Good morning, everyone. Welcome back to day 2. I am very pleasantly surprised by the in-person turnout, especially this early. So thank you so much for everyone for being here in person and for everyone joining us virtually. My name is Iman Kyler, and I'm a tax associate at Skadden, and I will be introducing our first panel. Prior to the introduction, I just want to flag 2 things. We have a very packed agenda today, so we will be taking a few 15-minute coffee breaks throughout the day, and we will have lunch at 12:15. To start with introduction, our first panel is going to focus on FDII. For our presenter, we have Pat Brown, who is the co-leader, Washington National Tax Services at PwC. And for our commentators, we have Kyle Parmelo, who is senior fellow at American Enterprise Institute here, Martin Sullivan, chief economist at Tax Analyst, and Alan Cole, who's the senior economist at Tax Foundation. I know Mindy yesterday flagged that this is not, the focus is not economy. We're not going to have as many economists as more of a lawyer, conference, but this is for folks looking for that aspect. This is your panel. But thank you so much again, everyone, for being here. And Pat, I'll hand the mic to you.
Thank you. Thanks everybody for coming back, and thanks to all of you in TV land for joining us as well. I just have to gently correct my introducer. It's FDII, not FDII. That's for you, George. I also have to note President Eisenhower, as many of you may know from back in history days, not that many of us remember him, he was a famous golfer, and he said that he would know after he died whether he was in heaven or in hell based on which tee box he was lined up at. And there was a particular hole at the golf club that he played at that was just his nemesis, and he said he would know he was in hell when he opened his eyes after his death and he was at that tee box. My version of that would be lined up to moderate a panel with 3 economists. And so here I am in my version of hell. But of course, this group of panelists is outstanding and really does need no introduction. So I think I'm going to try and get right into it because we do have a lot of ground to cover, and I think we only have 2 hours, isn't that right? I'm kidding. No, we just have an hour. So I'm just going to take a couple of minutes, but really only a couple of minutes, and talk about FDII in terms of what it technically does, just at a high level, but frankly just enough to kind of get us into the meat of the conversation. And I really hope that these 3 guys can give us their insights really from an economics perspective, because fundamentally how we judge FDII in terms of whether or not it's succeeding, in terms of whether or not it makes sense for the United States, I believe, as a non-economist, is really fundamentally a question about the economics of it and the behavioral incentives that it creates or doesn't create, and what kinds of reactions the business community can be expected to do, can be expected to undertake as a result of having FDII there. So what is it? It's a 37.5%, currently, a 37.5% deduction for qualifying income of U.S. corporations. Of course, FDII is the carrot to GILTI's stick from the 2017 Tax Cuts and Jobs Act. Those 2 pieces together, both are in Section 250. So together with the 50% deduction for GILTI, the 37.5% deduction for FDII is frequently referred to as the Section 250 deduction. FDII, as the name implies, is related to income from sales of property to foreign persons or services provided to foreign persons. So it's directed to non-U.S. activities conducted by U.S. corporations. Of course, the name would also imply that this is measuring intangible income, that FDII is a benefit for intangible income. But just as we talked about a little bit yesterday on the panel on GILTI, FDII doesn't actually measure intangible income directly. Instead, it is determined formulaically. So the way that operates is essentially very similar to GILTI. There's this concept of QBI, and your eligibility for FDII is determined by essentially the amount of income that exceeds 10% of the taxpayer's basis in tangible property. That then determines essentially what is referred to as your deemed intangible income. You then have to figure out what is the ratio of that income that is considered foreign, because again, FDII is only available for foreign income. Now, as we may get into a little bit if time permits, the Section 250 deduction is limited by a taxpayer's overall taxable income, and no carryback or carry forward is permitted. So it's very much a current year snapshot, again, in many respects similar to the way GILTI operates. So that's technically what it does, again, at a very high level. In terms of its purpose, if you go back to the 2017 legislative history, and of course FDII was a creature of the Senate bill. It was not in the House bill. It was a creature of the Senate bill. But the Senate Finance Committee provides two purposes in the legislative history for FDII. The first is to provide an incentive for taxpayers to earn intangible income in the United States, and therefore to attract, and this is the term used in the legislative history, quote, potentially valuable economic activity. So I'll say that's purpose one. Purpose two, which I sometimes refer to as GILTI FDII parity, provide neutrality between earning intangible income in the U.S. through a U.S. corporation versus earning that same income outside the United States through a controlled foreign corporation. And again, quoting here directly from the legislative history, the goal here was to limit the extent to which the code, quote, distorts business investment decisions. Now, those two purposes are frequently aligned with each other in the operation of FDII, but there are places, as hopefully we will get into as we go through this discussion, where they can potentially be in tension or in conflict with each other. And so in thinking about what we want FDII to look like going forward, should we have it at all, and if so, what should it look like going forward, we need to kind of, I find at least, it's helpful to go back to those purposes and ask the question, how are we aligning ourselves with the purposes of FDII as reflected in the legislative history? That is, to what extent are we pursuing the design features that Congress intended? And again, to the extent those two are not necessarily aligned with each other or even potentially in conflict, which of those two design features or design goals should be paramount? Okay, so to start off and maybe ask my panelists to kind of jump in here and get into the part of the discussion. So one of the questions that I think one has to confront in the area of considering FDII is, to what extent are the policy goals appropriate? Focusing specifically on this question, again, I'll go back to the prior slide, which talks about this potentially valuable economic activity. So the goal of FDII from Congress's perspective was not merely to get the income in the United States, it was rather to get, quote, potentially valuable economic activity in the United States. Now, there is, of course, and the paper goes into this, there is a considerable amount of economic research that talks about and supports the notion that there are these, quote, spillover benefits with respect to R&D. So there would, in other words, there would be economic research that supports the notion that countries should consider supporting R&D activities, attracting more R&D activities to their country because of these so-called spillover benefits. Question for you guys all on the panel, the economists on the panel, how do we think about that question with respect to the ownership of intangible property? And as we're going to get into, I hope, as we go through the panel, how do we think about the question of categories of intangible property? Because as we will get into, of course, FDII is fairly agnostic, I would say very agnostic, to the categories of intangible property. Remember, as we talked about, FDII does not even define intangible income directly. It does so indirectly, and so therefore, by design, it's very much agnostic to this question of, is patented IP more valuable than marketing IP? Are certain types of IP more worthy of congressional largesse or some form of incentive? And so maybe I'll throw it open generally, but I'm wondering if any of my panelists here have any immediate reaction to this question of, how do I think about this spillover benefits question? How do we think about quantifying, measuring, or even just thinking about the benefit of attracting the ownership of intangible property to the U.S.? Anybody want to have a go at that?
Well, I'll start off, and
Okay,
then
great.
y'all can
Thanks,
correct
Marty.
me. The, you said FDII was agnostic, and I thought that was a good way of characterizing it because it's very broad. And let's just contrast to a patent box, where a patent box only patents are qualified. That doesn't include non-patented research IMP, and also it's overly broad because it includes copyrights and other. And we as economists, and this is very well known, that R&D has spillover benefits. I don't think advertising and commercialization does. And within R&D, NSF has 3 different categories of R&D: basic R&D, intermediate R&D, and development. And the basic R&D is going to have more spillover benefits, but it's less commercially valuable. So those moonshot projects, while at the end of the R&D process, you can see where the profit is going to come in. So we don't, I would say economists generally don't like subsidizing non-technical IP.
So do you guys have a reaction to that, Kyle, Alan?
So maybe at a high level, worth noting or thinking about the goals of FDII versus a patent box or versus, say, an R&D tax credit, where FDII, I think, its operation is in the context of an open economy where corporations can locate unique assets, either in the United States or overseas. Those assets can be intellectual property that earn, what economists call economic rents. And generally, economists will tell you we want to tax economic rents at higher rates and excuse normal returns. But in an open economy, it's flipped for these assets, that we worry about putting too much of a burden on them because might locate them elsewhere. And that's, if you look at the design of FDII, that's what it's getting at. It's carving out normal returns and placing a lower burden on excess returns, broadly defined, whether that's intangible income or pure profit shifting from one jurisdiction to another. A patent box, on the other hand, is designed in ways that are supposed to, but I'm skeptical that it would, encourage additional R&D. Okay. The reason I'm skeptical is the base of the patent box is not well designed for doing so, and we can get into that.
In terms of real R&D, I'm not particularly worried about the international margin in terms of would people choose to create valuable R&D projects elsewhere rather than the United States too often. I just, if you kind of eyeball it, if you think about the world's forward-looking companies that you think are going to capture the next big trends, they're probably starting a lot of their real activities in the United States. I don't think anyone would expect, if you take a new trend like AI or self-driving cars, you would not expect to see 3 German companies and 2 American companies going forward in that. You're expecting something more like 7 and 1 in favor of America. So I'm not worried about that margin. You could be more worried about the margin of, does America have too high of a social discount rate, as it were? Is it thinking too much about the present and not enough about the future? And I do think tax codes are frequently guilty of that. So that's the margin I would worry about more in terms of real R&D. Perhaps we're just not doing enough of it relative to kind of its present valued benefits over the rest of my life and my children's lives and so on. But for the most part, I do think of FDII more as being about capturing the taxing rights of the R&D that we already know happens and will happen a great deal in the United States, almost kind of regardless of tax policy within the reasonable bounds. We know we're going to get a lot, and we just want to get the taxing rights.
So one of the questions I note here on the slide, and you guys may not have a reaction to this. I mean, in some respects, this feels more like a legal question. Certainly welcome anybody in the audience's reaction to this. But the second sub-bullet I've got here on this slide, does IP ownership in the US lead to greater IP utilization or exploitation in the US? I think the reality is from a tax perspective, from a tax legal perspective, I'm the lawyer here, it can be tricky if your IP is owned outside the United States to figure out how to manufacture in the United States, essentially in a tax-efficient way. Whereas if your IP is owned in the United States and we have that encouragement to own the IP in the United States, which FDII provides, now the manufacturing equation becomes a little bit easier from the standpoint of the way you might establish your manufacturing operations. Again, I don't know if anybody in the audience has any reaction to that, but it's certainly something to be aware of. When I think about sort of the traditional spillover benefits, I would think about them the way you guys have talked about them. But that's sort of, well, what benefit do I see directly from IP ownership in the United States? Does it give me more R&D in the United States? Well, maybe it does, maybe it doesn't. But does it potentially lead to more of that downstream activity, the manufacturing type activity associated with the ownership?
Potentially valuable activity.
Right, exactly. As the Senate said, potentially valuable activity. We're going to come back to Pat. Yep, please. If you're going to try and correct my pronunciation, pal, we're going to.
Okay, thank you. And thank you, Pat. Great job. I agree with almost everything you've said so far. I do have to say that my teenage daughter thinks her dad is cool solely on the basis of my claim to her that I helped put 50 cent in the tax code. So I will die on that hill. And as a consumer of tax policy consulting services, I like what I'm hearing from Skadden on this question. I just want to say. So I don't know if EY wants to chime in, but we can maybe talk about that later. So yeah, I think you were just hitting on where my mind was going, which is, and Kyle kind of got to this as well as Alan. There's this question of what's the purpose, or is this about encouraging more R&D at the margin, like on an NPV basis, or is this about neutrality or reducing differentials in the location of ownership of IP and therefore the location of excess profits? My view has always been that FDII is more about the latter. If you're trying to do the former, then yes, you want to look at other R&D credit or expensing or super deductions or things like that, certainly. But it's really about where the profits are located for tax purposes, which then kind of leads to the question of how important is that?
Yeah.
And I think you were getting at, like, for example, if you have the IP offshore, you can't license it back to the U.S. because you're going to have U.S. source subpart F income, which is like one of the biggest fouls an international tax planner can commit.
Right.
And so we know there are reasons why you want it here.
Right.
I don't know if there's any way given this is an economist panel, to try to quantify the magnitude of that, because at the end of the day, there are trade-offs, right? We want the tax base here. We want any spillover benefits here. But there's also, if it's a marginal amount, then maybe it's not worth the revenue loss. But if it's a significant amount, then maybe it is. And so it's really, I know it's a question that nobody's probably ready to answer, but just kind of putting it out there. Yeah. There is clearly a rationale for it. The question is there any way to quantify it so that the trade-offs can be analyzed with better information?
Yep, thanks, George. I mean, I think, Marty, you've written, of course, about how FDII has influenced taxpayer behavior, to what extent we see that in the data. That really goes more, not so much to George's question on this exploitation point, but rather on to what extent are we seeing things like, for example, more royalty income in the data and things like that. But do you have a reaction to that, kind of to what extent are we seeing, to what extent is it effective in the sense of getting the IP here?
By the way, you're saying you have the correct pronunciation. George, it was so funny yesterday. I was watching, I'm sorry I couldn't be here yesterday. I had to watch it at home. And in the closed captioning, every time you said Cuba, it came up as Cuba. And your first comment was, the first time you mentioned it, you said, I'll reserve that for my comments on Cuba. And I'm like,
Very
anyway.
wide-ranging, this conference. We cover a lot of topics.
I forgot what the question was. Oh, no, I absolutely agree with George that if you look at this as an R&D thing, it gets very, very, very low marks. The intention was to move mobile profits back to the United States, and we're going to show some data on that. Now, the harder question is, does it bring real economic activity? And as George says, we really don't. I see no, there were some economists who were just asserting, oh yeah, automatically it's going to do that, and that got quickly dispelled. I don't know about the tax technical difficulties of bringing it back, but I see no reason why where I locate my patents,
Right.
they cannot just be licensed back.
Right. I think there is no reason apart from the legal reason, which
Right.
George and I were alluding
So
to, and that's the.
That
Yeah.
is, and I think that's really important because if it's not R&D, and we'll tell you about the magnitude of the profit shifting that might be attributable to FDII, then are those potentially valuable activities actually occurring? Right. And a priori, I doubt it, but I cannot.
Right. So there's another rationale, and Alan, I want to come back to you on FDII, which was not described on the prior slide, was not part of the legislative history, but maybe now is maybe looming larger or should loom larger in policymakers' minds, and that is, of course, reflected here on, I think it's the second bullet. And it's really, the U.S. is not necessarily indifferent to whether taxpayers choose GILTI or FDII. Again, this neutrality point from the taxpayer's perspective, perhaps the taxpayer becomes indifferent. That was arguably Congress's goal, make the taxpayer indifferent to whether or not they earn that income as GILTI or they earn that income and qualify for FDII. But that doesn't mean the United States is indifferent to it. FDII, of course, provides, generally speaking, a primary right to tax intangible income, the first right to tax the income, whereas GILTI, of course, provides only a secondary right because the country where the foreign country where the activities are located is going to tax the income first under GILTI, and then the U.S. would get a post-foreign tax credit taxing right. So as we think about a world, Alan, where foreign tax rates seem to be on the rise, because of course a number of countries have taken steps to adopt minimum taxes and things like that. As we think about that world, should we think about a different rationale for FDII than the rationale that maybe we had when we enacted it 6-7 years ago?
Absolutely, absolutely. I imagine the kind of best case for the GILTI FDII regime in 2017 to be when you're looking at a firm that has the option, let's say, to move some ethereal intangible assets to a very low tax jurisdiction, or to just keep them in the United States and not do anything fancy. And there, you don't actually care too much about whether your taxing right is primary or secondary, because the whole point is, well, if they're locating assets somewhere else, locating intangible assets somewhere else, they're probably locating them in the place where they can pay the lowest foreign taxes, some small island that just takes a tiny little 1 cent off of every dollar. And that's their structure. And then you get the full secondary taxing right that's really not diminished very much by the tax haven at all. So GILTI is kind of meant to work hand in hand really well with a low tax jurisdiction, and essentially act as a tax on that income anyway. So that sort of firm would be indifferent between GILTI and FDII. But the whole point of Pillar 2, the whole point of the global minimum tax is, if it works, we're going to get rid of those low tax jurisdictions and bring everyone up to 15%. And it's going to work, strongest on those jurisdictions I just had in mind that work hand in hand well with GILTI. And when you look at GILTI against a higher tax jurisdiction, what happens is there are foreign tax credits. We say, okay, fair enough, that's a real jurisdiction that's taxing the income a bunch, and we're not going to go after it. I have more questions about that approach now that Pillar 2 is here, because we would rather get the money than not. Pillar 2 says we don't care where you pay 15% as long as you pay 15%, and perhaps the companies won't care anymore, but the United States Treasury should.
Yeah.
And in that sense, FDII seems to be, it needs to be more attractive than
One of
guilty
the
going
things
forward.
interesting about that, want to get you guys to react to this, but we heard several times during the conversation yesterday people making reference to Pillar 2 is here and aligning with Pillar 2. One can be quite skeptical about the extent to which the world will truly align and stay aligned around Pillar 2 and still take on board the point you made, Alan, which is tax rates going up in foreign jurisdictions, fewer and fewer so-called tax havens in foreign jurisdictions around the world, causes the United States, again, the United States Treasury, to think differently about this primary versus secondary right, even though one may have a somewhat skeptical or jaundiced view on the extent to which we're truly seeing the emergence of some kumbaya moment in international taxation. But I don't want, Marty, Alan, you guys have any reaction to any of this stuff?
Just noting that I think that this analysis is probably quite complicated, even under current law or the current regime, and also in the future under Pillar 2, and also gets to my skepticism of whether guilty and FDII really were had this parity to begin with. That because they operate differently, one of them provides a deduction against the U.S. tax base to provide the lower rate. The other uses a foreign tax credit system to get at roughly the same rate. That can end up in different, a company can end up in different situations depending on its activity elsewhere. So you can be in excess credit position and guilty doesn't really matter. And that could happen pre-Pillar 2. And then post-Pillar 2, same deal. Pillar 2 is not literally just a 15% statutory tax rate on profits earned in low tax or in all jurisdictions. There's a lot of base shenanigans going on there. So this is going to be very like country by or company by company, rather than a broad sweeping generalization of how this might play out.
Shenanigans, by the way, folks, that's an economist term. Lawyers would never use that term. Marty, do you have any reaction to this, or should we move on? Happy to move on.
I just think it's a lot of shenanigans. But the about Pillar 2, I know we want to focus on that, but I do think it does change the landscape. If it works the way it's supposed to work, big question, we would get rid of tax holidays and patent boxes in those low tax jurisdictions, maybe. Kind of, or we would diminish the benefits of them. So, go ahead.
Those, one way I think about those is whether they're like special low rates on certain income that operate within a broader regime. You think of those at the margin. Right. That you have one additional activity that's going to be pushed into that, and that's going to get a lower rate. Yeah. Whether that triggers Pillar 2 at the margin depends on your activity everywhere else in that jurisdiction. Yeah. So I don't think that they go away, and their design may not change very much either.
So, Marty, carry on.
Okay. I agree with Kyle.
Okay.
But I just want to say about you're talking about revenue. And so a big question is, does FDII raise or lose revenue?
Right.
Now, it's a Laffer curve type of thing.
Right.
So if a lot of IP comes into the U.S. and we start taxing the income from that IP, it actually could be a revenue raiser.
Right.
So and since I think the main goal, or the way I think about the main goal of FDII is to scoop up all that IP, prevent all that IP from ending up in tax havens, IP income. And but on the other hand, so that's good, that raises revenue, but you lower the rate.
Right.
You lower the rate on all IP, export IP. And so it's a trade-off. So it's not really clear if there is
We
a
could get all the IP if we didn't tax it at all, but then we wouldn't be getting very much revenue, right?
That's Laffer curve.
See, I'm actually an economist, folks.
That's a technical term.
I want to now kind of come back to this comparison with patent boxes, because I do think, you know, there are questions. Of course, a number of countries around the world have patent box regimes. As far as I know, a regime that looks very much like FDII is unique to the United States. And some of the differences here that are just worth ticking off, and then obviously get you guys to react to any of these that you want to react to. But of course, as we noted at the very outset, FDII is limited to activities that are directed to foreign markets, right? Sales or services directed to foreign customers. Patent boxes, no. Patent box would apply equally whether you were selling to foreign persons or selling to the US. Patent boxes, Marty, you alluded to this. You know, certain types of IP qualify for patent boxes, but other types of IP don't. Certainly, you know, marketing IP, for example, wouldn't qualify typically for patent box treatment. I'm not aware of any jurisdiction, in fact, that would have their patent box apply to marketing IP. How do we think about that? And, you know, Marty, going to the point you just made about we want to scoop up all this IP. Well, when I hear all, I think marketing, patents, copyrights. I think let's get the whole kit and caboodle. But if I think about spillover benefits in a more narrow sense, maybe I think about that question. Maybe I think about that question differently. Not really sure how to think about that. One thing we haven't touched on at all, which is a feature of a lot of patent boxes, is a so-called nexus or substance requirement. So you only get the benefit to the extent the activities, so we'll call them DEMPI activities, or some meaningful subset of these activities are done in the jurisdiction where that is giving the patent box benefit. That's clearly a way to say, hey, we're giving the benefit because it's tied to jobs and we want those jobs. And so, you know, that's the rationale behind it. But I want to get your collective or individual reaction to any or all of those criteria, which again are differences between FDII as we know and love it today and patent box regimes. So.
Yeah, so just a quick comment on the nexus requirements. I mean, that would change the nature of the benefit quite a bit, in that it would no longer be about the location of IP, right, and rather just the location of additional economic activity. Now, that additional economic activity, I'm skeptical that patent boxes are structured in ways that would encourage additional economic activity. And the reason for that is, one, that a lot of R&D is already expensed throughout the world. Right. So if you think of it for a traditional cost of capital model, that upfront deduction at the lower rate is going to be equal to the present value of your tax at that same rate. So it's a zero tax rate, whether the rate is set at 10, 15, 20. You're just losing revenue at that point. Now, there are exceptions to this. The UK, for example, allows debt-financed investment to be deducted against the ordinary corporate rate, which makes it very valuable for additional investment. But yeah, I just because of those structural components, I am skeptical of the policy of moving in that direction.
Moving to more of a nexus requirement.
Which again, going back to the first point I made, is kind of the opposite of how economists should view all of this, where right, you want to encourage the marginal activity and tax the economic rents. But in this narrow case, right, I think it's good to be focusing on the location of activity.
Yep. Alan, do you have a reaction to this?
Yeah, so one difference between FDII and patent boxes that you highlighted, and I just thought I'd relate how I think about it, is the fact that FDII applies to exports rather than more generally, as a lot of patent box regimes do. And it's kind of an interesting choice, and I've thought about this a little while as kind of several provisions from the Tax Cuts and Jobs Act in international sphere. They do a sort of examination of the statistical accounting profile of what a company looks like and comes up with a response based on well, this sort of a company is often doing this sort of thing. Right. And so we want to have this sort of regime. And that's kind of a recognition that you can't look into every last transaction and argue about each individual transaction within the firm and get the perfect tax code. You just kind of want to do something that's in the broad strokes right. And for example, with FDII, that would be the fact that the income is earned abroad, or the revenue is earned abroad, really suggests that you could attribute a lot of the income to abroad as well if you wanted to. If you're selling in some other market, you probably have some ways of saying, actually, a lot of the EIP is involved in the selling rather than in the in kind of home country production. And so it's an unusually shiftable set of income. Right. And we want to say, this is the sort of company that has unusually shiftable income, but nonetheless kept it in the United States. That's probably we have a tenuous hold on that income. We want to tax it less. And you'll see that approaches like that elsewhere in the Tax Cuts and Jobs Act in terms of guilty when it's mostly enacting its secondary taxing right on low tax jurisdictions. It's like, well, that income might statistically probably belong to us in some sense, much more than the average income. And the same thing with BEAT a little bit. It looks at statistically sketchy looking tax profiles and goes after those companies first. And none of these statistical discrimination schemes work perfectly, but they probably work more cheaply than the alternative of closely examining every transaction. So that's one of the differences between FDII and a patent box, and I kind of like it.
Yeah. So Marty, I want to come back to you. You touched on this question about revenue, right? And we know that coming into 2017, we had a very highly developed patent box proposal, Bustani-Neal, which we refer to here in the slide, developed in the years prior to TCJA. Clearly a lot of thought given to it by congressional staff, by members. Didn't get enacted. My sort of, I'll call it naked supposition to this was when you did the math on providing patent box benefits in the United States, given the size of the US market, what you ended up with to get an acceptable revenue number was just a benefit that was so modest, it wasn't going to influence behavior. And as you noted, the goal here is to influence behavior. So I don't know if you have a reaction to that. I know you've looked at Bustani-Neal in the past, although in fairness, we've all looked at it in the distant past because it's been 7+ years since anybody's thought about it a lot.
It was the summer of 2015. Everybody was talking about patent boxes, and then it went away.
Right.
And I can't remember exactly why it went away. Maybe it was the revenue cost, or maybe it was just the ridiculous complexity of it all, because you had to do so many allocations. Yes. One of the parameters was above the line costs. Yes. Well, that line can be adjusted. Yes. As people who do BEAT understand. I just think it just lost its appeal.
Complexity, revenue issues, maybe a number of points. I should know.
I read that. You should really ask George.
Do you want to comment on that or not? Okay.
I've always said that it was 2015, by the way.
Right.
It went away not because the...
We have a mic coming your way, George.
The 2015 Bustani-Neal patent box went away not because the opponents of a patent box didn't like it, but because the supporters of a patent box didn't like it. And it wasn't generous enough for them, but it cost so much. And when we hinted that maybe you use R&D amortization to pay for it, people were like, no, forget it. Yeah. To make it as generous as the supporters of a patent box wanted it to be, it would have cost as much as like a 10% corporate rate cut. And so the view was, well, if it's going to cost that much, we'll just cut the corporate rate.
Right. Okay. Thanks, George. So I'm mindful of time, and I want to turn the conversation to Cuba before we get. Sorry, that's Cuba. Maybe I'll really emphasize that. Because on this point about parity between guilty and FDII, now this is, this may be more of a lawyer's point. But when we think about QBI, look, it's computed in a very similar manner, not identical, but a very similar manner for GILTI and FDII. But the impact can be very different, and this actually came up on the GILTI panel yesterday. The impact in the GILTI context, to the extent income is, if you will, covered by QBI, the United States effectively relinquishes the taxing right on that income. In the FDII context, to the extent the income is covered by QBI, it's taxed at a 21% rate. And certainly since FDII was enacted, there have been a number of, I have had conversations with a number of taxpayers around this question of, I would really like to do more, have more IP in the United States, but the reality is the size of my capital investment, my capital stock in the United States is so significant that it wipes out much of my potential for FDII benefit. Now, obviously, if that capital investment is outside the United States, and QBI is operating in the GILTI context, you're paying local tax but not paying US tax at all. So again, a very different impact. So I guess, a question for you all to think about from an economics perspective, how do we think about this notion of QBI as a disincentive to either moving IP, or if you have the IP here and you're getting FDII today, does it now become a disincentive to making that next capital investment in the United States? And to be clear, I think policymakers want both. We want the IP, we want the capital investment here in the United States, right? So how do we think about that? I don't know, does anybody has any reaction to that?
Well, it's pretty plain. If you look at the formula, as you say, it's formulaically computed. If you incentivize IP income, you're disincentivizing tangible income. Mm-hmm. So in the case of GILTI, you're encouraging foreign investment, and in the case of tangible investment, and in the case of FDII, you're discouraging domestic investment. That comes right out of the formula. There's no avoiding it. Now the question is, what are the elasticities? Sorry to use it. Does it really happen?
Right.
But I think
is this a lawyer's problem, in other words? Is it a lawyer's problem that I would highlight, but you would say, well, is it really going to happen?
Yeah, right.
Yeah.
I don't really care if it happens. I'm just theoretically telling you what's possible.
The economist's answer.
Marty's point gets to Kyle's idea that in some sense, these regimes look backwards because we're being so nice to kind of the maybe most intangible ideas, some of which are going to be here forever, never going to go away. Once an idea has been thought up, people can remember it, and it's not going away. Whereas we're being much harsher on the actual expenses, where a tax rate could make a difference. Ideas reproduce themselves for free; factories don't. And so in some sense, the regime feels backwards, but it's all because of this international profit-shifting game. And if we're right that the international profit-shifting game is more important, then you do things that kind of look silly in terms of the real economy because they work well in terms of the on-paper economy. And yes, that feels a little bit depressing, but it's not necessarily the wrong thing to do.
And maybe I'll frame what Marty said a little differently, and I will count this as my qualified defense of QBI. There's been a lot of QBI dislike at this event so far, but I think in the context of GILTI, one way at a high level to think about QBI is it is protecting the normal return on tangible assets. So if a firm's discount rate is equal to the QBI rate, a firm is going to face the same investment incentive as if under a territorial tax system for tangible property. So the U.S. is not distorting investment decisions, it's not distorting ownership of assets, and that's a positive thing. Now, because it's formulaic, that may not be correct in practice. 10% is awfully generous, and as a result, 10% in the foreign context may be shielding excess returns from taxation and actually distorting the location of assets. Okay. And then on the FDII side, same deal. Because it's formulaic, 10% may be too much, and it may actually be harming. Marginal investment incentives in the U.S. I mean, an alternative system would be to use expensing of tangible assets in the place of a formula. Now, the challenge with that is that companies may not like that because of how it's treated on the financial statement as a timing difference rather than something that permanently reduces tax. And there's also the issue of how to deal with new assets versus old assets. QBI was pretty clever in that it applied to all existing basis and is a permanent difference.
The way to solve the QBI is to just use expensing. Let me just explain a little bit. Economists know there's two ways to measure excess profit. One is to use the FDII and QBI, the QBI method.
Right.
The other is it's a well-known economic thing that if you do expensing, all you're equivalently taxing, you're exempting from tax the normal return and only taxing the excess return. So you could simplify this thing and get the same, not the same result, but the same concept, as Kyle said, of excess profits by just allowing expensing in the computation of FDII income.
So I want to ask you guys a
So
question
get rid of
about
QBI, go to expensing.
So
Make life easy.
we had, of course, when the TCJA was enacted, we had expensing in the United States for a number of years, and of course, there's a strong desire on the part of many businesses and many in Congress to go back to it. Could we have expensing in the U.S. and dispense with QBI in the FDI context, but retain QBI in the guilty context, because expensing outside the United States in the guilty computation, I'm not even sure I know how to wrap my head around whether or not that makes sense. But I mean, as an economics matter, if you say, well, there's two ways to do it, Marty, could I do it one way in the US and another way outside the United States?
I don't see why not. Again, we all know that 10%, so many fingers I have on my hand, that's we came up with 10. And you know, the adjusted basis and do it quarterly. I mean, all this precision for an imprecise concept seems sort of ridiculous to me. And expensing is one of the simplest things in the world to do. And so let's just, and it achieves the same. Now it's arbitrary and numerically it's going to be different, and accounting-wise it's going to be different. But you know, George mentioned the Altshuler-Gruber paper from 2013, and they used expensing to separate excess profit from normal profit. So I'm not making this up.
Right. Not that we would accuse you of that anyway, Marty. Yep, please, Mindy. We have two questions. We have Steve and Mindy, I think.
Oh, I didn't see Steve.
Marty, I just think it's important to unpack a little bit all of the, in my view, quite heroic assumptions that one has to make to reach the outcome that expensing only ends up taxing the excess returns.
Yes.
Because in practice, in the United States, I would submit it has not worked that, it doesn't work that way, it can't work that way. So can you explain the theory so we can understand the distinction between the theory and reality?
It's mathematically proved under certain conditions that if you expense the rate, and the discount rate is the same as the normal rate of return, that it exactly offsets that. And so the marginal effective tax rate on marginal investment is equal to zero in the cost of capital formulas that economists love to use. Now, does that really work in reality? Is that appropriate under all conditions? No. But again, I have a low bar to go over at 10% of QBI. So I don't really feel bad about being imperfect.
It may be bad, but it's no worse than that. That's I think what they're getting
Another
from Marty.
observation here is that, you know, if just to add is if companies were only earning normal returns and we enacted expensing, the corporate tax would raise no revenue, but that's not the case. And it's because there are economic rents. So it's not as though that expensing is shielding rents. It's that expensing is not shielding the rents, and we're still able to raise revenue if we were to go to a regime in which all investment were immediately expensed.
Yep. Mindy, please.
Yeah, must be missing something here, because how is expensing, aren't QBuy and expensing doing the opposite things for FDII? Like, okay, so it's, you can't repeal QBuy and replace it with it, because expensing exempts the
Depends on what you're
normal
building.
return, and FDII subjects it, the
But if
QBuy
you're trying
subjects it to a higher rate.
I'll answer the way I think about that, is if you're trying to have this benefit of FDII only apply to the excess returns, you could say, my whole question about what to do with the normal returns is a different question. I'm answering that question differently in the GILTI versus the FDII context, right?
But isn't, if you weren't worried about cross-border stuff, wouldn't you say the right answer is expensing to theoretically exempt the normal returns and fully tax at a high rate the excess profits, right? Isn't that what?
Yeah, that was my first
that's what Kyle said
point. But
initially.
I think in the context of this theoretical system, expensing would be in the base, and then all you would need to do is then provide a lower tax rate for the foreign-derived intangible income.
But you only need that because of cross-border concerns, not
Right.
pure economic.
Right.
Just to come back to a point that was made earlier, expensing is only available for new investment, and QBuy deals with old investment.
And new investment, Michael. It deals with new investment, too.
It deals with both,
Yeah.
but if you ask what's the largest part of QBuy,
Right.
my guess is it's the older investment rather than the new investment.
Right.
So you're basically talking about an alternative that does not deal with the excess returns on old investment, which is what FDII and GILTI
Yeah.
were largely concerned with. And so it's
We'll
not,
call that a transition issue, wouldn't you say, Mike?
Right.
well, it's, yeah, at some point, all of the investment will have occurred after the change in law. Yeah, that's right. But as Keynes put it so well, we'll all be dead by then.
Right.
Yeah.
Isn't what you're saying that if we're going to keep QBuy and have expensing for tax purposes, we shouldn't use basis, we should use sort of economic depreciation for QBuy purposes? Because why give a tax break to the normal return when you're expensing?
Yeah.
So
You'd want to use
maybe that's a
adjusted basis.
technical.
You'd want to use adjusted basis.
Well, but not for tax purposes, because you're expensing for tax purposes. So you have no QBuy,
Right.
so you get
Right.
your normal return
So
as
then
well
your
as your
This is a
excess
fascinating
return.
conversation, but I'm going to move us on, folks.
All right.
We've only got a few minutes left. So there's a couple of other issues we want to get to before we leave. One, noted at the bottom of the page here, it relates directly to this point about patent boxes and the fact that we didn't do a patent box regime, which means we don't provide the lower rate benefits to sales in the United States. And yet, in the GILTI context, so thinking about this from a GILTI FDII parity point, the GILTI rate is available for CFC sales into the United States. So this parity, this sought-for parity between GILTI and FDII breaks down in that context. That could suggest to us that we should have FDI benefits available for sales in the domestic market because we have them in the GILTI context, or it suggests we should not have the GILTI rate applicable for sales into the United States, or it suggests that in 2017, perhaps Congress decided that this parity was only important up to a point. I'm just curious if anybody on the panel has any reaction to that. Of course, we already talked about the patent box point, and maybe that's a revenue constraint, as George pointed out, as much as anything else. But are there other issues to think about in this context as you all think about the question? Maybe, maybe not. It doesn't have to be the case, but I thought I'd put it out there anyway for you if you have a reaction to it.
Well, I don't know if it directly answers your question. We have to acknowledge, even though Congress didn't mention it, this is an export incentive. And it's a big export incentive. Right. And it's assuming you want an export incentive, it's very poorly designed.
Okay.
Now, I know that wasn't what it was designed for.
Right.
And it wasn't congressional intent. But nevertheless, it does have this effect of promoting exports in a very uneven fashion.
Yep. Okay. We've only got a couple of minutes left. We're about to get the hook. We had a great panel yesterday afternoon on foreign branches, but I want to ask you all the question, again, thinking about this in the context of parity. How do we think about income earned through foreign branches and whether or not where should it fall in the FDII guilty spectrum? Because right now, income earned through foreign branches, it's kicked out of FDII, but because it's not earned through a CFC, it's not eligible for guilty. So it seems uniquely disadvantaged, and that seems distortionary. Is there an answer to this question where we'd say, well, you know what, we should allow guilty to be applicable in the foreign branch context? That was touched on yesterday at the panel, but there was acknowledged there's some tricky questions that have to be considered in that context. Like, do you turn your branch into a CFC with all that goes along with that? Or potentially extend FDII to make FDII benefits available to income earned through a branch. But in fact, if the IP is held in a foreign branch, it's not in the United States. And so are you then missing out on, whether it's Alan's point on primary taxing rights, because of course, if the IP is in a foreign branch, you don't have primary taxing rights, the foreign jurisdiction does. Or is it in the context of these potential spillover benefits? So I don't know if you guys have any quick reaction to any of those questions around foreign branches. Is there a strong view on that, or should we should maybe kick that back to the guilty, the foreign branch panel and let them decide?
Let them decide.
Let them decide. Okay. We've only got, say, 2 minutes left. I want to ask a question that maybe is more of an economist question, and that relates to, we're not going to unfortunately get through everything in the time available, but expenses, specifically apportioned expenses, R&D. So we know that in the context of Section 904, for purposes of your foreign tax credit limitation, we have this concept of exclusive apportionment for R&D expenses. So if you do more than 50% of your R&D in the United States, you get to take 50% of that R&D expense and move it out of foreign source income effectively. You don't apportion it, it just goes directly against domestic income. That's obviously a benefit in your foreign tax credit computation. We don't do that in the FDII context. Treasury regulations, Treasury was asked to do that in the FDII context and specifically rejected that, said, no, we're not going to take that approach in the FDII context. I'm curious, as you all think about some of the concepts we talked about at the very start of this panel, R&D and the benefits associated with R&D performed here in the United States, is this something we should be thinking about in the FDII context? I mean, it may be something, well, it is something Treasury could do by regulation, but it's also something that potentially Congress could give a steer to Treasury in 2025 to say, we want you to do this, or not. Do you guys have a reaction to that, anybody? How do you think about that? Marty, I mean, you're looking expectantly like you want to say something.
No. The allocation rule, it's expense allocation, it just seems, I don't know, I'm not a practitioner, but it just seems you have to do FDII, you have to separate out your domestic from your foreign income and then your intangible income from your other income. And that requires expense apportionment. And that seems like a rat's nest of complications and arbitrariness. So I don't really have an opinion about this one.
Alan or Kyle, you guys have any reaction?
I think one thing we see when we at Tax Foundation have modeled guilty versus the kind of standard income inclusion rule is guilty is a little bit kind of less generous on expense allocation. And to the extent I have an opinion on that, I'd say that's probably a better way to go. But low confidence answer here because it's very tricky.
I think we'll have to leave it there because we're at time. So please join me, Alan, Marty, and Kyle. Thank you so much for your participation.
The second panel. Thanks to the first panel, Pat, the commentators, for such an excellent presentation and thought-provoking discussion. Now we're going to go ahead and turn to the second panel. This panel is going to focus on the sourcing rules. To start with the introductions, our presenter is Nita Asher, who's principal at PwC. And then our commentators include Barbara Angus, who is the global tax policy leader at EY, Steve Shea, who is the senior tax fellow at Boston College Law School, and Gary Sprague, who is a partner at Baker and McKenzie. Nita, I will hand over the mic to you.
Thank you,
Thank
Iman.
you.
And I'd like to start off by thanking the co-authors, Paul and Iman, the team from Skadden, for working on this paper with me. To the extent you agree with the recommendations, you can give Iman credit. And if you have any questions about the recommendations or disagree with them, please reach out to Paul. I've mentioned that to the commentators a couple of times here, but it was a joy working with you all, and really appreciate your efforts. So the sourcing rules are a fundamental aspect of any tax system, as they determine how income and expenses are allocated between jurisdictions. Multiple papers discussed yesterday noted the importance of the sourcing rules in the outbound context, specifically noting how the foreign tax credit rules generally allow U.S. taxpayers to credit foreign taxes paid with respect to foreign source income against U.S. tax liability with respect to the same income. U.S. source rules also apply to the allocation of expenses and determine which expenses can be deducted from foreign source income. With respect to inbound transactions, which I believe Harrison, who was in the room earlier, is going to touch on later on today, those rules generally subject non-U.S. taxpayers to U.S. taxation, principally with respect to U.S. source income. And thus the U.S. sourcing rules essentially define the extent to which U.S. taxing jurisdiction with respect to inbound transactions. The sourcing rules play a vital role in the U.S. international tax system by protecting the U.S. tax base and ensuring tax fairness. However, there hasn't been a systematic reexamination of the U.S. sourcing rules since the 1960s and in some cases the 1920s. Throughout the years, U.S. source rules have faced extensive criticism from commentators because these rules are difficult to conceptualize, often lack economic grounding, and are not comprehensive. Furthermore, even with extraordinary technological and social changes, the sourcing rules have remained relatively unchanged since time of enactment. So accordingly, from a tax policy perspective, the U.S. source rules seem ripe for broad tax reform. However, this paper notes, and the commentators here will also note, that we must proceed with caution with respect to any broad reform or even narrow reform of the sourcing rules, because we could give rise to unintended complexities and potential economic distortions. And I have to say, the one thing that Eric and Pam and others did not task us with is making the system more complicated than it currently is. So I just want to keep this in mind when you're reading through the paper and hearing comments here. Also note that the paper focuses on the source rules for certain specific classes of gross income. We're going to touch on the sourcing rules with respect to personal services income, royalties, Gary's favorite, and gains from the sales of personal property and inventory property. I'll also note at the onset and during the course of the presentation that the source of income and the characterization of a transaction are interrelated and are of great importance. In the paper, you'll see we went through some of the interesting characterization issues that taxpayers and advisors grapple with before we even get to the sourcing rules. I think that's important to note here. So it's not just potentially reform with respect to sourcing rules, but also clarification with respect to some of these characterization issues that we see in practice. And so I'm going to pause here before diving into the three categories of income that's discussed in the sourcing paper and pull in the commentators for big picture comments from the onset. Wanted to start with this. Actually, after Pat's panel, I was like, let's start with some big picture because I want to make sure we cover those now, and we might re-emphasize some of these items at the end. So does anyone want to start? What came to mind when thinking about, 2025 and beyond, questions with sourcing rules? Barbara, I know this is something, this is not the first time people are thinking about the sourcing rules. And what we have here is the benefit, I think, was it Mindy? We're not worried about the economics. We're not worried about a reconciliation bill that might prevent us from referring to treaties or other things. The world is our oyster. What should we think about here?
And one thing that struck me, the first thing that struck me in reading the papers, in the paper, is that it did a really good job in making clear how incoherent the source rules are, and sort of out of date and just pretty fundamentally incoherent, which may be true of some of the global traditions on source rules as well. But two things that I was struck by, and I know it's sort of a constraint of this project, but not one that we commenters agreed to be bound by. One, I think it is impossible to rationalize the source rules in isolation. We need to factor in everything about the operative tax rules that relates to source and how we tax income once we've sourced it in order to get to a rational result. I thought the point made in the paper that there are countries that do not have separate source rules, that have one set of rules that does both things, seemed like a really interesting idea to explore. And then in terms of isolation, maybe a more important and more difficult to deal with issue is, I think it would be very hard for the US to rationalize its source rules in isolation. I think it does require a global discussion, because if we make changes there are changes to the source rules that I think the paper highlights that would be deviating from a long-standing global norm, and for the US to do that unilaterally would be incredibly complex. So to me, it seems like there is a place here for a global discussion. Let me be clear, I'm not suggesting BEPS 3.0 or Pillar 3. I mean a real traditional, old school, global discussion about the technical issues, the policy considerations, and not something that leads to mandates. And in thinking about that, and there were a lot of references in this paper and actually yesterday to the AOA, I looked back, and the work on the attribution of profits to permanent establishments began in the OECD in the mid-90s. It went through at least 8 public consultations before those principles were put into the OECD model treaty in 2010. And it was tons and tons of work within multiple working parties in the OECD, and that is the kind of discussion I think that the source rules generally would deserve.
Very thoughtful, Barbara. Steve?
I'd like to build on what Barbara just said. Source rules have a kind of unique role in the United States, and they're kind of an additional key to turn to make adjustments for when we tax, when we don't tax. Many other countries don't use them, but I want to make 2 points about source rules. One is they do not have an economic basis of any significance. And that was pointed out years ago, back in the early 90s, by David Bradford, Hugh Walt. And if you think about it, Paul gave an example earlier. well, if I am sitting in his case, Washington, giving advice in Egypt, why should that be sourced in Washington? And vice versa. If you're in Egypt giving advice and you spent 30 years building up your intellectual capital in the United States to give that advice, why should it all be sourced in Egypt? So you can see the relative potential incoherence. I will also put a different example, but gets to the same place. What is economic income? Economic income is the return to an expenditure. You expend on capital, you expend on labor, and then you earn your return. How does the tax law do it? We take the income first. We say, what source does it have? Well, if we go back to our economic example, and that final sale is a result of a supply chain that started in one country, went to another country, went to a third country, and then the final sale is of a distribution company somewhere. That income is really economically the outcome of all the expenditures in that supply chain. But what do we do in tax? We take the last piece, and for each separate piece in that chain, we say, where were we when we did it? That also requires a heroic understanding of how much income was earned at each place. And if it's all arm's length, that's one thing. Most of our income is not arm's length. So economics and source have a very distant relationship. I think at best they're in-laws, but they're certainly not directly related. So what does that lead me to? That leads me to, if we're going to continue to use source rules, we should think exactly as Barbara, I think, was suggesting, what is the purpose? And what that purpose is, it's saying who has the taxing right. That's ultimately. Now, the last thing I'd say to pick up on Barbara, I do think we are in the midst of a global conversation about where those taxing rights are. We know that globally, because China and India are now a part of the global economy, that we are having to look at market countries, source countries, more than we did in the past, where we looked at where did the capital come from, which were the rich countries, which is us. So directionally, the one thing we know is over the next 10 years, beyond the end of my professional lifetime, is there's going to be much more source taxation because that's where the balance of power is in the world. It's just inevitable. And the question is, do we fight it and have double taxation and push all along, or do we guide it, preferably? Do we work cooperatively and try and put it in a direction that is in our best interest? I think those are the real questions that face us in 25 and 26, but they're all going to be covered in the guise of what should our tax rules be.
Yeah, so I had some similar thoughts, but first I'd like to congratulate Mindy on naming this panel, this exercise, as an incubator, ideas incubator, because in Silicon Valley, saying that your idea came out of an incubator puts about $1 billion on your valuation. Easy. So when I heard that this project was to rethink the statutory basis of source, I thought, well, this is really interesting, because can we come up with a set of unifying principles that would then give us guidance as to what the source rules ought to be for each of these categories? And like Barbara and Steve, I perceive that it's really challenging to do. You can articulate what the different principles are for some of the source rules, but it's really not possible to articulate a single principle that animates all of them. But I thought if there was going to be some overall revision, it might be useful to articulate what the different bases are. And there are several of them. The most commonly articulated basis is, well, that's where the economic activity takes place. If someone asks you, well, what's the basic US source rule? You frequently say that. And maybe that works for services, but it doesn't really work for too much else. Think of all of our source rules for things that tend towards the passive income. The economic activity of the lender is probably where the lender is accumulating the capital, not where the payor is located. But we certainly think it's entirely right to tax interest, dividends, royalties, rents at source. Interesting, we use that word source. There we're thinking of source as the payor, not the recipient. While on the services side, we think of the source as at the recipient level, not the payor. But even the example of interest is kind of interesting because even though it's internationally accepted and it's been in our law forever that we can exercise source-based taxation on interest, the Congress says, well, not really. We want portfolio interest to allow capital to come in out of the United States, and our treaty policy is to get rid of source-based taxation on the other side. So even that fundamental principle in practice we give up on a regular basis. Offshore capital gains, in principle, it's a resident-based thing, so we don't tax offshore companies on their capital gains unless it's the FERPTA gain. So there we kind of use our source rule as a declaration of right to tax, which I think is what Steve was getting to in terms of how you think about source rules. It's us drawing a circle around those income items that we think we, the United States, should be able to tax. I think that works pretty well, or at least mechanically, in fact, does work on the inbound context, since on the inbound context, we do tend to define what we're entitled to tax in terms of source. Still, anomalies, the difference between a lump sum payment for an intangible property versus a contingent payment. Lump sum taxed at the place of the residence, contingent taxed at the place of the user. It's the same asset. Why would there be a different source rule for those two things? That may be because we perhaps expect the foreign country to tax contingent payments, but maybe not tax gains. So there, maybe the source rule is designed to match what the expectation is on the foreign side, which is an interesting concept that we would mold our law to match what's going on the other side of the transaction. It makes sense when you think about the foreign tax credit, right? Because if the foreign country is going to tax it, then it does make sense for us to consider that to be foreign source. And then finally, one area that I think is a pretty powerful underlying principle but doesn't really show up in our law is, should our source rules be focusing on where the market is that the enterprise is addressing? Old 863B did the rough justice thing of, you make it here and sell it there. We'll divide the source part here, part there. And interestingly, the only change to the source rules in TCJA was to cut that off. Say, we're going to disregard the market. We're going to source that export transaction solely on the basis of where the production activity takes place. Does that make sense from an overall economic perspective? It certainly doesn't make sense from the perspective of where those businesses are looking to extract profits from, because those businesses surely are extracting profits from the foreign market. And ironically, at the same time that we're all adjusting our planning to deal with the truncated 863B, Treasury comes out with proposed regulations for digital delivery of software, saying if you're delivering to a foreign user, we're just going to deem that to be foreign source. Why is that? The justification is because it's a foreign user. So should there be a big difference between a manufactured product and a not physical product? No, our source rules today have those discontinuities. And then finally, a very interesting point that Steve made is, should we pay any attention to what's going on outside the United States? It's clearly the case that there's going to be more and more pressure for source-based taxation by other countries, i.e. taxation without physical presence in the country. Should we use our law to defend against that? I mean, that maybe is part of the thinking behind the foreign tax credit regulations. If we make it so painful for U.S. companies to take a foreign tax credit on foreign withholding taxes on services, will foreign countries stop doing it? I think the answer to that is no, no way. But as a matter of policy, is there an alternative? I do note that the poor DST came in for a bit of rough treatment yesterday, but I consider the DST to be a manifestation of source-based concepts. If you look at the very beginning of the DST, it came from a report by two French tax officials with similar names, Colin and Colin. And their theory was very much a physical presence theory. Their theory was that users of social networks in particular were, in essence, unpaid labor. And that unpaid labor in the country should be recognized with a taxation right in that country. Now, that theory didn't work as well when you went beyond social networks and advertising platforms and into other things like ride-hailing services. And so the concept of what justifies the DST expanded, but it's still based on the foreign enterprise doing business in my country. If you think back to the old UK law distinction between trading with the UK, which did not give rise to UK taxing rights, to trading in the UK, which does give rise to UK taxing rights, that's the concept of the DST, that you are trading in my country. You know, you have user engagement in my country. And that, to my mind, is a pretty traditional concept of source-based taxation. So I also think that DSTs are clearly income taxes because their goal is to tax the income of American companies, and I would be very interested if the U.S. Treasury were to try to say they're precluded by treaties on that basis. So that last point is, you know, the rest of the world is thinking more expansively about what is source-based taxation, and should we use our law to kind of match them, or should we use our law to try to oppose that trend if we think that it is a trend that should be opposed? I do also note that, you know, we're all part of the post-pandemic generation, so we came up with 3 very similar concepts on the source rule integrity today, and we did it by email, not by actually talking to each other, as is common in the post-pandemic panel organization process.
That is correct. And thank you for all of those very important and insightful big picture items. You know, my takeaways, should or can we go about changing the sourcing rules on our own? The need for global revenue, making sourcing even more important in, you know, the global economy. Also, does it make sense to have different sourcing rules in the inbound context versus the outbound context? Things to maybe keep in mind as we dig into the rules with respect and recommendations with respect to services, royalties, and gains from the sale of property a bit more. So starting with services, the sourcing of income earned by individuals or entities from personal services is generally based on the service provider's location when providing the services. Pursuant to regulations, income from services performed in the U.S. and partly outside of the U.S. are allocated between the two on the basis that most correctly reflects the proper source of the income under the facts and circumstances. And that's a quote from the regulations. And there's further guidance that emphasizes the relative time spent in the U.S. or outside of the U.S., but that's pretty much all we have. There is a de minimis exception that basically applies to, or what's known as the commercial traveler's exception, that allows income from services performed in the U.S. to be treated as foreign source income if certain conditions are met, including a monetary condition where the compensation cannot exceed $3,000. And that $3,000 threshold has not been indexed or increased for inflation. $3,000 in 1960 went a long way, and you know, the average salary for men in 1960 was $4,100. So you can see it's very close to the median wage. We won't go into the salary for women at that time. This isn't a presentation on the wage gap, and I thought this particular recommendation to maybe increase the compensation threshold and remove the requirement that compensation is for services performed for a foreign employer not engaged in a U.S. trade or business was a bit of low-hanging fruit, an easy way to just make sense of an exception that's in the code. And I do want to note, Steve expressed a little bit of caution with tinkering this particular exception. We do want to give it, some credibility, but also with increasing the compensation threshold, you do raise questions about compliance, something else to audit in the system, and it's not going to remove some of the burdens, Steve, you noted, like on the employer side and on the reporting side, by making this an exception that more, individuals are able to qualify for. Any further comments there on changes to the de minimis?
Just the commercial exception hasn't had any functional effect, but at the same time, it hasn't provoked auditing. And if we actually make it more relevant, then goodness, do we really want people looking at it? So can we let sleeping dogs lie? That's really the question.
Oh, Steve, can we do something about it? Could we eliminate?
Compliance is fine, because nobody complies.
We used to call that good enough for government work. And in reality, look, yes, the answer is yes in the real world. I couldn't say that if I were a member of the government. I can't say that as a lawyer. But the reality is life goes on.
But couldn't we do better? For example, could the commercial traveler rule be rewritten to be a compliance safe harbor? So there, I think the fact that it's focused on foreign employers, on employers that don't otherwise have a U.S. presence, I think that actually makes some sense, because if you have a U.S. presence in an employer situation, you may have the ability to comply. But could we eliminate the dollar threshold entirely and just focus on time? Is someone
treaties do,
well,
by the way.
but someone someone that is here more, that is here below the level of time, but makes more income, it seems to suggest that they have a greater, their value is in some greater way connected to some other location. Now one thing that would do, I think, would eliminate for the U.S. the ability to have the special rules, the artiste and sportsman rules in the treaties that say if you're a rock star and you come here for one day and make a huge amount, that's U.S. source. But it does feel like the purpose of it is, if the purpose of it is compliance, there ought to be a way to make it operate as a rational, compliance safe harbor for both the employee and the employer.
Yeah, it just doesn't make sense to have something in the code that is so impractical. So what's required is a definition of what we're meant to encourage or allow. And in the era where $4,100 was the average wage, that was intended to, and I'm sure did, facilitate an awful lot of commercial traveling in and out of the United States. And if that's what we want to encourage, then maybe we need to rethink some of the other parameters around it, but I think it's a valuable part of the code, just not as written today.
The other argument is that we have gone effectively without a commercial traveler exception for this whole time because it's been useless for the last 3 decades. So the other approach is take it out of the code, don't replace it, but say you're not going to look closely at it. Take Barbara's approach with it. That probably is the most intellectually honest one, but I just come back to my mother saying, no good deed goes unpunished.
Well, then we need to have tax inspectors at all the exits checking those Singaporean and Taiwanese travelers, make sure they file their tax return for a couple days.
Maybe.
All of these are really interesting thoughts, and hopefully we can do something, or perhaps nothing is what is agreed to continue. So turning back to the general rule, with respect to the sourcing of personal services income, I believe it's important to note that services, with the exception of transportation services, which have their own unique set of rules, were historically personal in the sense that they were directly performed by individuals. And in today's world, we know that a large share of service providers or just services in general are automated. everything from call center operations to how we go about shopping. I actually put in an Amazon order in the Uber on the way here, thinking about, wow, I'm gonna go discuss sourcing panel. What have I done from a sourcing perspective here? The paper considers the treatment of, and we're going to talk about automation, not only in this section, but also in the royalty section. We also considered in the paper the treatment of multi-jurisdictional personal services under existing case law. And I didn't prepare slides for this panel, not because I'm lazy, even though I might be. A lot of what we're going to refer to, the case law, they have been, principles that taxpayers and their advisors have relied upon for years and years. Paul and I did a DC bar panel a couple of years, maybe 2 years ago, where we actually outlined the facts and the holdings of these cases. Happy to share those with you. But we often cite to Pietas Negras Broadcasting, which addresses the location of services where the services are not strictly personal. And that particular case has been relied upon by taxpayers in many situations, but it doesn't provide definitive guidance on what factors are to be considered when services are a combination of human and mechanical activities that take place in 2 or more jurisdictions. So you have this combination of automation and personal services, and then you're dealing with multiple jurisdictions. A potential reform with respect to, this type of issue that arises with sourcing personal services is modifying the US tax rules where you have services performed in multiple countries by a combination of human and machine or IP to embrace concepts from the AOA. As Barbara noted, AOA was referred to in many panels yesterday. I know that there were comments not only from some of the commentators here, but others who, as part of this incubator, reviewed each other's papers saying, do we really want to bring in transfer pricing concepts into the sourcing rules and in other areas of the tax law? But we do have something that's well thought out that could potentially prove useful in a situation where you have services provided in multiple jurisdictions and by a combination of humans and machine. Pause for comments here. As Gary noted, we shared several emails over the past couple of days. So I know thoughts here, and I know you all have some strong thoughts on utilizing AOA. Maybe Gary, starting with you.
Yeah,
where it
sure.
makes sense and where it doesn't?
Yeah. So I thought the AOA proposal was a very interesting proposal, although I could see greater utility in some parts of the services allocation context than others, because there are several. The paper talked about, well, how do we divide how do we determine source when we've got humans performing services in 2 different jurisdictions? I actually think that the time spent rule works pretty well there because it's generally the same service, right? And if you have the same service, the same income is arising from the service, time spent, I think, works pretty well. But where the AOA might have a role to play, and if not the AOA, there's a real need for guidance here. This is, I think, a Treasury thing, not a congressional thing, is as noted, a lot of services these days aren't just personal services, but they're a combination of persons and equipment. In some cases, a lot of equipment and not many people. And in other cases, a lot of IP, both when it's just a personal service performed by humans and when it's an automated service that's delivered through a machine. Now those inputs, the human input and the machine input or the IP input, could be situated in different places. Back to Pietas Negras, which is a really interesting case. It was a pre-54 code case. So it didn't actually address our source rules in the way they're written today was essentially engaged in trade or business case. But that is a perfect example where a service is performed both by humans, because there were humans in the radio station, doing the broadcasting, the talk show, and equipment. There's a radio tower on the Mexican side of the border. So the court didn't really get into the question of whether you ought to be looking at the humans or the equipment or some combination of both. It was an easy case because they were both at the same place. But in the modern world, those things can be in different places. And how do you allocate the income between the equipment contribution, the IP contribution, and the person contribution? So there needs to be some guidance. The AOA is directionally appropriate for that, in that it tries to determine what the value contribution is of different parts of an enterprise, and source, in our context, source the income from that part of the contribution in the place where that is. It's probably easier applied where you've got a person equipment combination delivering the service than IP, since it's really hard to locate a place where IP exists. And there, again, no guidance on this, but I suspect the interesting question will be, if you're performing services that do utilize IP, shouldn't the IP return then essentially follow the people where they're performing their service, as opposed to being located somewhere else, which might be outside the jurisdiction where the people are actually doing the face-to-face interface? There is one other aspect of this that comes up a lot in practice, and that is when you look at a service enterprise, do you actually look at every single activity of that enterprise to source the income? Or do you only look to the, shall we say, client-facing activity? That's another way that would solve the problem. It's not an AOA type solution, because if you say that, say there's a service that does have a big IP and equipment component to it that's offshore somewhere, but if you say we ignore that, like maybe we ignore marketing activity and just allocate all the income to the revenue generating activity, then it all is going to flow to where the people are, as opposed to saying, no, marketing is not the provision of service, R&D is not the provision of service. Then we do need an AOA type something to divide the income between that which is client facing, producing the revenue that you have to source, and something that's not even considered.
So I'm hearing AOA in some circumstances, not all, could make sense, but also this look-through approach, whether or not we are forced to look through, might also impact the utility of AOA principles. Any other?
May I?
Yes.
Make one interjection, then I'll stop. I was not advocating look through to different legal entities, but maybe Barbara, Steve can comment, and then I can come back to that, because that was also raised in the paper in the context of sourcing cloud transactions, and we do need guidance there. And the big debate is, do you look through or not? And I do have very strong views on that, but I'll hold off for 2 seconds.
I don't know that we have to say that we're using transfer pricing or the AOA, but I don't see how we can't be looking to the underlying economics. There is some fundamental truth about where or how or by whom the value was added that is generating the income, and failure to focus on that for the different types of categories seems like it is a mistake, particularly when you've got categories of activities or categories of income for purposes of sourcing rules that are becoming so blurred. But the basis for the rules for each category starts from fundamentally different principles. So you don't have anything that answers the overlap or the gaps or the categories that aren't specifically addressed. In terms of the rules for services that look to place of performance, I guess I question whether that really needs to be revisited in an era of ever-expanding remote work. And particularly the fact that the ability to work remotely is disparate for different for different types of services. We all can provide tax advice, tax policy advice to a client without any need for any proximity, and sometimes they might prefer to have less proximity. But if we were heart surgeons, presumably we need to be within arm's length of our patient. Although I recognize, as I'm saying that
They could be
probably
providing direction.
probably is
Yeah.
not true in the future and may not even really be true today. So is really place of performance the right thing? Do we need to look at, things like how royalties are sourced and think about, where is should we be thinking about where whatever is being compensated, the skill, the expertise, the thing that is being compensated for in terms of the service, where does that spring from?
I can't improve on any of this.
Oh, okay. And I promise, Gary, I will get back to you when we touch on the sourcing of cloud computing transactions for sure.
You've got a quick.
Just a quick observation. I suspect half the people in the room here have worked on global dealing advanced pricing agreements. And I think they provide a foundation for analyzing a lot of these issues. It's gone on for 30 years. The US, the UK, Japan have generally shook hands on it. Now other countries are joining and shaking hands on it. And part of the beauty is that the taxpayer takes the first cut. There's a burden on the taxpayer to say who does what, where, and how. And in 1992, 3, 4, that was simple. Today, it's much less simple. But I just think the global dealing example out there shows sophisticated taxpayers with sophisticated advisors grappling with these issues and thankfully coming up with a solution that's pretty good.
Thank you.
But that's really an AOA type approach, right?
Well, it is,
Yeah.
but
It's not a mechanical dividing it up by account or something.
each bank's facts are different.
Right.
And so the burden is on the taxpayer to come forward with what my facts are, and then the foreign governments and the U.S. government say, well, but that sounds different from what I heard from this guy over here. And you have to explain.
Here, take a mic.
I mean, what it goes to is that services can involve risk and not just time. A lot of us bill by the hour, so we don't appreciate that. But I mean, the 482-9 reg talks about all the different ways services can be compensated, and our services source rules don't really recognize risk, right? Whereas the global dealing rules do. And the problem is the electivity, because with check the box, you can either go under the branch rules, which mean the non-risk related, or go under the transfer pricing rules and take risk into account, and that's taxpayer elective. And so you get all these folks making elections that minimize their U.S. tax, maybe have some income that falls in the ocean because of the way our rules work compared to everybody else. Whereas if we went with AOA, we'd at least be consistent with other countries, and there'd be less income that's falling in the ocean.
Yeah, I'm not sure much falls in the ocean when you've got 3 sophisticated governments looking
Fair
at
enough.
what you do.
But not all the services are between those three countries, or among those 3 countries.
Can you control these people?
I can't control them, but time can control us. And I know we have other topics to cover. Before moving to royalties, I just want to touch on one of the characterization. We focused on, or we referred to several characterization issues with personal services income in the paper. The distinguishing between personal services and the use of IP or license might be a good segue into the next section that we're going to discuss. We do have a recommendation with respect to this issue with how do you distinguish between the two. I know that Gary has some thoughts here, but we looked to the Garcia case. I'm not going to go into details there, but potentially recommend clarifying or codifying the approach set forth in Garcia with respect to an activity that involves both services and the use of provider's name, image, or likeness. and basically treat any payment as a royalty where the predominant benefit to the payor is based on the individual's name, image, or likeness, rather than disaggregating the payment between its license and service components. I know, Gary, you noted in our email exchange that Garcia is not a sourcing or even a characterization case, it's an allocation case, but just wanting to see if there are any thoughts there between, like with respect to this characterization issue, as we're going to turn into the royalty sourcing rules here.
Sure. So the first point is to observe that source is inextricably tied up with character. I mean, when you go through the paper, a lot of the discussion in the paper isn't a source rule discussion at all. It's a character discussion. And there are really hard lines to draw between a license and a service, rent versus service, rent versus sale of property. The -18 regs dealing with software and, in the future, content are all character divisions. Now, the source consequences follow, but the regs aren't really dealing with source, they're dealing with character. Now, in the Garcia and other golfer cases, I don't think that was either a source or a character case, because it was clear that the golfer was licensing his name and image and license for some purposes and agreed to perform services for other purposes. And the payment was just under one contract, one lump sum, and the taxpayer and eventually the tax court had to figure out how much was on this side and how much was on that side. Now, a predominant character rule, I think, would make life easier, because then you only have to pick 49 versus 51 as opposed to precisely, 38.7 and 62.3, right? But it really is an administrative convenience thing rather than a technical thing. I also observe that if the taxpayer is concerned about this, it's completely susceptible to self-help at the moment. You just have one contract for your name, image and likeness provision, and you get a payment for that, and a different contract for your walking around the golf course services provision, and you get paid for that. So it would be an administrative convenience, but it doesn't strike me as the same fundamentally challenging issue as a lot of the other character cases where the transaction really is a single transaction. You take the cloud regs, -19. Those are single transactions, and you can argue it's got elements of different characters within a single cloud services transaction, but there I do think the law needs to come up with a determination that the transaction as a whole is one character or another. And there I do think a predominant character rule would be an interpretive element that the Treasury ought to put in fact has put in the proposed regulations to classify cloud transactions. So I personally see Goosen as, a messy factual allocation issue, as different from the cloud regs, which is a unitary characterization question.
So going back to what Barbara said at the onset, thinking about the purpose behind these sourcing rules, I think is important too. And are we looking to them or providing rules to alleviate the administrative burden, or really trying to get to the purpose behind the rules? And Gary, you brought up the cloud computing regs, and before I turn to royalties, I did promise some more time on those. When we started writing this paper about a year ago, we thought maybe by time of this event, we would have some proposed regulations on the sourcing of cloud computing transactions. And we know that the hardworking attorneys at Treasury and the IRS are working on a lot of guidance, and this is not something that has come has made it out the door. But just to remind everyone that we do have proposed characterization rules with respect to cloud computing transactions, and in the proposed regulations, there is reference to the need for sourcing rules and how Treasury is considering them. We all agree that there is a strong need for sourcing rules with respect to the characterization of cloud computing transactions. And just from a characterization standpoint, these types of transactions are likely going to be characterized as services. Not going to go into the details here. But I do want to note that the paper recommends rules that would essentially apply an entity by entity approach with respect to sourcing these transactions instead of a look-through approach. So you would source the income based on the provider of the cloud computing services. And then also, I think this ties into some of the questions that we all grapple with. Advisors write a lot of opinions on the treatment of agents and how they factor in, or should they even factor in, might be something we should discuss here before turning to royalties in the sourcing of income. And so, Gary, I know you have thoughts on the sourcing of cloud computing transactions. And Steve, I want to make sure, because you also think the agency issue is something that should be clarified or addressed in either administrative guidance or maybe even the Internal Revenue Code.
Yeah. So to start on cloud sourcing, I think the paper does get it right. The debate is, let's assume a cloud enterprise that has 3 different legal entities involved in the provision of the service. One is doing development, the other is the data center that hosts the platform, and the third is customer facing, maybe it books the revenue, has customer support, all that sort of thing. If the 2 choices are, you kind of look through at the initial customer-facing level to all the inputs in the chain versus looking at each separate entity itself, I think it's clearly the right answer to look at each separate entity for the following reasons. Except for withholding tax, most of our interesting issues that are driven by source, such as foreign tax credit, Subpart F, are net income concepts. And I think we can rely on transfer pricing to make sure that each entity ends up with the right amount of net income. And each entity ought to be applying the source rules to its own particular items of income. So look at the customer-facing entity that's invoicing the cloud service. Its contributions are going to be the people-facing activity, the salespeople, et cetera, but it's going to pay a cost of service out to some other entity, and so its income is only going to be the net income arising from what it economically contributes. And I think it's entirely appropriate that income be sourced entirely by the people and assets that are employed in that entity. And then you can ripple that down the chain. Each entity has its own people and assets in whatever location they're in. They're going to get the right amount of income, either related or unrelated party payments, and they're going to source that income according to where their own people and assets are. So I think that system works just fine, and there's no conceptual reason to say, well, we're going to start at the customer revenue recognition level and look all the way back through the chain to see where lots of different contributions may be made. Not only is that conceptually inappropriate in my mind, it's just impossibly complex.
And so lastly, on the treatment of agents, there are issues, cases, even current cases that try to address the treatment of agents. And the paper recommends that services provided by a dependent or third party on behalf of the agent's principal are actually attributable to the principal when determining the source of the servicing or of the services. And also services provided by an independent agent or by its subcontractor not attributable to the principal unless the principal lacks a minimum level of substance and control over the contractor. And just clarifying these rules and the treatment of agents and the services sourcing construct, I think would not only help with the administrability of the rules, but provide guidance to taxpayers who might be inadvertently foot-faulting, just needing some guidance outside of the case law that we look to that don't always apply in the current economic environment. So that is something that is also recommended in the paper. In the interest of time, unless there's anything else about agents, maybe we can turn to royalties income, because as Gary noted in an email, strongly worded, he thinks the sourcing of royalties is the source rule most in need of clarification. And, you know, I don't know if that's just because of all of the royalty sourcing and the FTC regulations that have been talked about over the past couple of years, but just where we are and, you know, the current technological and global environment. And just to step back a bit, royalty income from the license of intangible property is generally sourced to the place where intangibles are used. And that seems like a relatively straightforward rule, except the place of use is hard to determine, extremely hard to determine. And so the paper recommends or tries to recommend a rule to simplify the place of use determination by clarifying use to mean actual use by the royalty payor without regard to any third country rights that may also be transferred and without regard to any sublicense not covered by the current anti-conduit regulations under 881-3, because we think that the conduit regulations, which taxpayers are familiar with, they do provide like a protectionary type of measure here. Unsure if that really simplifies the determination. Maybe anyone, I know Gary, you have strong feelings here. Place of use, what can we do with that determination in the royalty sourcing construct or context?
You want me to go, or Barbara, Steve, do you want to say something?
It's all yours.
All right. Okay, so first, I think what you're referring to there is solving the cascading royalty problem. So I think that would be a good thing. You know, it would be the United States giving up jurisdiction to tax foreign-to-foreign royalties, but my sense is we don't do that very often, and it certainly is a irritant in the code to have that exist, at least if you believe that SDI Netherlands kind of bent way over backwards to come to the result that it did, rather than relying on a strict statutory interpretation. So that would be a good thing. What my email was referring to is more the place of use analysis in normal contexts that really was brought to the fore in the foreign tax credit regulations, where we had to determine whether the IP was used only in one country. You know, maybe in the old days, our rulings on this start from way back in the 1960s. It was easier to determine where IP is used, but it's really hard these days. And even from the beginning, the rulings, we have ruling on copyright, 2 rulings on copyrights, a ruling on trademark. We've got a case, Sanchez, so it's a real case, on patent and know-how. And I don't think they're reconcilable. I think the only conceivable way that you could reconcile those cases is by dividing it into types of intangible properties. Say Sanchez says for patents, you source it according to wherever the manufacturing process was that was the patented process. For trademark and royalty, those rulings all source the royalty essentially in the country of consumption. Sanchez involved patents that were issued by protecting sales in other countries, but the Sanchez case just ignored that. So how can you reconcile the trademark and copyright rulings, which source in the place of consumption, with Sanchez that sources at the place of productive activity? There's nothing in the code that says we're going to source patents one way and copyrights and trademarks the other. So I'd like to see some thought given to that. It's also interesting that from the very beginning, that the law did not follow copyright law and trademark law very closely. The famous seminal ruling dealing with copyright dealt with a textbook publisher publishing the books, printing the books, copying the books, if you will, in the United States and selling into a foreign market. You know, there's zero doubt that that publisher was using a copyright in the United States, but the ruling says it's not U.S. source income, it's foreign source because the books were sold into that foreign jurisdiction. So there, the service says, we're going to ignore that IP use, and put all the source on this other IP use. Taking that concept and applying it in a world where there's lots of different little types of IP used at various types or various places along the supply chain is very challenging.
So the case law and the rulings that Gary's referring to are covered by the paper, and I'm glad we started with the big picture items because we're getting the hook. But we didn't get to touch on during this panel the rules or recommendations with respect to the sourcing of gains from inventory property. I recommend looking at those. Please reach out. I think Steve and Barbara also had some comments on the recommendations with respect to those sourcing rules. And once again, thank you to the commentators. I value all of your contributions to international tax policy and enjoyed working with you on this. So thank you.
Thank you so much, Nita, and the commentators. Sorry to be the one to cut you guys off, but this was great. We're going to take a 15-minute coffee break, and the next panel will be right after that. Thank you. start with the introductions. This panel is going to cover sections 1248 and 245 Cap A. Our presenter is going to be Eric Sessenbrenner, who's a partner at Skadden. Our commentators include Michael DeFranco, who's a principal at PwC, Tiana Dvornik, who's a partner at Wachtell, and finally Rachel Kleinberg, who's a partner at Silly. Eric, if you could kick us off, that would be great. Thank you.
Thank you, Aman. And I want to start just also by thanking Mindy and the steering committee for all of their assistance and help. It's been a great process for me, and I would be remiss if I didn't also give a great thanks to my former colleague, Caitlin Hurd, who's here, who was instrumental in developing the paper. If for those of you who've read the paper, we're addressing 1248 and 245 Cap A, largely in light of the 2017 reforms. And I think there's a number of questions that we're going to try to tee up here. I can assure you my panelists here will answer all of those questions definitively. But I think how you respond to those questions, how you think about some of the questions, in particular, the relationship between 1248 and 245 Cap A, may be influenced by your view on what type of a system we have. Do we have somewhat of a residual deferral system? Do we have a full inclusion system? Do we have territoriality? I want to just start by kind of laying the groundwork, and for some of the folks in the room, this may even be a trip down memory lane, but I was thinking of the guilty panel that we had yesterday and talking about, the original enactment of Subpart F. You go back to 1962, that was when 1248 came into the code as well. And that was, of course, the first instance where Congress was starting to peel back on deferral. But yet, clearly deferral was the default provision of US taxation. Subpart F was very narrow. And the idea of retaining some type of a neutrality between distributed earnings and retained earnings was an important goal of 1248. Of course, currency considerations, the fact that US-based multinationals had money offshore that was in non-US currency was also a significant consideration behind the original enactment of 1248. But the basic proposition that earnings that have not yet been taxed would be reflected to some degree in built-in gain at the shareholder level, to the extent that could be measured and tracked. That could be taxed in the same manner as those earnings were distributed. You could imagine them being distributed immediately before the sale. You'd want to have essential parity between those two paradigms. Putting distributed earnings on par, or retained earnings that are reflected in gain on par with distributed earnings was the goal. And for a large part of the history of 1248, you could have thought of that as being somewhat of an anti-abuse rule to try to prevent people from bailing out effectively previously untaxed earnings in the form of gain. But of course, you've got to consider 902, the foreign tax credit rules, and the fact that starting in 1986, we had rate conformity for corporations. And so at least for a lot of my career, 1248 in the corporate context has been viewed as really an affirmative planning tool. It was a benefit to be able to capture a dividend with all the associated consequences of that, leaving to some degree a residual application of 1248 in its most basic instance to individuals. But of course, in 2004, we had effectively rate conformity for individuals as well in the form of QDI. And so coming into the 2017 changes, I think there was largely, both in the corporate as well as in the individual sphere, a sense that 1248 was a planning tool, that it was a technique. It was more for the benefit of taxpayers than for the fisc. And that was still in the context of a largely deferral system, right? 2017 comes along and everything changes, of course. We've got massive amounts of PTAP in the system from 965 as well as from guilty inclusions. We have a very little residual untaxed earnings. And so there's a fair question. In fact, it's somewhat begged by the fact pattern as I laid that out. Do you even need 1248 anymore? What is the continued role? What is the purpose of 1248?
And I think, in part, as I said, how you answer that question is a function of how you think of 1248 relating to 245 Cap A, how you think of them interacting. There's obviously scope questions. There's differences in terms of the application. Like 902, 245 Cap A applies not just to CFCs, but also to 1050 companies. And so there are some distinctions there between the application of 1248 and 245 Cap A. But largely, there's a question of, circumstances where 245 Cap A does not apply. You've got hybrid dividends, you've got your QBI return, and as we learned on some of the earlier panels, even the QBI may be somewhat of a debatable proposition going forward. You've got US earnings, you've got disqualified amounts under 245 Cap A, and then finally individuals. But of course, they have QDI that gives them some degree of benefit on the distributed earnings or the deemed distributed earnings under 1248. One of the things that I think that it's also important to remember is you have 245 Cap A itself, and you could flip it on its head and say that 1248 is necessary in order to ensure that your 245 Cap A amounts aren't inadvertently taxed as gain, and there could be a basis for retention of 1248 on those grounds alone. So I think there's places where 245 Cap A doesn't apply. There's a principled notion of whatever extent you view distributed earnings and embedded gain, those really should, in principle, be treated the same, even if under current law there isn't a difference in terms of the rates or even the incidence of taxation. I would also note that the DRD itself, just by virtue of the structure of the system that we have, we've implemented essentially territoriality through a DRD. That is a system that naturally would lend itself to potential changes in the future. You could imagine an 85% DRD. I know that gets into a question of what you think our system really is, and I think that's at the heart of a lot of the questions that we're going to try to delve into here. So with that background, I think when you think about 1248, I think our paper suggests that there is at least a principled basis for retaining it. I think there's probably more than that, at least in my personal view, but there's a lot less for it to police. If you look at the current system, there's a lot of complexity involved. Largely that's regulatory, not legislative, but there's a lot of complexity involved in the strict tracing and tracking of earnings to be preserved for future taxation. I think there probably are a number of places where you could think about, a simplification. There's probably a number of places, and we talk about them in the paper, where there are some tweaks to really tailor, assuming you would retain 1248, to really tailor it to the narrower focus that it has today. And so that's kind of how I think about just level setting the overall role. In terms of regulatory streamlining, I think there's sort of tracing and tracking changes. I would invite my panelists, I don't know, Tiana, if you wanted to comment on that.
I'd be happy to, but one observation as you were talking there kind of hit me, and we didn't really talk about this before, but the questions about how relevant is 1248A, it's really kind of the same question, how relevant is 245 Cap A? Because at the end of the day, they kind of apply to the same set of things. And you don't really hear people talking about, well, do we need 245 Cap A? But I do think that they are inextricably related, and to Eric's point, the theoretical reasoning for 1248A, I think, still stands. And the reason we're having this conversation is not because that theory is wrong, but because since it's been enacted, everything else has changed, including mostly rates. But it is very interesting to sort of think about, and Eric touched on this as well, what the categories are where this is relevant, right? QBI is very small. Individuals, certainly, capital losses, that's a concern. But one other big area where 245 Cap A is relevant or doesn't apply is in the extraordinary disposition rules, which really aren't about 245 Cap A. They're really about guilty and subpart F. So it is a lot for maybe little, but that doesn't, I don't think, defeat the validity of the section. Which then brings me into but okay, do you continue the theoretical purity and the complexity that comes with the system, given that it does now touch a smaller set of issues. And one of the areas where one might think about simplification is in the area of tracking and tracing. So 1248, the regs that tell you how to, 1248 obviously tracks EMP associated with the shareholder stock during the shareholder's period of ownership. And that's kind of born out of the idea that, well, during the time that you control the corporation, this is your EMP. The incentive that we're trying to achieve here is to, make you indifferent as between distributing those earnings or not. And the regs under 1248 deal with that problem, and they deal with it in different ways. There are simple cases, which I imagine there aren't many of those because, they involve total continuity and consistency, right? Same shareholder, same shares, no other class of stock, number of shares never changes. And, that one's kind of pretty straightforward. But then you get into the complex cases, and that involves, a lot more computation. And so maybe one question is, would some simplifying conventions for the complex cases make sense to bring them more to the kind of simple cases, just to not spend too much time acknowledging that perhaps there's not a lot of there. And the other thing that, and Eric points this out in the paper, which I thought was very interesting, even though, the theory is sort of you track the earnings attributable to a particular shareholder, it might be an easier system if you just thought of dividends on a kind of 316 type model, and you didn't really bother with tracing, but you just went kind of with a simple pro rata approach. Now, you certainly get away from the theory, but you might gain in administrability.
And the question is whether you retain enough of the overall, consistent with the theoretical underpinnings to avoid some of the complexity that's probably unnecessary in a system today. What about the 5-year taint? I mean, that's a place where I think, again, 1248 is largely a benefit, and the 5-year taint is essentially a beneficial provision. You've got CFCs and former CFCs that it applies to. It is a place where there is at least some complexity in the system.
Yeah, and I mean, I think it's funny that we always call it a taint for the reasons you describe, which is it's a good thing in current day, and it was presumably an anti-abuse provision, right? And it doesn't line up with 245 Cap A. And it certainly makes it harder to track earnings if at any time in the 5 years, if you were a 10% holder, you're subject to 1248. And so I think it makes sense to align it with 245 Cap A and what 902 had done as well, which is to look at whether you're a 10% shareholder at the time of the transaction as opposed to some prior time.
Yeah, the question is really getting into that situation where you sell down, right? You're at 12% or you're at 15% and you sell down to 9%. Is there some rationale, and I think there is, I'm asking in a sort of loaded way, is there some rationale for the continued application in that fact pattern?
Clearly, to the extent it is still an anti-abuse rule, right, for individuals or otherwise, or to the extent it is a detriment to taxpayers, you might want to have an anti-abuse rule to govern against, somebody artificially fluctuating its share ownership, somebody else putting in money so that they go down below 10% right before a disposition or something along those lines. But just given what, again, what's at stake, having that 5-year taint is just unnecessarily complicating.
And it's another one of those questions, purity versus administrability. If you really wanted to be pure, I think you'd go back all the way, right?
And that's the system we have today in the regulatory space, right? Is one that really is trying to achieve purity. I think about in particular the 367B regulations and the complexity there of even hiving up shares into blocks to trace your 1248 amounts. It just seems to me there's a lot of that complexity that probably could in the current environment and given the current role of 1248 could be dispensed with. Application to partnerships is another place where there's at least been historically some, complexity in terms of, how 1248 applies. And I think that that's been somewhat moving over time, but that's another place where It seems to me that there's.
Yeah, I mean, I think we talked about the fact that, obviously for subpart F and guilty purposes, we've moved to aggregate treatment for domestic partnerships. And I think we all collectively felt like, I'm sure many in this room do, that aggregate treatment is appropriate for 1248 purposes as well.
It just made sense to have that consistency, right? 1248, subpart F, guilty, all of these things function together. And I think another example of that is, the voter value point, right? So subpart F and guilty obviously now work by voter value for purposes of determining if you're a U.S. shareholder. 1248 has its own version of that didn't get changed in 2017. So that's another area where it seems just like consistency would make sense.
Yep. And we would recommend making that change. That seems, I would say yet, hasn't been changed yet. So with that, I think we wanted to switch into more of a 245 Cap A discussion. But before we do that, any questions or comments from the audience on 1248? Everyone's in agreement. We should retain it, but simplify it. That's okay. Agreed. That needs to be more of an objective in our legislative process. So 245 Cap A, I think, you could think of it as, I think of it as replacing 902 in the sense of a territorial type system. Obviously, it operates differently. It's applicable to 10% specified foreign corporations, so it largely overlaps with what 902 was doing. I think there were a number of aspects of 245 Cap A that are interesting, like other participation exemption regimes around the world. There's a holding period requirement. We can debate what role that really serves, whether it's appropriate, whether it should be modified. There's questions around the scope of it, fundamentally. You've got it applicable to 1050 companies, but there's a time aspect as well in terms of when the earnings were generated. It applies to all earnings. It doesn't have to be generated on the shareholders' watch, unlike 1248. And so in that sense, I would at least suggest that it seems to be much more consistent in its current iteration with an exemption or a territorial type system of, we've made the call to not tax foreign earnings, at least at a certain level. There's still a residual, what you might think of as below 10% kind of portfolio dividends that would be taxed in the US, but largely all other foreign dividends are not taxed, except for specified categories where they're carved out and the DRD is called off in the case of those. But there's a number of aspects, I think, with respect to, the earnings that it's applicable to, the holding period, that tell you a lot about, I think, or at least how you feel about those. And we know about the BBBA proposed changes that are out there that would restrict the scope and more align it with guilty and subpart F that I think some would suggest is, a pretty fundamental change in terms of how it's functioning. And again, as I said at the outset, I think how you answer some of these questions is a function of what type of a system you think we have.
An exercise in discipline, Eric, for me to keep my mouth shut for the first half of the panel. But I'm not going to completely leave 1248 because I think we do need to continue to consider it as we're looking at 245. I think there's a couple things with 245A that you can consider if you're looking at what kinds of changes one can make to it. And I do think the mechanics of 245A could be changed to pick up the remaining aspects that we say 1248 needs to be around for. We'll put individuals aside because that's a different panel, but that's its own beast, and maybe we need 1248 for that. As much as it pains me to say, getting rid of something that I've spent a lot of time and a lot of effort in really trying to understand and master, it might not have a place if we made 245A a provision that would cover gains. That's a small piece, right? Now, in 2011, Camp tried to cover gains and maybe take on the possibility of losses and exempting, right? So full kind of traditional participation exemption system was not well received. Camp 2.0 got rid of that component in 2014. I think if we go back to it today, though, and we don't talk about disallowing losses or exempting income, but we talk about just picking up the recharacterization of 1248 that happens as a dividend. So it'd be that it is exempt to the extent of, now here's the big question, do I include pre-acquisition earnings or just post-acquisition earnings? So I think there's a lot of things that go into the questions here. First of all, I think you could get rid of, talk about simplification. I love simplification, and I do recognize, but I think it should be considered getting rid of the 1-year holding period in 245A and getting rid of the 5-year taint and just saying that it's post-acquisition E&P. Now, I've only thought about this for hours. This is a kind of question that deserves weeks, months of study to really get to the right answer. But the theory would be that if you're acquiring a CFC, you've got the basis to cover the pre-acquisition E&P. If you don't have the holding period and you say, well, it could be manipulated, that's why the 1-year rule was there, or you needed to have meaningful ownership to be a participation exemption. So what? I own it for 5 days. I'm only covering 5 days of earnings with the participation exemption. I think that's sort of fair. It does simplify things. And so there is an argument to look back at maybe not being as complete as what Camp was trying to do. And there's reasons Camp was really complicated. We had low tax earnings around the globe. We don't have that with Pillar 2. So you don't have to worry about policing super low tax earnings.
And that was the concern, I
Yeah.
take it, with Camp in 2011,
That's
was that you could have very low taxed earnings and then you get this benefit.
Yeah.
That was
Yeah. So in many ways, the world's simpler, so why not make our rules simpler? And if we do that, you could look at 245A and say, we'll just pick up that mechanic that's happening in 1248. You don't have to go to those rules. We don't have to ignore them. And maybe we simplify them and bring them into 245A and just cover it.
I mean, you probably know better than I do, but is it really simplifying to have to figure out 5 days
simple.
worth of
Nothing's
post-acquisition
simple. No.
E&P?
No, and what I'm also would love, is to take 338 and make it more accessible and knock down some of the QSP things. And hey, it sounds like partnerships, right? It's 754 elections, but it's not easy. Nothing's easy in tax, as we know. But I'm looking
It's
for
more theoretically pure.
Yeah, but I always believe theory should yield for administrability, so I get that.
Mike, one question on the pre-acquisition earnings. You're just talking about the gain, the 1248 aspect of it, right? You're not talking about for distributions, because it seems to me, if you're not taking into account pre-acquisition earnings on actual dividends, that's a fundamental change to the system.
Yeah. I thought he was.
It is the fundamental change to the system, and one that was actually approached a little bit by Build Back Better. If you went to post-acquisition earnings only, that would be farther than Build Back Better went. But if you knocked, you could look at, we've got to have PTI rules that are out there and actually working. I mean, we're still waiting on those rules, right? But if you've got basis that covers it, I guess the theory would be you don't need it because that gain should have been captured or should have been captured in the basis that you have, and that's all those pre-acquisition earnings. I get it. There's a lot of people who thought about this very carefully in 2017. And so I'm not suggesting that's necessarily the answer, but there's an argument for it that simplify it to just post-acquisition earnings. It is really hard in a real world to figure out the earnings of a Romanian company that's been in existence for 30 years. The other thing is quite often we have a 338 election, so we've already done it, right? And if I'm advocating let's loosen up the 338 eligibility, then I'm kind of pushing us toward that anyway. Mindy. We can hear you.
Your proposal, does that eliminate the need?
Oh, I'm not proposing anything. Let's be clear. I'm just talking, Mindy.
This idea, this notion, does that address or make go away the problem the government was trying to solve for in the 245 Cap 8-5 regs?
Kind of, yeah. I kind of look at all that mess and all of those. A lot of the policing in the 245 is about transition. And once we're out of transition, I just don't get, I mean, you at the point of, much of this is about sub-F, guilty, the gap. There's way more complexity in those rules today than really needs to be on a go-forward basis. Yeah, that might, but I'd have to think, look, I mean, I've had
Although there's other
hours.
ways to solve it,
Yeah.
right? I would just note, Kim yesterday made a very helpful suggestion on changes, legislative changes to 951. I think that that's also a place where you could address a lot of what's now handled in the 245 Cap A-5 regs.
Yeah.
So I had a question. I want to go a different direction, just to hear your thoughts on the panel. Putting individuals aside where PTI makes sense, why wouldn't the world be simpler if after there's a sub-F inclusion or a guilty inclusion, we don't give any credit for PTI to a domestic corporation, and those earnings are eligible for 245 Cap A? It seems to me that the combination of 1248 and 245 is stepping on the toe. We've got two regimes trying to prevent double taxation of those earnings. And they're stepping on each other's toes in terms of the complexity. So my question is, once you've done the anti-deferral rule, if the shareholder is a U.S. shareholder that's entitled to 245 Cap A, why keep track of PTI at that point? For the U.S. shareholder, I mean, for the domestic corporation eligible for 245 Cap A, so that we have one regime for corporations, pathway to ensure no double tax, but for individuals, it makes sense to have PTI.
In other words, I just want to be clear, what you're suggesting is replacing 245 Cap A with essentially a deemed PTAP regime, so that it all just becomes PTAP, so.
DRD in place of basis.
Right?
It's just DRD in place
Every
of basis.
dividends are excluded effectively, right?
Yeah.
I think that's a really good point.
Either way, we're caught in the middle, though. I think you could go either way.
Yeah.
If you had a basis adjustment and just deemed it to be PTAP, that would exempt it as well, right?
But then we get into, well, what character is that PTAP? which one of the 9 different types of PTAP do you have? And is that worth all the candles for that?
There's a lot one can say about what happened with the proposed PTI regs that were around when I was in government and why they're no longer around. But we've got to figure that out. But it's interesting. You're just saying replace a DRD for basis, right? For them. So, you don't.
1248 made sense in the world it existed, but in a world where you get dividend exemption, just any subpart F or guilty is part of the ethane eligible for 245 Cap A under 1248.
Well, make sure you're covering gains, though, too.
Well, exactly.
I agree.
And that goes back to the question, what is our system? And a system that might make sense or at least kind of hang together would be a system where we say, okay, no more deferral. We're going to tax most of this income at whatever rate we want, and then we're going to decide what income we're not going to tax, and then you just don't tax it. Yeah. Gains, dividends, doesn't matter.
But what about gains on the sale of the stock? Built-in appreciation. You've been talking about earnings, but what happens if there's appreciation in the assets of the
So more than the
company.
earnings is what you're suggesting. So I've got
I'm
IP.
not suggesting. I'm just asking the question of what the suggested
You've got,
approach
that's what
might be.
1248 does. You've got gain, and it recharacterizes gain as ordinary income or distribution dividend.
extent of EMP.
To the extent
I think
of
Eric's suggesting
EMP.
like economic gain, not gain that's
Beyond
sort of
that.
just reflective of earnings.
Appreciation of INP would be the.
Ron had a question?
Yeah, just to bring things together, I mean, there's a 959 and a 961 regime, and that's fine. And oh, by the way, we're also capturing and kind of isolating the FX side, which we can have different debates on the merits of that, but it's sort of necessary. I mean, I get another way to do it holistically would be through a 245A, 1248 approach, and everything goes over there, but FX kind of falls out the window, or at least you need some wacky tracing rule to track your earnings that are attributable to inclusions versus exemption, and that's not awesome. So the symmetry kind of makes some sense to me, and I'd be happy to get rid of the FX part. But I think that's the path to it.
By FX, you're talking about the rule
Yeah.
and that's got to getting rid of that's got to be a revenue raiser because people time their
I
transactions.
was going to say.
today.
To recognize losses and not gains. The other thing is the 960 credit on PTI. You'd have to get rid of that, right? Because you wouldn't be tracing it anymore.
Yeah.
But you could just drop that into a pool, you know, and so it may actually raise revenue to switch to what we're talking about here with 245 Cap A and 1248 handling instead of all the PTI.
Well, let's be clear, we're not all here to raise revenue, though. We're
I
here to get it
understand,
right.
but my point is that for the folks who
I
are concerned
hear
about
you.
these things being pro-taxpayer, they're not necessarily pro-taxpayer. They really
right.
are just
You're
trying
right.
to simplify.
You're right. Yes, Steve, I know.
So let's say that maybe you're expanding 245 Cap A, you're at least retaining it. I think there's a number of points, there are a number of points that we addressed in the paper, obviously. Technical points, CFC to CFC distributions, hybrid dividends, other places where there's, I think arguably some complexity. I don't know, Tiana, the hybrid dividends is a place where I think when I read the regs, I'm surprised at the level, to be honest, of complexity. And I just have to imagine that there have to be easier ways to deal with the underlying policy considerations. I mean, the fact that something's deductible, surely you could have just a shareholder type account. You could treat it like 245 Cap A-5. Not that that is something I would look to necessarily as a model to base other regimes on, but just treating it as disqualified EMP that kind of sits there. You get into questions around what the ordering is and how it stacks, but that seems to me that that would have to be a simpler regime, or at least a more straightforward regime.
And maybe you're just looking for a reason to keep the PTAT regs.
U.S. source income is a place where I think we've talked about that, Rachel. Obviously, 245 Cap A-5 doesn't apply to the U.S. source portion. There are some technical issues, but there's also questions as how you coordinate it with other DRDs that would be available.
Yeah, if you've got U.S. source and foreign source income, and you've got the 245 Cap A DRD at 100%, at least currently, and 243s at 65%, and how do you allocate? And in my mind, that's a situation where you're trying to figure out between simplicity and getting to the right answer, right? This may be a situation where tracking does make sense, but is more complex as opposed to having some convention for how that U.S. source and foreign source income is dividended. But I don't know. I mean, there is both. I mean, money is fungible, and also there's taxpayer electivity associated with that. So I don't know what other people on the panel think.
Well, I remember Ty Grinberg probably in 2008 telling me that we would not have to worry about foreign tax credits at some point anymore. And obviously we do more now, it seems, than ever. And so the sourcing
panels yesterday.
the sourcing is still really important and critical to so much. And much of the individual panel that's going to pick some of this up, it's sort of relevant when we get to 1248 stuff and how these things play out. So they are relevant, and it is a very important part of what happens in here.
You can see the U.S. source earnings, though, taken to a kind of very extreme example. Yeah. It just really wouldn't make, let's say you had a foreign corporation that just engages in a U.S. trade or business. 100% wouldn't make sense in that scenario.
Well, why is that? Why actually is that problematic? I mean, those earnings are all taxed in the U.S., right? Presumably those are all ECI earnings that are taxed, or they're dividends from a corporation that's directly taxed in the U.S. Yeah, why is that?
But you would
exactly
want it to be consistent with a 10% U.S. holder, right? Like if you have a domestic corporation, you often have a 65% DRD. So I would think you'd want to conform it to the rules for a domestic corporation.
I just think about circumstances in particular, maybe I'm hung up on pre-acquisition earnings, but circumstances where those are earnings that have been taxed, they've been taxed in the US, they're sort of, in a foreign company, and that the fact that they come out later are treated differently, that's not always been intuitive to me that should be treated differently, I guess. That's all. You get into other weird anomalies, one of which we had addressed in the paper of sort of interaction of 316, and this has to do with the US source portion, how it's defined. I think this is just a glitch personally, but the US source portion is defined by reference to accumulated EMP. So in the case of a nimble dividend, you have something that is regarded as a dividend under 316, but yet definitionally 0% of it would be foreign source portion that would be eligible for 245 cap. Say you had a deficit the year before.
Which can't be what was intended,
Yeah,
by the way.
Can't be right.
Yeah.
I guess there's a question of whether it makes more sense to have 245 cap A apply to a nimble dividend or to get rid of nimble dividends.
Yeah.
Yeah.
Which also to the latter point, the 65% in the U.S. source portion, I think my issue with it is the 65% never made any sense to me. Like, why
Correct.
is it, right?
I mean, that may not make sense as domestic.
Exactly.
Rule. Exactly. But at least it should be consistent.
Yeah.
Ron?
On the nimble dividend point, I think the House bill actually had an express nimble dividend rule that they took out, and it didn't really look like the conference agreement replaced it. It's very troubling.
It's weird.
And troubling is exactly right. I would just say as a practitioner, that very fact is what gives me a lot of nervousness. You might be tempted to say, well, that's just oversight. That couldn't be what they meant. You could apply some interpretive gloss. I think that legislative history completely, strips you of being able to do that.
And it comes up in unfortunate situations too, because at least if you're trying to make a distribution, maybe you can control it to some extent, right? Because you can control the timing of the distribution. But this comes up today, weirdly, in 956, which with distressed companies that can't, credit, like, say you're right before bankruptcy, creditors want a more secure package, and it's a difficult negotiation because they're like, hey, we have 245 cap A, right? 956 isn't a thing anymore, except for it becomes a thing, especially with current loss companies that have accumulated EMP but might have current, which will in the future, which will then trigger a 956 pickup. So.
Yep. The final topic that we wanted to just address, and Mike, you alluded to this when you were talking earlier. The BBBA proposed certain changes to 245 cap A, namely restricting it to CFCs. I think it consistent with the idea that you get the benefit of this to the extent everything has kind of been washed through a world where you've got it being potentially subject to GILTI and Subpart F. I think as a practical matter, that really restricts 245 cap A to your QBI return. But how you think about that in the interaction of 1248 and what would you do to coordinate them? It seems to me there's something obviously we address in the paper, but there's a number of issues I think that come out of that are worth at least thinking about.
So, I mean, I think, and I just got my memory on BBA, but there was a change, 1248, which was just the technical correction that was proposed earlier. Then the 245A changes were the 1050 elect and then 1059. But I think if we're looking at it in the context of 2012 or some other big rethink, there's so much has changed since 2017, and so much has actually changed since Build Back Better. I mean, when you look at where we are with Pillar 2, I mean, the whole low tax consideration is almost off the table. It's got to be almost off the table. And then you've got GILTI, and what is GILTI doing? And, and so there's a free hand to, I think, carefully think about simplifying this whole area and making it work more consistently. Because right now, it feels like 1248 is something that's out there, very important because it still gets at that little bit of income. But if it wasn't there, it'd be a horrible answer. So how do we make sure they all work together? And if they're going to continue separately, how are they made to work together and sort of seem like they are working toward the same purpose and not a 5-year rule and a 1-year rule and all the other differences that are out there about ownership thresholds and such. I don't know about the others, but BBA does seem like that was a long time ago, so I guess you can even be looking forward and use that as a proxy for looking ahead.
With that, additional comments?
BBA did away with 245 cap A for 1050 companies, right?
You could elect
it. You could elect.
Yeah, but the election went.
Yeah.
You had to have the potential CFC had to agree, and
Yeah.
all the shareholders had to agree. And given that individuals would be disadvantaged by the CFC treatment, you would probably advise the company not to agree, right? So and they didn't resurrect 902.
No.
So what that meant was 1050 companies were treated like portfolio investments and were double taxed. Is that really fair?
No.
We did suggest in the paper, I hate to even bring it up because it's mind-numbingly complicated at this point, but we did suggest one approach would be to retain 902 just in that circumstance, which I think makes no sense whatsoever. It's an option, right?
Or you could potentially,
Yeah.
I mean, you could potentially have a shareholder level election on CFC instead of it being an election for everybody.
So that then the company, you need to have the company elect so that
To be able to report.
the information, right? They'll do a 50%.
Exactly, the company and any shareholder.
But we would all advise the company not to make that election if all the shareholders, if it had to apply to all shareholders, right? Because individuals who may well be the 10% investors are going to be hurt by that. So why would you discourage them from buying your stock? And it was a forever thing, right? You couldn't change it from
forever.
year to year. So you really need to have, if you're going to do that system, which kind of makes sense because then 1248 applies and GILTI applies to the 1050 shareholder, you got to make it very flexible for people to get into it.
With that, I think we're at the half-hour mark. Thank you. Thank you.
the morning. This panel is going to focus on Section 367. Our presenter today is going to be Joshua Rowland, and our commentators are going to be Devon Bordeaux, partner at Weil, Nicholas Denovio at Latham, and then finally Brian Jan, who's a partner at McDermott. Joshua, I'm going to give it to you to kick us off.
Thank you. As noted, the topic of this panel was 367. Is this working? Can you guys hear me okay? Yeah, working. Go ahead. Okay. So 367 was enacted as a bit of an overlay to the domestic non-recognition provisions in the code. There was an acknowledgement that the cross-border transactions had some additional considerations that were not present in the context of purely domestic transactions. And as a result, those non-recognition provisions apply only if a series of conditions that depends on the type of transaction under 367 is met. So today, 367 is a mix of both operative rules as well as broad grants of regulatory authority depending on the type of transaction that is going on. And so do we have the slides? Or my reference to the table is not going to land if we don't have. Next one. Yep. All right. So this is a very, very high-level look. So as the table indicates, we've got 367A, which has some statutory rules as well as a kind of robust set of regulations. 367D, which likewise has statutory rules as well as some regulations. And 367B and E, which primarily are just broad grants of regulatory authority and some legislative history. So just at a very, very high level. In the case of 367A transactions, they generally apply to outbound transfers of property to foreign corporations. So for example, when shareholders of a domestic public company exchange their shares for shares in a foreign public company in a Section 354 exchange, pursuant to a reverse triangular merger, or in a Section 351 exchange in a double dummy or similar transaction. There are two notable exceptions in the regulations and in the statute. The statute has an exception on its face for outbound transfers of foreign stock, and then as well as a grant of regulatory authority. The regulations contain an exception for outbound transfers of domestic stock. The regulatory exception for domestic stock has more conditions and generally is more challenging to meet. Both of these exceptions, I would note, we'll come back to this, require 5% shareholders to enter into gain recognition agreements. So one thing I want to note on 367A and 367 generally is that one of the considerations that applied for these non-US cross-border transactions was ensuring that gain that arose in the US was subject to tax in the US. There's a second consideration that we'll talk about in a few minutes, but one of the primary things was just ensuring this level of gain recognition. And so 367A accomplishes this in two ways. One, it can result in immediate gain, or it can ensure that gain is recognized on a deferred basis pursuant to this gain recognition agreement. The last thing I'll note, because we'll come back to it later, is that before the TCJA, the statute also included an exception for the outbound transfer of active trader business assets that were going to be used by the foreign corporation outside the United States. The second provision, 367D, provides a rule for intangible property. So it's effectively an exception to the 367A rules. And it says instead of kind of immediate gain recognition, instead of these other exceptions that might apply, the treatment is that the transferor is treated as having sold the property for a series of contingent payments. Now, one reason for this is likely that intangible property is hard to value, and so the fact that it was challenging to value intangible property means that these payments were being made over time, and those payments were commensurate with the income of the property itself, rather than having to go through a difficult and potentially controversial exercise of valuing the intangible property. So we have, again, two kind of limited exceptions. One is just an acceleration of gain if you have a subsequent disposition of the property or the stock. And then there are some proposed regulations that would create an exception for repatriation of property. The one other thing I wanted to note here is that the statutory regime, as modified by the regulations, is a bit of a hybrid. It is in part a contingent sale. It is in part a royalty, a deemed license of the property. And there are both statutory and regulatory provisions that apply license treatment in some circumstances or for some purposes. But then third, it is still nonetheless a corporate non-recognition exchange. And so there are many questions that arise as to which of those three buckets you're in for which purpose. As I noted, 367B and E are mostly regulatory grants, and there are robust packages of regulations. Just kind of in the interest of time, we're probably not going to talk about those today, and we're going to focus on a couple of potential legislative changes to A and to D. Okay. So, as I kind of mentioned before, 367A generally serves two broad purposes. The first one is the capture of a gain that arose in the U.S. And the second one is, and this is, I would say, more regulatory, it serves as a deterrent to what are called inversion transactions, whereby, classically, a foreign small co would acquire all of the shares of a foreign big co. So I think we'll talk about this, and I think Devin and Nick have a number of comments on this point. But there is another rule that accomplishes, kind of this anti-inversion objective more targetedly and probably more effectively, and that is Section 7874. So there's a couple reasons that we've observed in our practice over the years that inversions have effectively tailed off significantly over the last several years. First, in the kind of mid-2010s, the Obama administration issued a bunch of regulations that both made inversions more challenging and made any benefits of inversions, base erosion, or ways of taking earnings out of the U.S. tax net, made that more challenging. And as a result, that resulted in a reduction in inversions. The TCJA in 2017 likewise affected a substantial reduction in inversions, both through a combination of anti-base erosion measures, 163J, the base erosion and anti-abuse tax, the BEAT, as well as through a corporate rate reduction. And then third, global developments have also triggered a reduction in inversions, starting with anti-hybrid and earnings stripping rules in Europe, and now moving on all the way to kind of Pillar 2 and some of these other things. The rates between the US and foreign countries and the ability to base erode those two jurisdictions has shrunk considerably. They're much more similar. So for those reasons, 7874 and these other provisions have reduced inversions. And so the question is, to what extent should 367A police or deter inversion transactions? Considering that the kind of original purpose of 367 was to maintain the ability to tax gains arising in the US. So the two alternatives we have here on the screen are, number one, domestic stock could be treated for 367 purposes in the same manner as foreign stock. So the first consideration is that foreign stock, of course, is nonetheless subject to gain recognition through gain recognition agreements and through other considerations. Subjecting domestic stock to that treatment likewise would maintain the ability to tax that gain, but would sort of simplify and streamline some of these complicated regulations. Alternative number two, and then I'm going to turn it over to Nick and Devin, who probably think I've been speaking way too long already, is to kind of conform the treatment of 367 to 7874. 7874 has a different test. Primarily, 367A has a three-part test plus the GRA requirement I mentioned. That doesn't overlap completely with 7874, which, in addition to having a different test from a percentage ownership perspective, has different ways of measuring and has a substantial business activities exception. With all that as intro,
Well, let's take first off, the paper that Jose and Josh is a great read. Everyone should read it. It's really fantastically done, and congratulate you for doing that. If I take a step back, Nick, and I look at, before we get to alternatives, right, we've got two systems. We've got 367 that's policing shareholders in this context. And we have 7874 that in large measure is policing the company in an inversion. Well, why didn't 367 work, right? If you have taxation upon an inversion, why doesn't that just deter inversions? Why didn't we just need 367? Why did 7874 come along? To me, it was a lot about the public and how the public trades and the like. In our securities, we have a lot of day traders. They've already marked the market. We have a lot of tax indifferent parties. That could be hedge funds that aren't particularly measured against their post-tax returns or on a pre-tax return, could be foreigners. There are a number of reasons why 367 policing shareholders was not particularly effective. It's effective in some, as we talked about, right? It's effective in certain places. Concentrated share ownership, heavy publicly traded private equity, and then in the private sector. But largely 367 was not viewed as a significant enough deterrent from taking US companies and moving them under a foreign co. I think that we can fairly say that. So now we have 7874 that has come in, has a different set of percentages, a different set of calculations. Look, it's great for this panel, right? Honestly, we all do this for a living, and we make pains to explain to boards of directors, this is the 50 and this is 60 and this is 6 of one and half dozen of the other. At the end of the day, for me, starting with alternative 2, there is a certain attractiveness to at least coordinating between 367 and 7874 if you believe that shareholder deterrent still has some place. And one thing I would cite is actually a TCJA change, which is the inability to get qualified dividend income on dividends of foreign companies that are formerly 60% inverted companies. I think that was very powerful. And at least in prep, I don't want to speak for Nick, we see a lot of deterrence of doing a 60% inversion because of the lack of qualified dividend income in the reduction of investor base that would otherwise invest in that company. So that to me says, okay, well, that's doing some part, but it's not necessarily the answer that shareholders per se taxation. That's a bit of a capital markets access rather than existing shareholders. So to me, there's a certain attractiveness, Nick, to alternative 2, at least as a beginning part of coordinating the two provisions.
I think that was the New York State Bar recommendation several years ago to harmonize these rules, and I think it was a good one. By the way, I don't think you spoke too long. I think you did an exceptional job in taking maybe 18 years or more of international tax policy and distilling it down into about 12 minutes. But agree completely with what was said. I think the point that you made in particular about TCJA was a carrot and a stick, right? Level the playing field with the reduced corporate tax on the one hand, but then enact the base erosion tax on the other hand to limit the base erosion, which had already been significantly limited with things like the 385 regs on debt push down, et cetera. So I agree. I don't think 367A accomplishes the anti-inversion objectives. 7874 does that. I think the 50, 60, 80% test just makes it extremely difficult and cumbersome to explain these rules to even a very tax-savvy CFO and general counsel. When you have, let's say, a foreign company acquiring a US company, and the US company's shareholders are going to get, pick a number, 34% of the combined company. And one of my corporate partners will say to me, inversion. I thought they're not doing those anymore. And I said, well, TCJA reduced the incentive to do it. But you have to understand, all of the rules that were enacted over the last decade are still there. number one. And number two, it got harsher, if anything, under TCJA for the qualified dividend, the BEAT issue. And, we're nearing the tail end, but you also have the recapture of the 965 tax. I have, and I learned this several years ago, I will not get on the phone and try to explain these rules without a slide in front of a CFO or a general counsel. Because they'll say, we're at 34%. Why do we have to worry about this? And I said, you have to understand, we have a series of rules that are designed only to inflate the numerator and reduce the denominator. And the rules are the rules. I'm not here to criticize them or question them. They are what they are. They grew up for different reasons. But really to try to explain these rules to, as I said, even a tax-savvy business person or in-house counsel is important. So harmonization, I think, is the right thing. And, you touched on all the other important.
And I don't think we're suggesting that 7874 is a perfect statutory and regulatory regime. It has a number which you can read, both Nick and I have commented on over the years, that there are a number of issues with 7874. That being said, it quarantines, it's executing the policy, and then we can focus our collective efforts on making 7874 rationalized and effective. I think alternative 2 is the least controversial up there, right? Alternative 1 is in some sense, you're abandoning shareholder level anti-inversion policy altogether and just relying on the 7874. Look, I think there's some real arguments in the public context particularly. It's more compelling with a diverse public group of shareholders who are making decisions of allocation of capital on public markets to go with alternative 1. It may not be as effective or have as much intellectual purity if you're looking at private companies, but put this focus on public. That also may have some benefit, some benefit to it. Import over gain recognition agreements from the 367 into 7874, such that if there was something that did occur, that would be certainly. Something you could address. One last thing that Nick, you and I talked about in prep for this. It's really worth saying this out loud. When we're talking about anti-inversion policy, it has been on all fronts. It's not just 367. It's not just 7874. It's not base erosion. There are a number of things. For example, out from under, right? So how do I rationalize my newly inverted company by taking assets out of the U.S. taxing system and placing them under my new parent? That has become increasingly more challenging. You said it best, which I'm going to steal your line, which is the playbook no longer exists, right? There used to be an idea of how you would do that, much more challenging, which again just shows the backstop to anti-inversion, right? That's where the value went parabolic in times of old, where that just doesn't exist in the modern deal environment.
Last point on 367A-3C, foreign parent acquiring a U.S. target. All the planning is around the 60% test under 7874. But if you're hovering around the 50% test, it adds an element of uncertainty to the public filings, to the securities filings. Is it going to be taxable to the shareholders? Well, we don't know. The numbers can move between signing and closing. Typically, they don't move that much, but if you're hovering, then they could move enough so that what you're telling the public shareholders, taxable versus tax-free, may not turn out to be accurate, and you may have to update it. You may have to plan to update it. And then you say, well, why don't you just break reorganization treatment altogether, take 367 off the table, use a chain of companies, great-grandparent stock, and you run smack into Section 304, which we're not here to talk about. That would be another code section that it would be nice to fix at some point. But with that, I'll pause.
Yeah, but on that point, one last thing, else we'll take up the whole panel. Brian won't have anything to add. When I look at that, there's even in the deal market, you can see ways of dealing with 367 where you're hovering around 50 and it says, look, you will either progress with the deal if 367A does not apply, or we'll go to this other structure, and maybe it's an up-C, maybe it's taxable, but there's plenty of examples where there's a pivot into another structure to mitigate that 367 tax, just to deal with it. And in many ways, that's not great for the entire economic system, right? You don't have a structure until you're coming into close. There's disclosure around it. Our corporate partners end up hating us even more than they already do, right? Because you say, hey, well, if it goes this way, it's door A. If not, it's door B. And it just is making things very messy in terms of execution.
Maybe just, I hope to synthesize some of the points you just made. In addition to keeping Devin popular with his corporate partners, I think one of the broader points was, right now, 367 applies a deterrent effect in an arbitrary, maybe capricious, I don't know, but an arbitrary manner, whereas it taxes certain populations of shareholders with respect to certain companies. Founders, as you mentioned, a few maybe widely held shareholder-owned companies, employee-owned companies, things like that. Whereas 7874 applies universally to the corporation itself and all of its shareholders. And that is a much more effective deterrent effect and probably can be targeted more.
One last point, this is a deal point, which is 7874 affects the entire ecosystem of economics of a deal. That is to say, both the U.S. company and the foreign company and their collective shareholders all will bear the burden of 7874. 367, as you just said, and I'm stealing your point, it's great, which is it's only affecting this small group of shareholders and creating an economic deterrent on them rather than looking at the whole ecosystem. Mindy?
So from a policy perspective, let's assume you're correct that why still have 367A there, but what's in it for the government to take the trouble to revise a statute when they take a victory lap for dealing with inversions well? Why would they want to go through the effort of revising a statute that could create more problems?
Simplification.
Yeah, I think it's market efficiency and making where there's arbitrary decisions being made because of tax policy. I think we all agree that tax policy is not a wise one, and you see that in 367, where the goal of anti-inversion policy can be encapsulated in 7874 and be executed properly there. So I think it is simplification and efficiency.
So both of those points, just to extrapolate a little bit on them, I think that the simplification point leads to controversy, right? Having two overlapping sets of rules, the 367 ones being more complicated, I would say, and more data-driven on some level. You can probably get most of the 7874, kind of on the face of the transaction. That's just going to lead to more controversy, which I think should be avoided. And then secondly, the capital markets efficiency, just allocating
But there's one more piece that I think we're missing, and I miss it a lot because of what I do, which is just deals. I think it's easy to say the enforcement. I think this is a fair point. The enforcement arm of the government, it is much more efficient, direct to enforce on 7874. 367A with a broad group of shareholders is a significantly more challenging audit and enforcement environment.
Right.
So I guess that's a government resource argument for streamlining.
What's the saying? You want one throat to choke or something?
Yeah, exactly. Yeah.
I never use that. I'm sorry. Was there a question back there?
Was there a question?
So two other really quick points before just moving on to the next thing. One is that it's not on the slide, and we touched on it briefly, but 7874 has a substantial business activities exception, which seems relevant to import into 367 to harmonize them. It really goes to whether a large plurality of your business is operated in a particular foreign country. 25% is the standard used in the regulations. So I wanted to flag that. The third point is, I think what we're trying to talk or focus solely on here are legislative changes. So here, the harmonization we think is appropriate in the statutory context rather than the regulatory context, because 367A is already an operative rule and doesn't rely as heavily on the regulations. Those have kind of developed to support the limited operating rule. Anyway, let me go on very quickly to the next topic. And this is, I would say, a kind of a contingent proposal, which is kind of outlined in the paper in a little more detail. There's already been panels on the differential treatment between directly owned foreign businesses and indirectly owned foreign businesses. And by that I mean businesses that are operated by a US person in a branch versus businesses operated indirectly through a corporation. The differential tax treatment is substantial. There are many, many differences related to the rate after the 250 deduction for GILTI and so forth, related to foreign tax credits, related to certain exclusions from income as a result of tangible property and the QBI exception. The list goes on. And I think, our observation anyway, which is not necessarily scientific but anecdotal, is that the U.S. is very much an outlier in its treatment of its territoriality regime. Many jurisdictions, either mostly or wholly exclude branch profits from their operating taxation. And so, other panels have talked about that. I've talked about branches, they've talked about GILTI, and probably discussed the interplay between them. I think if it is decided to either somewhat harmonize them or that this distinction isn't fully warranted, 367A is also relevant. 367A, as I noted kind of at the very beginning, used to include an exception for outbound transfers of trade or business assets to be used by the foreign corporation outside the United States, but that was eliminated in the TCJA. If there should be it should be easier to move between the two direct and indirect taxation regimes. That should be added back in. Any comments? I think we wanted to just touch on this briefly.
No, I think we can move on to 367D.
We want to make sure Brian gets into this. Yeah.
We don't want him to fall asleep way down in the end there. Yeah. Okay. So as I kind of noted at the outset, 367D is a little bit of a hybrid or hydra. It has components, and the first words of the statute tell you that it is treated, the outbound transfer of property in a non-recognition transaction or sub C, if that is intangible property, is treated as a sale for contingent payments. Those contingent payments must be over time commensurate with the income from the property. And we think that one of the primary reasons for this exception is that it is challenging to value intangible property in many circumstances. There was a whole global initiative trying to deal with hard to value intangible property, and it's an ongoing problem. But then, so it's part sale for contingent payments, but then it's also part license. For certain purposes, both in the statute and the regulations, the payments received and the payments deemed made are treated as royalty payments for both character, for 904 purposes, et cetera. And then part of it is kind of unknown, right? It's still a non-recognition exchange. All of the other sub-C provisions kind of appear to apply, but it's not entirely clear. And so, I think in particular, the basis consequences of these transactions, whether there's basis recovery from the transferor, that's similar to a license, right? If the transferor is treated as licensing the property, it should be able to recover any basis it has in the property. Conversely, if it's instead treated either as a contingent sale or as a non-recognition exchange, that basis, would carry over in some form or fashion to the transferee. Second is timing. This contingent payments. There's been some development as to how to do that over time, but questions about acceleration, deferral. Notice 2012-39 dealt with acceleration in certain circumstances, and then payments over time and how they can migrate with changes in the productivity and profitability of the intangible. So I'm going to stop at that and see, Brian, if you want to.
Yeah, I mean, the point about basis and kind of the uncertainty around the basis consequences when you have a 367D transaction ends up being very important. And in certain specific contexts. And the area that I see this the most is where there's an acquisition of a target that has IP. It's both foreign and U.S. rights, and that IP kind of, you get a step up in basis for whatever reason. It's treated as an asset acquisition for one reason or another, and so you have foreign IP that you want to kind of align with the ownership of your other foreign IP in a CFC. So you've already paid for basis, but 367D really would seem to tell you that if you do a non-recognition outbound transaction of that IP, then your basis isn't going to protect you from income inclusions under 367D. Now, the statute itself, does have these sale elements in it and refer to kind of sale treatment, but the regs don't really take account of that basis. And so you end up in kind of the worst of all worlds, in the sense that if you had sold the IP, your U.S. income inclusion would have been limited to your gain in the IP, which if you just acquired it might not be anything. If you'd licensed the IP and retained ownership in the U.S., you could have continued to amortize the IP against your U.S. income. Under 367D, you don't get any of that. You just have the income inclusion in the U.S. and some deductions against E&P, tested income, whatever it is, in the CFC, which may not be that useful for you. Certainly aren't as valuable as protecting against U.S. income inclusion in most cases. And so it seems an unsatisfactory situation, and it really stems from the statute itself, as Josh said, this kind of ambiguous, is it a sale, is it a license treatment? And so it seems to be, while Treasury could write regulations, there is a deemed sale election very narrowly applied to operational intangibles. I think this is something that really calls for a statutory fix, at a minimum to clarify kind of what an appropriate model is for taking into account basis.
Yeah.
Simple question. What do we need 367D at this point in terms of all the changes that have been made? We all know originally why it was put there, and it was very inartfully drafted, as some of us remember. They had to change it a couple years after they first put it into the code because it was really a mess in terms of the source of the deemed royalty. But they put it there. People were made aware that they shouldn't do this. It was more like a don't do this provision than it was an actual operative provision. And the question is, in the current environment, why not do it? What are we protecting against now?
I think it's reasonable to think about treating 367D type intangibles under 367A instead. Now, the argument against that would be, well, you're losing this commensurate with income concept that you get by pulling in the reference to the principles of Section 482. But you can deal with that statutorily in some way. It doesn't necessarily have to be that whatever gain, it doesn't have to be a one-off, gain inclusion. There could be a potential to add a CWI concept, even if you had more of a sale treatment. So, but yes, I think, do we need 367D the way it is? No, I think something should change about it.
Yeah, I guess, oh, sorry. I was going to note that, there's probably, there are two elements. One is that, as you point out, there have been a lot of changes, in particular to 482. They've added, a realistic alternative and other things that give the government more ability to challenge valuations and get to the right valuation. So that's probably cutting against one of the policy things. The ability to defer gain on transactions through 367D is a favorable outcome, and it's more. It might be more similar to the way a lot of companies treat this type of property in their operating business. So if they have third-party customers or they have large customers, the license is probably more similar in many circumstances to how they would exploit that IP in general. So is it necessary? I mean, I guess it depends on what the premise of the question is. Like, it doesn't seem necessary to protect the fisc anymore, but it does have some utility, I guess.
I mean, you're right that if you could get rid of 367D as long as you had 367A not have an active trader business exception, right? Because you wouldn't want mobile IP to be able to transfer like it was before the 84 Act, and that's fine. The other thing, though, is as 367D has been modified and implemented over time, it's gone way beyond its initial scope, which was intangibles that are movable apart from moving a trader business, like patents, copyrights, trade secrets, to things like including goodwill, going concern value, customer relations, most of which are attached to a branch and not transferred from a U.S. taxpayer apart from a branch to foreign. And it seems to me, I mean, back in '84, none of us really thought about branch transfers. But when you have intangibles that have grown up in a branch, we don't have the primary right to tax that, right? We're giving somebody else the primary right to tax it. And yet 367D, as it applies today, gives us the primary right to tax the transfer of those branch intangibles that grew up in deductions in the branch. And we assert the primary right to tax it when they convert the branch to a CFC. And that really keeps a lot of branches from becoming CFCs and taking advantage of the GILTI structure, because it's a huge double tax cost today. It wasn't so bad before 17 because they were all in the same basket, and you didn't get any deduction for foreign tax purposes, but you could use the excess credit to shelter your 367D charge. You can't do that today, at least in most circumstances. And so we really are double taxing under 367D branch transfers. And it seems to me somebody needs to put a spotlight on that if we're going to continue to treat branches as fully subject to U.S. tax and not like CFCs.
Right. Yeah, I guess actually, can I ask a follow-up question? Is there a distinction in your mind between the treatment in 367D of branch IP and 367A? Because they seem to be somewhat similar, I guess.
No, I think the same thing could be said for if you're a bank and you have a branch in London and you want to convert it to a CFC and you happen to own an office building in the city, you've got a lot of appreciation in that office building. But if you had sold it as a branch, we wouldn't have taxed it because the UK would have taxed it. So why should we apply 367A to it when you incorporate it? For branch assets, we don't have the primary right to tax. We admit to having a residual right to tax. So there's no sense in applying a primary right when you change your form of doing business.
Yeah, so then there becomes a policy design question of what do you do when you're moving IP from primary to secondary taxing rights without actually taking it into a CFC, so moving it to a foreign branch. And we do have the 904-4F rules that reattribute foreign branch income to the U.S. And maybe that's enough if there's enough time for the reattribution, to take its course. But I suppose people would be concerned about a transaction where you're in short order moving IP into a branch and then to a CFC. Yeah, you'll just have to draw a line, but yeah.
The last thing we have on here is repatriations of IP, which I'm actually going to skip. But so in our last 2 minutes, if there are any other questions, comments, compliments?
We'll take it all.
I'll give you one.
You got one more.
Can we get rid of 367A GRAs on foreign stock legislatively? Any sympathy for that?
Are you asking me?
Sure. It seems like a good government tax administration thing. I think it could be done regulatorily, but.
Yeah, I mean, so right. I guess I had said initially that one of the reasons for 367A, and then I sort of said the GRA rules were accomplishing this, was to prevent the capture of, or prevent the U.S. tax of realized gains when they were transferred offshore. And I think that's a little bit simplified. A different way of describing it is to prevent the diversification of concentrated gains through a foreign corporation, which effectively results in the permanent or indefinite deferral of that gain if you can diversify appropriately. And so the GRA rules are kind of striking a balance. I don't know why I'm defending these, but here I am. The GRA rules, are kind of striking a balance. So they only last for 5 years. They permit kind of diversification into a foreign corporation. But yes, we shouldn't because of big government, I agree. Anyway.
Perfect. Please join me in thanking our panels.
Thank you. Thank you. Thank you.
So this concludes our morning session. Lunch is outside and we'll be back at 12:45. Thanks, everyone. I hate to cut that music. That was a lot of fun. Hope you all enjoyed your lunch. And our next panel is going to be on transfer pricing, and it will be an hour long, followed by 15-minute break. Our presenter is Rocco Famia. He is a member at Miller and Chevalier. And our commentators are Peter Barnes of counsel at Kaplan and Drysdale, Nate Carden, a partner at Skadden, and Michael McDonald, who will be right back. Sure, an executive director at EY. So Rocco, I'll turn it over to you. Thank you.
Great, thank you. Thank you very much. So we're on for an hour. We're going to take the full hour, so please get comfortable in your seats. All right, we've introduced our, thank you, Mike, for joining us. So these are the three items we're going to consider in the panel: the arm's length standard, OECD transfer pricing guidelines, and then intangibles. So three minor topics we'll tackle over the next hour. And the question with respect to each is really whether it would be useful for Congress to consider these items in light of U.S. interests and in light of the international tax landscape, and if so, what kinds of things should the Congress consider? And I really want to thank Mindy and the other sort of project organizers for actually including transfer pricing as a topic. It's often a kind of afterthought to international legislative policy discussions, and I think it shouldn't be. So very happy to be here. So I'd just like to start with the word about the purpose of the transfer pricing rules and put it into the context given developments in the international tax landscape. And so obviously the transfer pricing rules govern allocations of income and other items between entities of a multinational group that transact with each other. And so this is very much the starting point. The other sets of rules that have been discussed and will be discussed throughout the conference kind of apply after transfer pricing, right? After income is allocated or other items are allocated among entities. And so one can design very, very good CFC rules or very good foreign tax credit rules, and they're not going to operate as intended unless the transfer pricing rules in application are adequate, let's say, right? They don't have to be perfect or very good. Adequate is what we're shooting for. It can't be an afterthought in these discussions. And so the first item on the slide, obviously the transfer pricing rules help define the core U.S. tax base, right? The income of U.S. entities from their activities in the United States. And this purpose has gotten the attention of Congress over the years, and I would say more attention than the second purpose. Changes to the statute intended to ensure that U.S. taxpayers earn appropriate amounts from transfer of intangibles developed in the U.S. The second and third sentences of 42. But the transfer pricing rules also serve a second purpose, which is very, very important, and I think will become even more important in the future. They provide a framework for resolving double tax disputes, right? So in the transfer pricing space, two or more countries can assert primary taxing rights to the same income. That kind of double taxation can't be addressed through foreign tax credits or an exemption or territorial system. It can only be addressed through common rules and a common framework that allows countries to come to an agreement about the appropriate allocation of income. And given the proliferation of minimum taxes around the world and just the general increase, I think, in foreign taxes around the world, this purpose is going to become increasingly important. And finally, I just want to observe, and the paper makes this point, that the U.S. transfer pricing rules are, and really always have been, neutral rules. And it's an interesting observation about the rules. They don't apply differently depending on whether transactions are with entities in high tax jurisdictions or low tax jurisdictions. They aren't motivated by increasing activities in the U.S. or economic investment. They're just sort of trying to get things right. And there's an obvious reason to that, right? Neutral transfer pricing rules are necessary to avoid double taxation. And to the extent policymakers want to pursue other policy objectives sort of unrelated to that, we would really encourage them to look for other rules to play with and not the transfer pricing rules. So we'll move to topic 1, the arm's length standard. And so the statute provides authority to the IRS to reallocate income or other items to more clearly reflect income or prevent tax avoidance. No mention of the arm's length standard in the statute. For decades, the US regulations have incorporated the arm's length standard, and international standards, notably the OECD transfer pricing guidelines, also incorporate the arm's length standard. And in some ways, that's a tremendous success. And it's a success really driven in large part by the United States over decades to have general consensus on the standard in this space. The US position is that the US rules are consistent with the OECD transfer pricing guidelines. But the IRS will only refer to the OECD transfer pricing guidelines in the context of MAP or APAs, and so not in the context of domestic examinations or appeals, for example. There's been tremendous pressure on and scrutiny of the arm's length standard, arm's length transfer pricing in the US and internationally. Pressure on policymakers to kind of erode or water down or stretch the standard to meet policy concerns of the United States, policy concerns of other countries. For example, policy concerns of market jurisdictions that they aren't getting their fair share, or policy concerns of countries where significant management activities take place, or intangible development activities, or so on. And the BEPS 1.0 initiatives produced significant changes to the OECD transfer pricing guidelines in response to some of these pressures, but they certainly didn't relieve that pressure. And the Pillar 1 work is again another manifestation of this, and it hasn't produced results, right? Either on very big questions like how to allocate excess profits among jurisdictions, and it hasn't really produced results on small questions either, like providing certainty on distribution returns. And so it's possible that these pressures will lead to changes to the OECD transfer pricing guidelines in the future, or even changes to the US regulations that will move away or drift away from the arm's length standard. And so the question in this space is, does Congress have a role? Like, should Congress explicitly incorporate the arm's length standard into the statute? Should they do other things in the statute to kind of pull into the statute some of the guidance that has been foundational in the US regulations and OECD transfer pricing guidelines over decades, like the best method rule, kind of comparability analysis, that sort of thing. And on balance, I think the paper comes to the view that maybe Congress should consider this. The clear reflection standard in the statute's very broad. It could be interpreted in ways that are not consistent with arm's length transfer pricing. It's too significant an issue to be left to interpretation of future, Treasury departments and future IRS officials. And maybe Congress should take the opportunity to weigh in on the standard, and so that any reconsideration of the standard would be subject to a future legislative process rather than a regulatory process. And should other of these items on the list be considered? Maybe they should. Again, maybe the rules of 6662E, the transfer pricing penalty rules, already refer to some of the nuts and bolts foundational elements of the transfer pricing regulations. They kind of just literally refer to the regulations because there's no place in the statute for them to refer. So the notion of specified methods and unspecified methods makes an appearance in the statutory text of 6662E, but no appearance in 42. The basic framework of the transfer pricing regulations has been in place since the 1990s. Same with the OECD transfer pricing guidelines. It's stable enough. Why not make some reference to it in the statute? And I guess as a third overarching item, Congress could consider providing additional tools or direction to IRS and Treasury in the line of relieving double taxation. And one item I note here on the slide is just the authority to enter into administrative agreements for the resolution of transfer pricing disputes with non-treaty jurisdictions. We have a mutual agreement process in our tax treaties. It works well, but it's only in our tax treaties. And I was sort of struck, the Taiwan tax bill had some references yesterday. It's a kind of innovative approach to incorporating treaty concepts in the statute. It leaves out of kind of its first phase, MAP. And why is that? It would be great to have an administrative agreement with Brazil, let's say, to resolve transfer pricing issues, even if we can't come to an agreement with them on withholding tax rates or PE standards or anything like that. And so with that, maybe, Peter, I'll turn it to you I've talked enough, so.
Thank you, Rocco, and thank you to the organizers, but especially to you for the hard work you did putting the paper together. I'm the simple, on-the-ground kind of guy here. I'm not the deep academic. And I want to seize on Rocco's last point of what could Congress do that might make this better.
Wait, you are a deep academic.
Yeah.
What are you talking about?
Certainly not. So.
I'm a fake there, too. I'm a fake there as well.
What the heck? Sorry to interrupt, Peter.
Known you a long time, Mike. I think what Congress can do really ties to the discussion earlier this morning, which is to say, this is not an area where you have to be perfect. I was struck very much by Marty Sullivan's comment this morning that with QBI, we're looking for precision for an imprecise concept. And we've had that kind of conversation all along, whether it's QBI, whether it's a substance-based carve-out, FDII. We tolerate and accept that the answers in these other areas, we're going to take shortcuts. Is it a perfect calculation of what intangible income is? No. But when we come to transfer pricing, we somehow have this vision that there is an answer, a price, a margin. And what's astonishing is the M&A guys will do a deal, and they can really focus in on 367. A major multinational company will have literally thousands of cross-border flows. It's in 100 countries. It's selling different goods, different services, and there will be thousands of cross-border flows. No one flow is more than 1 or 2% of the company's total volume. Now, that may be $1 billion, but it's only a few percentage points. What I would like Congress to do is to accept and tell the IRS that, look, we understand that perfection is not possible, and so safe harbors, shortcuts, other kinds of approaches are good enough, same conversation we had earlier today, and that the IRS in the US would then take this and work with the OECD, work with our treaty partners, and work with others. The Pillar 1, Amount B conversations are fascinating because of all the things we ought to be able to work out is a safe harbor, rough justice amount for amount B. We can't, or we're struggling to get there. So I think we really do need to be moving away from perfection. I would love to have Congress acknowledge we're moving away from perfection. The biggest challenge for the IRS and for other governments in this area is case selection. I'm sure you've heard Sam Maruka and other people from the IRS say, we don't do a good job of picking our cases because the taxpayer has all the information, and on our audits, we struggle to find which flow, which taxpayer we need to dig into. What I'd like to have transfer pricing do in the US and globally is to take as many cases off the table as possible. Then our agents can focus in on the cases that really matter, can advance the law appropriately. But I would like Congress to take steps here to empower the IRS to take steps with its peers around the world in order to take as many of these cases off the table. I assure you the multinational companies are not going to fight over whether it's 4% or 5%. And if you can take that dispute off the table, I think it's a big win.
Mike?
I just want to comment on that because what you say makes a lot of sense. And I would also say that I think the U.S., the IRS and Treasury have been historically sympathetic to that view. Like, why are we spending so much time on less important things? Let's pick a number for distribution and focus on intangibles. That sort of was the spirit I always thought behind the services cost method and the services safe harbor, right? And so, and I can also personally vouch for the fact that for the decades I was at the OECD, we were basically, and other countries too, were saying the same things. Like, why can't we just try to come up with safe harbors? And we were never able to. And amount B is fascinating to me, right? Because, and again, I think this is speculation, I don't know, but I think to some extent it's driven by the US who kind of want to, can we take on this safe harbor issue? But it's funny, the buzzsaw that it's going through. It's an absolute buzzsaw. Countries are looking at this and they're basically seeing, is this a revenue loser or not? And based on that, the countries like Australia say, we're out. India, we're out. Other countries are hedging and hemming and hawing. In this case, I don't think the U.S. is the problem. So, for example, I wouldn't necessarily think that Congress would have to goad the IRS to achieve that objective. And then a similar question is, what purpose could Congress have in helping or in getting us to goad the rest of the world? I'm not sure how that would work.
Well, I'm not sure they'd go, I'm not sure Congress needs to do that. I think an endorsement publicly by Congress that good is good enough would be helpful here, because I still think you've got acolytes all over the world, and Amount B shows it, who think there's an answer if we just work hard enough.
The issue there might be, sorry, I'll let you go. The issue might be, it's funny because I think there's a lot of high-level consensus on what you're saying. It's like, come on, guys, why are we doing this? But then what happens? It gets down to the drafters. It gets down to that lower level, and typically it's not only by countries' treasury departments, but their tax authorities, and they don't want to give it up. So yeah, high-level agreement. Everyone agrees this would be better, net better. But so far at least, when it's gotten down to the details, countries have been unable to take other than a short-term parochial view. I'm not saying it's not worth doing, but that has been the impediment, I think.
Well, and I mean, I think it's kind of understandable. I don't know that I would call it short-term and parochial. I guess, and I look at the United States as actually the principal perpetrator on this in terms of how things get enforced. I've never run into an IRS examination team that believes that what the U.S. is doing, even if it ought to fall under the guidelines of Amount B, is actually routine distribution, right? I mean, the United States very strongly believes that our market is special, that the people that are here are adding all of this value. So I guess I don't see this as another country's problem. I see this as a broader problem. In terms of a congressional nudge, I actually think the idea of sort of good enough is a great thing to put into the statute, right? And in particular, to me, the more interesting thing wouldn't be to codify the arm's length standard, it'd be to codify the arm's length range, right? To say, the commissioner shall have the power, the secretary shall have the power to reallocate in circumstances where you are outside of the arm's length range. Now, I will also say that there's, outside of the international context, 482 does a bunch of other work, right, in, partnership areas, et cetera, that, you might want to sort of separately carve out. I would also say, in terms of Congress having a role in things that we wrestle with, in the theme, as Mindy has tried to give us, of focusing both on technical stuff and big picture stuff, is let's stop referencing 482 control as a standard in other parts of the code. That does nobody any good in, for example, 59A. Nobody has any idea what common control under 482 means outside of the context of the 482 cases, all of which are about clear reflection of income. So, you want a simple thing to do? Get rid of that. Just carve those. That would be a great thing for Congress to do, is not try to import 482 concepts into the rest of the code. But more broadly, I don't know how much good a detailed codification would do. We're certainly not going to take the 482 regs and codify them. Maybe you could codify the methods, but I actually think codifying the arm's length range would be terrific. That being said, right, I don't think it's going to solve our, safe harbors routine distribution problem, because I don't think there are really countries that think that they are routine. I think countries think everybody else is routine, but, we're special.
Yeah, I haven't given very much thought, but the common control standard imported into other areas is a problem, where we don't know what common control is in edge cases in 42. And the paper, we're not going to talk about it today, but it talks a little bit about pricing or valuation in other contexts where you think 42 might apply but doesn't. And I think there are those kinds of discontinuities I've heard that word around this conference that might be an easier lift to address. But we've talked a lot about the OECD, so let's move on to the next.
Before you
go ahead, Mike.
there, I just want to pick up, just in listening to when you were talking about the U.S. rules and how either as a policy or a rule, the U.S. will not apply domestically the OECD transfer. I mean, it's funny, there's some irony in that, because there are a number of instances in which the OECD guidance more clearly articulates what has been a U.S. policy position. Two examples I can think of is the recent IRS GLAM on implicit support. The GLAM has an example, and that example is pretty much taken directly out of the OECD Transfer Pricing Guidelines, Chapter 1, that the U.S. actually had a decent hand in writing. Another example is prior to the codification TCJA, the discussion of goodwill in the transfer pricing guidelines, I think more clearly reflected what was in fact the U.S. policy position. So it's funny that they might be hoisted by their own petard by following that too doggedly.
Yeah, the advice memorandum, this is from 2007. It's interesting. It was focused on commensurate with income. And since 2007, of course, principles like commensurate with income have been incorporated in the OECD transfer pricing guidelines, and it might be worthwhile for the IRS to consider just pulling that advice memorandum, like whether it makes sense anymore. But of course, to the extent U.S. law differs, taxpayers have a right to apply U.S. law. They don't have to apply a standard that's incorporated into a treaty.
I was thinking of the opposite situation.
I know, but
actually.
That's exactly right. That's exactly right. Yeah, go ahead, Steve.
I just would like to make a strong pitch. We have probably the most effective single sentence in the code in Section 482, now 3 sentences. And each time a sentence was added, they risked doing damage to that first sentence that is still very critical to the tax system, and particularly the international tax system. please do not ask Congress to either modify a sentence or add a sentence. And part of the reason I say that is because we are in a new world of litigation. We're in a new world. Any new sentence creates the ability to challenge whether the subsequent action taken under it is consistent with that sentence. I just really, 42 has done a very, very good job. I would encourage us not to disturb it.
So Steve, is that because you like the sort of carte blanche authority that it gives to the Treasury?
Yes, absolutely. But nobody was talking about limiting that authority. They are all talking about encouraging them to go further and do safe harbors. I think that's already there. And I think the other part of this is we are working in a very dynamic global context, and the ability of the IRS to respond, bob, weave, or take, as you said in the GLAM, the example from the OECD, I think is very valuable. And so I think that flexibility has served us very well.
Yeah, I just want to say, I understand that comment, and I think single sentences that have been in the law for decades, like one ought to be, approach the idea of modifying them with a lot of humility. But Congress gets to decide what the law is, and it is the place to go for significant policy questions. And so I fear, and the implicit support issue, it's a minor issue in the grand scheme, but it's a good one. It's not clear to me the answer in the OECD guidelines is consistent with the arm's length standard. Does that matter? Like, I think it matters. Maybe Congress thinks it matters.
I wrote an article about that, by the way, in this week's Tax Notes International, just FYI.
And it may be a minor portion, but there's one company for whom it was $1 billion question.
Yeah.
So
Yeah, maybe they litigated in Canada. Is that
could have
what you're
happened.
thinking about?
Just hypothetical.
Could have happened.
But I mean, Steve, I take the comment.
Yeah,
It's a very legitimate concern.
I guess I will also say, and we'll get to, I'll say more about this here in a minute as we go into TBG, but I also think for those that are, looking to protect Treasury from, sort of judicial asteroids, right? 482 potentially has non-trivial non-delegation problems as it's currently written. So, we should think about exactly what we think the right balance is. But we'll say more about that in connection with what do we ask the OECD to do?
Yeah, so we've talked about the OECD transfer pricing guidelines quite a bit, and already they govern the resolution of pricing disputes under treaties and increasingly serve as a reference point for domestic law. The US is an OECD member. We've had an important role in shaping the guidelines. The OECD operates by consensus, and the guidelines are a consensus document. They don't have reservations or observations to them. There have been very, very significant changes to the guidelines over the last 10 years. A couple of them are noted. Mike, you mentioned the financial transactions, business restructuring guidelines. This is a lot of detail in the guidelines that doesn't exist in the US regulations. It's not 100% clear. We could get agreement among transfer pricing practitioners that the results provided by the guidelines would also be provided by US law or would be consistent with the arm's length standard. And the process for changing the OECD transfer pricing guidelines is really different than the process for regulating in the United States or legislating in the United States. It's a government-to-government process. Sometimes there are discussion drafts or consultations held. Stakeholder input is solicited, but not always, and certainly it's not required. And so the question here, there's always a question, and it's always the same one. Does Congress have a role? And here it wouldn't be a substantive role, but a process role. Should Congress work with Treasury to develop procedures for considering or agreeing to changes to the OECD transfer pricing guidelines. And just as an example, the paper sort of outlines a kind of notice and comment process where if Treasury is considering significant changes at the OECD to the guidelines, then it might be required to provide notice of that to taxpayers in the US and provide a position on whether the changes are consistent with existing US law and solicit comments. Currently there is no US process around this, but it's incredibly important because changes to the transfer pricing guidelines effectively do change US law. They change the determination of transfer pricing cases involving treaty partners, and those are the vast majority of transfer pricing disputes that exist in the system. And so with that, maybe Mike, I will turn it over to you.
And these are really good forward-looking questions, but I'm going to have to do what I have to do on every single panel, because at some point we have to address transfer pricing is broken and why. And so I want to sort of...
We don't have any of those people on the panel, so
Yeah.
we're addressing
No. Yeah, no. Let's accept it, because I do think it plays into this. And to me, there's kind of an underlying premise in a lot of these OECD questions. And I think the underlying premise is that there's a significant difference between currently, I realize this is a forward-looking question, but currently between what the OECD transfer pricing guideline says and what 482 says. And I think I posit that the actual number of true divergences in the written text are actually low. But what you have to do is set aside those positions like Dempsey trumps contracts can be simply gratuitously ignored, and things like that have absolutely no foundation in the transfer pricing guidelines themselves. To me, one of the key questions that we have to answer when we're accepting the premise that transfer pricing is broken, it's important to know, is the problem that the rules are incorrect or unclear, for which they need to be clarified, or is the problem more that there's incorrect application of what in fact are fairly clear rules? I actually think the problem is more towards the latter. And for me, it then becomes, I think, trying to apply the rules that are actually written as opposed to the parodies of the OECD guidelines that I have heard, or the cartoonish views of the OECD guidelines. That latter one, Mike Williams and Pascal Saint-Amand, an absolute cartoonish view of the guidelines. And so I think we have to come to grips with that in fact the guidance in the transfer pricing guidelines and 482, the divergences are actually few, as the basis to try to think about, okay, how do we go forward? So I haven't even gone to your questions, but I'll wait my fair turn to address that.
It's sufficiently provocative. Yeah, I mean, I guess I wonder how, I mean, that could be right. You know, my professional photo doesn't have a flag. My name badges don't say the United States of America. So, you know, far be it for me to decide, and far be it for any of us to decide, right? I mean, one of the challenges, I think, with kind of where the OECD is going more broadly, and I think everybody in this room has probably heard me say it, but I'll say it anyway. I very strongly believe the OECD is not set up to be a regulatory body. It doesn't have the mission, it doesn't have the competence, it doesn't have the staffing to write regulations. I think we see that with Pillar 2, and I think adopting that theory with respect to the transfer pricing guidelines is something that we absolutely do at our peril. And with all due respect, and I should probably scooch over a little bit, but you know, I'm not I'm not sure that the changes to the guidelines in 17 and 22 relative to where they were in 10 and even in 1995 have actually added more light than heat in terms of really giving guidance. And part of the reason for that is I think that a consensus-built document that is not reflective of individual tax systems is very, very, very hard to actually describe as a set of rules, right? The best example of that, to my mind, is the provisions in the risk control framework that talk about proper delineation of a transaction as a financing. I, as a US tax practitioner, I can think, okay, you're gonna tell me it's a financing, now I know what I've got. I've got a debt instrument, or maybe I've got preferred stock, right? I can work with that. But that's not how the rest of the world views it. And I think trying to go halfway in describing what the consequences of a transaction are in the risk control framework have actually moved us backwards, not forwards. I think principles would be better, right? And then the other point that I'll make, which I was hinting at before, is I do think, to the extent we're worried about system stability, that delegating rulemaking authority to sort of what effectively is a private actor from a U.S. perspective is both a constitutionally dubious as well as
No,
sort
it's
of
not.
politically.
I mean, it's an interpretation of Article 9. I mean, it's basically an extension of treaty negotiations.
But then is it actually a domestic rule, or is it just the thing that the members of the APMA team and their competent authority counterparts use in negotiation? If it's there behind the scenes, like this is how we're going to do it, then yeah, I mean that's right. They can deal with the negotiation process however they want to. But if we're going to say that the TPG should be part of the way we think about interpreting our rules, or even more directly, that we ought to have a consultative process whereby adoption of the TPG into our own domestic regulations is part of the way we run our rules, then I think we're in a completely different world than an interpretation of Article 9, because we're talking about a rulemaking process. At least that's my fairly strongly held view, in case people were wondering.
Peter, let's let you.
Yeah, let me make a side comment, which doesn't directly impact either of those. I think there is a role for opening up what the OECD does, because I think as long as it's perceived to be this closed club of other countries, that's not healthy for any of us. So whether Congress and Treasury have hearings to talk about what's going on or anything else that opens it up, I think is a positive. But let me make a side comment. What I worry about with the transfer pricing guidelines and our regs, and really the mentality everybody brings to this, is we're always like Talmudic scholars trying to divine an answer. And what I've preached many times to no success is I want the dog that doesn't bark. The perfect audit is the one where the agent says, what do you do on transfer pricing? You respond, here's what I do. The agent says, I understand, keep going, and there's no change. But the way we mark our ability, what have we done? Well, we had 400 audits and we had 350 adjustments. That's a failed system. The successful system is where you've picked your cases right, so you only had 100 audits, and 50 of those, there was no adjustment. So I think there needs to be a mind change. Hearings and other things could help in that, to open up the OECD, but also to make both the OECD and the world and taxpayers recognize that the right audit is one with no adjustment, not the one with an adjustment.
Yeah, I think a lot of the transfer pricing mindset has developed basically with a low tax or zero tax, jurisdiction on the other side. And it's very easy, Peter, when that, if you're an auditor and that is the paradigm you've been trained on, it's very easy to go in thinking about, am I going to propose 10 adjustments or 15? When the world we're going into is moderate tax and high tax on the other side almost all the time, like the mindset of 10 or 15 adjustments is not it's not fit for purpose in
Yeah,
the future, I think.
But the other point on that is multinational companies do not have the ability to tailor 100 transfer pricing policies for 100 countries. They can't. They can't administer it, they can't explain it, they can't anything. If you have an audit in Korea, the very first question they ask is, what do you do in Japan and China? Because Korea wants to know exactly what you did in Japan and China, and the way to avoid a problem in Korea is to say, I do exactly what I did in Japan and China. So I think the multinational companies, by and large, are not doing one-offs. They're doing policies. And the problem we have with disputes is one country says, I don't like that, and there's no other country in which you can get a correlative adjustment.
Yeah, I do think, just to address the discussion between Mike and Nate, like I see both sides of it, and I just think in this space, unlike other spaces, there's a value to consistency and conformity that maybe goes beyond kind of the value of either getting things right or getting things kind of in the narrow U.S. interest. But I hear the concerns also and I do think the OECD process could be improved on changes to the transfer pricing guidelines. It has frankly gotten better over time. There is more transparency than there used to be, but I do think it can be improved.
I mean, part of my thought is prior to changing the transfer pricing guidelines, why don't people read the transfer pricing guidelines? They're more powerful than they're given credit for. To give a couple of examples, it's an important principle in the risk guidance that contracts are important. Right? It sets the stake in the ground on an ex-ante basis about who is taking risk. That is incredibly important when you consider that audits happen years after risk is plays out. Right? All of that is laid in, and the whole thing is, hey, you throw away contractual information at your peril. But the other powerful aspect is, well, if we simply allow contractual arrangements to be respected unfettered, all is lost. And the answer to that is no, because there's very powerful valuation guidance, right? And the valuation guidance is such, and there are examples in there that basically give the lie to these assertions about how respecting contracts definitely leads to BEPS, right? But the problem is, I am not hearing a discussion at that level among countries and in audits internationally. Instead, I'm hearing, let's not even talk about how to evaluate a contractual arrangements. Let's just skip over that and let's replace it with, well, in my view, unrelated parties would have done X or Y. That's very frustrating, and it's also not grounded in the rules. I know I sound like an apologist for the transfer pricing guidelines and the U.S. regs, and it's because the two are actually close together if people would just read it. By the way, so I was gone, you know, Biggie Smalls, right? He says, there's rules to this stuff. I wrote me a manual. This is the manual. This is a textual analysis of the transfer pricing guidelines that I think very clearly gives the lie to a number of the positions that we're hearing every single day. And it's not something that says, well, we were thinking this and other countries are thinking that. It's a textual analysis. You can't reach a conclusion in 1.105 given what paragraph 1.94 and 1.87 says. Now, I realize, Nate, you may think that I'm sort of playing into your strength by saying, you know, we're trying to define things by rules, but notwithstanding that, in fact, all these things I'm talking about in these paragraphs are really very strong general principles of valuation and administration that for some reason is being followed in the breach by countries, and I don't think it's accidental.
Would you hold that up so Sahil can get a good photograph for Bloomberg?
Yeah, sure.
Bloomberg.
I mean, I don't get a nickel out of every copy sold.
Okay.
Yeah.
Good,
It's the
Sahil.
B&A tax management portfolio on the OECD transfer pricing guide.
That'll show up in the next ad.
I felt like we were told no props. But
Yeah.
you know,
No, we were told no math.
I see no math. Yeah, it is, just to Nate's point about the capacity of the OECD to develop rules, there is no place to go to adjudicate an issue under the OECD transfer pricing guidelines. It is like a deficiency in the process. That is not something obviously Congress can solve or would want to solve, but a kind of like legalistic reading of the transfer pricing guidelines has limits, because there's nowhere you could go with that other than to try to persuade arbitration. So,
Case by case arbitration. I mean, the United States position
Well, transfer pricing is case by case.
Yeah,
I
but
mean,
they want case by case arbitration with no articulated rationale for the decision. Like, it's almost worse than litigation, right? It's like everyone is a new dart on the board, but I don't see a constellation emerging. I just see a bunch of stars.
So you're saying an analysis or an evaluation of the transfer pricing guidelines that actually articulates how this paragraph fits within the context of that is without value?
No, I think it'd be of great value. The question is, who's going to do it?
all right, let's move on to an easier question.
That's a rhetorical question, which means I have no answer.
So we've sort of been talking about intangibles, I think, the last 20 minutes.
We also didn't address your actual questions.
That's all right. That's okay.
From the last one.
We don't need to do that. Okay. They're just prompts, Mike. So we've been talking about intangibles, I think, in the guise of talking about the guidelines, and there's a reason for that. Most of the action in the transfer pricing space is on intangibles, and Congress has provided due attention to that twice, adding to the sentence Steve mentioned in 1986 with the commensurate with income standard, and just in 2017 with the aggregation and realistic alternatives principles. And commensurate with income has been administered by Treasury and IRS, I think to their credit, as a kind of rebuttable evidentiary presumption, right? So to the extent there's material excess returns from IP that's been transferred outside of the US, those returns are going to be presumed to belong with the US transferee unless the taxpayer can prove otherwise. And that has been the approach, and that is generally the approach taken by the OECD guidelines as well with respect to so-called hard-to-value intangibles. There's been a lot of controversy in this space, controversy related to cost-sharing arrangements, in particular the intangibles or resources provided at the start of the arrangement, or if there's an acquisition and valuation issues there. Significant changes to the regulations in 2009, and cases in litigation currently under the old regs, under the new regulations, just a tremendous amount of controversy in this space. But controversy also in the licensing space. So the basic case of a US company that's developed intangibles, license it to a foreign licensee for the purpose of manufacturing products, let's say, and what is the appropriate royalty coming back to the US, with the IRS generally taking a position that the appropriate royalty is whatever royalty leaves the licensee with the kind of routine manufacturing return, and taxpayers saying, no, we should split the profits in some other way. Very significant recent changes to the OECD transfer pricing guidelines. Nate mentioned the risk and control framework that applies generally, but especially with respect to intangible development. The allocation of appropriate compensation, let's say, to so-called DEMPI functions or intangible development functions. And so, again, the question here, does Congress have a role? We have these two special statutory rules in the code related to intangibles, like is there any reason to have those rules in the code? What about cost sharing, given the amount of controversy around cost sharing? Should Congress direct Treasury IRS to eliminate or change those rules? And what about the risk control framework and DEMPI? Should those kinds of principles be incorporated into US law? The paper takes the view that there probably isn't very much purpose to these special statutory rules on intangibles, but it might set the wrong signal to just eliminate them. And maybe if we're going to have an arm's length standard, we might keep commensurate with income so long as the results are consistent with the arm's length standard, and same with the valuation guidance. Cost sharing, in my view, is sort of endorsed in the '86 legislative history, and there will be controversy around the valuation of intangible transactions no matter what the rules are. And so cost sharing provides a kind of avenue for taxpayers to use IP within the group in a way that might make sense and actually eliminate some of the issues raised by licensing. We've already talked enough about the OECD. Let's see, who do I have starting here? Nate, how about you?
All right, there we go. Yeah, I mean, look, I think.
Wait, isn't it my turn to start first? Sorry.
Please. I think, look, on the special statutory rules point, yeah, I mean, I don't ever think I've seen CWI do any real world work, right? Particularly given the position that's articulated in 2007-7, which is effectively the conscientious upfront valuation, right? If people are doing that, I'm not sure how much any kind of evidentiary presumption, in real life is actually acting. Now, to the extent one believed that the purpose of CWI was in fact to preserve primary taxing jurisdiction for the United States over time, right, and effectively say, like, no matter what happens, right, inconsistent with the arm's length principle, we're going to try to pull the income back, then I guess it might be doing some work. But I think rightly, that's not how Treasury, IRS, or pretty much anybody else think it works. And I think that's consistent with the way HTVI's worked out at the OECD. So I'm kind of with you, like, yeah, you could get rid of it. You could keep it. There might be some weird inferences from getting rid of it. But since I don't think it's doing that much work, there's other things that I prioritize. Cost sharing, kind of the same reaction, right? Is the cost sharing has kind of become this sort of weird paper tiger villain for reasons that are not at all clear to me. I don't see cost sharing as that different from other sets of our transfer pricing regulations. You can sort of synthesize the same result with 482-4 and 482-9. So I'm not sure why there would be a lot of incentive to get rid of it. And I guess on the third question, and I'm hoping Mike is next. I guess I would say, like, if we hear that we're already consistent, right, with the TPG guidelines in our 1994 regulations, then we don't need to do anything. So, should the recent OECD TPG changes be baked in? I guess it depends on what you think they are.
Mike, you are going next, so.
Yeah, and I agree with that. I agree with everything that said, and I would just be repeating myself to say that I actually do think that sort of the differences between the current regs and the transfer pricing guidelines properly interpreted are very small. Including DEMPI. DEMPI was nothing more than the most innocuous concept that's saying we're only going to respect legal ownership, but clearly others other than a legal owner are going to make contributions. Make sure you pay them. That's it. And they said
You're not giving yourself enough credit.
Some of the aspects that you might want to consider are, I don't know, development, enhancement, maintenance. It became an acronym, and it took on a life beyond its own. But again, I just don't think it's supported by a text. I'm repeating myself. I agree with everything you said. I actually would be curious, and this sounds snarky, but I don't mean it. I really would like Congress to clarify exactly what it is they want to accomplish with respect to this commensurate with income, that was established in 1986. Because at Treasury, at the IRS, we were struggling with two concepts. The idea of somehow being able to apply hindsight to allocate income with the arm's length principle. And it's so hard to do that. Like, we took a stab in the cost sharing regulations, as you alluded to, by saying it's related to information asymmetry, right? To the extent that there's information asymmetry, it sets up a systematic bias that transcends valuation. And in that case, we can do it, and that somehow is consistent with arm's length. But you're right, it's basically saying you're lying, right? No, I'm not lying. Yes, you are lying. No, I'm not lying. And so, I mean, Congress hasn't really weighed in after that as to whether or not this interpretation of CWI meets the requirements that they set out. And I would just welcome some clarity.
I want to make one observation on CWI, and Nate's, I think, correct observation that it doesn't do a lot of work in the real world. I've never seen a transfer pricing audit where CWI has been.
Is that Congress's
raised.
intent in drafting CWI? I realize it's
Well,
40
it could
years
be because
ago.
it changed taxpayer behavior, and the valuations are, more rigorous, and income methods are used. But one place where it has done work is in disputes over the validity of regulations. And so the Ninth Circuit in Altera and the tax court in 3M, pending appeal, cited commensurate with income as kind of extra authority to support regulations that were being challenged. And that is noteworthy, I think. That is noteworthy.
Is that similar to Steve's point with respect? That's similar to Steve's point with respect to the authority in the first sentence is something that's valuable.
Yeah,
Right? This is the authority in the regulation.
I've told this story before, so some of you may have heard it, but the mystery around commensurate with income. The 84 Act thought it was fixing these problems. In the 86 Act exercise, Peter Merrill and Pat Oglesby of the Joint Committee were sitting in the bowels of Longworth, and Pat was belly aching about, we aren't getting the money we should be getting from these intangible transfers. We ought to get the money we would otherwise get. And yeah, Steve, and Peter Merrill says, yeah, but what we do? And Pat says, well, it ought to be equal. We ought to get equal amount of money. And Peter says, equal, we don't know equal. That's in the future. But it ought to be the same. And they say, well, we can't write a statute that says the same. So they literally pulled a thesaurus off the wall in the Joint Committee office. And Peter Merrill and Pat Oglesby flipped through it. And the word commensurate jumps out. And that way Peter and Pat could write commensurate, because commensurate's a good word. So we talk about what Congress was thinking. It was Peter and Pat with a thesaurus in the basement of the Joint Committee.
And just add one thing. If you remember 86, and all of you do. In 86, the House bill was a one-way street. It only applied it for outbound. And one thing we Treasury, because we wanted it to be even-handed, in conference persuaded the Senate side to make it go both ways. So, and I think that's some evidence of what the intent is. And I think this panel has discussed it very appropriately. I think you kind of captured. I have to go back and think a lot more as to whether the intent was to preserve our primary taxing jurisdiction. I don't get that out of my memory of it, but I have to go back and check.
I think that point it's like an incredibly insightful point. I came across that in the legislative history as well, and it jumped out at me on this point that the rules are neutral. I think if you read that legislative history, it says something like, essentially, we think this is the right answer, and therefore it should apply when a foreign entity transfers intangibles to the U.S., which is quite a statement. And I think goes to the point that, it wasn't supposed to be a penalty. It was supposed to be an articulation of the arm's length standard to counteract perceptions about taxpayer positions at the time.
Can I take 45 seconds?
Peter, go ahead.
Well, taking Steve's suggestion that we not tinker with the statute, there are other things Congress can do. Congress can ask Treasury and IRS for a report. They've done this hundreds of times. I think there are two tools that the IRS and Treasury could use. One would be an analogy, not the same thing, to the uncertain tax positions. Uncertain tax positions require taxpayers to say, hey, here are a few things. You could have, with respect to intangibles, you could have the taxpayer attach a one-page form, what are your flows, most significant flows back and forth. That would help the IRS agent. The other would be to ask a question as to whether both U.S. and foreign companies in their master file of their transfer pricing, are they adequately addressing intangibles? If Congress asks the IRS for a report on that, the IRS is going to be incentivized, I think, to drive taxpayers to do more to disclose their intangibles and their master file work.
Great. Well, we are just about at time, so.
Our panels. So we are going to take a 15-minute break and we'll be right back at 2. Thank you, everybody. Back, everybody. So our next panel will discuss inbound taxation issues. Our presenter is Harrison Cohen, a managing director at Deloitte. And our commentators are Arlene Fitzpatrick, a principal at Ernst & Young, Carol Wang, a senior counsel at Chartsis Freeze, and Brett Wells, professor of law at the University of Houston Law Center. Thank you very much.
Okay, and I want to thank Rocco in the last panel for being so enlivening, especially after lunch. Hopefully, we will also be very lively as well. Okay, so once upon a time, I was sternly lectured that the tax imposed on a domestic corporation does not depend on whether it's U.S. controlled or foreign controlled. And I'll leave you to figure out who told me that and who their client was. But some believed then, and still believed in 2017, that foreign-controlled domestic corporations compete against U.S.-controlled domestic corporations on an unlevel playing field. And here, up on the screen, is part of what the Senate Finance Committee said about why it proposed the BEAT. And I'll just read it, because it's so important that you have this fixed in your mind. Foreign-owned U.S. subsidiaries are able to reduce their U.S. tax liability by making deductible payments to a foreign parent or foreign affiliates. This can erode the U.S. tax base if the payments are subject to little or no U.S. withholding tax. Foreign corporations often take advantage of deductions from taxable liability in their U.S. affiliates with payments of interest, royalties, management fees, or reinsurance payments. The provision aims to tax payments of this kind. This type of base erosion has corroded taxpayer confidence in the U.S. tax system. And moreover, the current U.S. international tax system makes foreign ownership of almost any asset or business more attractive than U.S. ownership. This unfairly favors foreign headquartered companies over U.S. headquartered companies, creating a tax-driven incentive for foreign takeovers of U.S. firms. Furthermore, it has created significant financial pressures for U.S. headquartered companies to redomicile abroad and shift income to low-tax jurisdictions. This provision aims to level the playing field between U.S. and foreign-owned multinational corporations in an administrable way. To the extent that corporations with significant gross receipts are able to utilize deductible related party payments to foreign affiliates to reduce their U.S. corporate tax liability below 10%, the committee intends that the BEAT function as a minimum tax to preclude such companies from significantly reducing their corporate tax liability by virtue of these payments. Okay, so that's what they intended. And here's what the minimum tax does. First of all, it's limited to multinationals with gross receipts of at least $500 million. Corporations within the scope of this are called applicable taxpayers. So let's start with tentative BEAT. To arrive at tentative BEAT, you just simply multiply the BEAT rate times modified taxable income, or MTI, let's call it. MTI is taxable income determined without the benefits, which we call base erosion tax benefits, from certain payments, which we call base erosion payments, to so-called foreign-related parties. Now, depending on the taxpayer, the BEAT rate is either 10 or 11%, and it's scheduled to go up after 2025 to 12.5 or 13.5%. Okay, so that's the tentative BEAT. But what's the final BEAT? If tentative BEAT exceeds regular tax liability reduced by most credits, and after 2025 reduced by all credits, then the excess is the BEAT liability. If there's no excess, there's no BEAT. Okay, now let's talk about foreign tax credits, of which there are none. Looking away from the BEAT for a moment, think about the AMT, the alternative minimum tax, that's been around since at least 1986. It has an AMT foreign tax credit. So tentative AMT starts with the AMT rate times the AMT income, but then it subtracts the AMT foreign tax credit. Only after that subtraction do you have tentative BEAT, which you then compare to regular tax, which is also reduced by the foreign tax credit. With the BEAT, on the other hand, there is no BEAT foreign tax credit. And so BEAT equals BEAT rate times MTI minus regular tax reduced by foreign tax credits and most other credits. And in addition, not only do foreign tax credits not reduce tentative BEAT, but there's no US credit that offsets final BEAT, including the foreign tax credit. Thus, every dollar of foreign tax credit claimed is potentially a dollar of increased BEAT. Now, one other thing we'll talk about, there's a base erosion percentage test. You won't be an applicable taxpayer if your ratio of base erosion tax benefits to total deductions is below a certain amount, either 2 or 3%. So that's the test we have now. And Carol will talk about why the Build Back Better Act may have wanted to change that. Okay, so what's the abuse that this is anti-abuse of? Okay? The BEAT does not distinguish between, on the one hand, payments that generate income of a foreign-related party that is not taxed or lowly taxed, and on the other hand, income of a foreign-related party that is taxed at a very high rate, either by the United States or by any other country. The only exception to this is when the tax imposed on the payment is U.S. gross basis withholding tax. So, for example, deductions for payments to a CFC that generates subpart F income of the CFC and are taxed in the hands of the U.S. shareholders are base erosion tax benefits to the same extent as deductions for payments that bear no U.S. or foreign tax. Now, I will say this, that the Treasury Department did write a regulation that excludes from the definition of base erosion payment a payment that's ECI in the hands of the recipient, effectively connected income. But it's not obvious that the code authorizes even this regulatory exercise of lenity. And I think Professor might actually go further than that. So you have to make a payment to a foreign-related party in order for it to be a base erosion payment. Who's related? It's not necessary that you and the taxpayer be more than 50% common controlled. Any 25% owner of the taxpayer will do, or anyone 50% related or more to a 25% owner. So, think about what's on the screen here. It seems that it's targeted mainly at foreign-parented multinationals, but you can see from the description that the drafter has put no such limitation in the BEAT. A U.S.-parented multinational, all of whose foreign members are CFCs, must treat as base erosion payments the deductible payments that its domestic corporate members make to its CFCs. This is true even if the CFC is highly taxed, and even if the payments result in foreign source income inclusions that generate creditable deemed payments of the CFC's foreign taxes by the U.S. shareholder. So for a U.S.-parented multinational, even if the CFC's foreign income tax liabilities are so high that all of the parent's income inclusions under Subpart F are sheltered by credits for foreign taxes that the CFCs pay, the U.S. parent can owe a BEAT. And it will owe a BEAT if the only amount of gross income, if it has net U.S. source income, and it will owe BEAT on all of the CFC's income, not just the income that it got from a related U.S. person. Okay, so you may be surprised. So I think we ought to go on what happened since 2017. In 2021, the Biden administration and the House of Representatives took a serious stab at fixing these problems in the Build Back Better Act. And Carol was on the Joint Taxes Foreign Team at the time, and she'll give us a firsthand account of some of the thinking there. At the end of the same year, the Inclusive Framework released the Globe Model Rules. So then in 2022, the United States enacted a new version of the corporate AMT, and also in 2022 and every year since then, the administration has proposed to repeal the BEAT and replace it with an under-taxed profits rule, the UTPR, consistent with the Globe Model Rules. And we're going to talk about whether that's a good idea. So that and some other questions. Here are the questions that we're going to touch on, the paper touches on. Should the BEAT be repealed in light of developments under Pillar 2? Should it be replaced by a UTPR? And if it's retained, should the definition of base erosion payment be narrowed by reference to either the U.S. tax or the foreign tax that's imposed on this payment? And if so, how? Should the BEAT be offset by foreign tax credits? Should the BEAT treat tax credits, not foreign tax credits, more like payments of the taxes that are offset by the credits rather than as tax reductions, which is how it treats it now? And then, we can talk more particularly about whether some of the class of base erosion tax benefits ought to actually be increased, which we can talk about in a minute. I didn't mention cost of goods sold, but that's one tax benefit that is, generally speaking, is not a base erosion tax benefit. Should the base erosion percentage test for applicable taxpayer status be eliminated? And if the corporation becomes an applicable taxpayer, should it remain an applicable taxpayer in later years? Or at least until, say, 10 years have gone by or the IRS relieves it in its discretion. And that's similar to something that's in the KMT right now. So with that as background, I'll hand it over to Carol, and who's going to take us through some of the interesting points in the Build Back Better Act.
Okay, great. Well, thank you, Harrison. Thank you for such a thorough paper. And I think I'm going to try to answer these questions by referencing the Build Back Better amendments to the BEAT. And we have some staffers here from House Ways and Means and also my old colleagues at JCT, so definitely chime in if there's anything wrong, and you should speak up. But I think several of the BBBA amendments spoke directly to the concerns that Harrison raised in his paper. So before I go into the BBBA changes, I just want to quickly summarize some of the present law features that are concerning. First, present law BEAT requires that there be a finding of a base erosion payment, and these base erosion payments are added to regular taxable income to derive modified taxable income. And that modified taxable income is then multiplied by a 10% rate or a 12.5% rate to get this tentative BEAT liability. As Harrison said, the BEAT is a minimum tax, so it's only applied or levied if it's in excess of the regular tax liability. And the regular tax liability in present law BEAT is decreased by all tax credits after 2026. So research and development credits, foreign tax credits, all of those reduce your regular tax liability and have the effect of making the BEAT liability, in excess of the regular tax liability and more likely to be levied. And the last point in the present law that the BBBA addressed that I want to touch on is who is an applicable taxpayer? Who is in scope of the rules? Currently, a taxpayer is subject to BEAT if they satisfy two tests. There's a gross receipt test, and then there's a base erosion percentage test. So the gross receipt test is looking at annual gross receipts of $500 million or more over the 3 prior years. And then the base erosion percentage test is looking at, as Harrison said, base erosion payments divided by total deductions. And if that ratio is greater than 3%, that taxpayer has met the base erosion percentage test and could be subject to the BEAT. So what's concerning about the present law BEAT? First, base erosion payments are defined both too broadly, perhaps, and too narrowly. So first, it can be defined too broadly because of the fact that BEAT doesn't pick up just payments from U.S. companies to foreign parents, but also U.S. companies to foreign subsidiaries, that may be CFCs, and that could be picked up as guilty. So in this very simplified picture, you can see how this, so BEAT payments, base erosion payments, pick up interest payments or deductible payments made by a U.S. subsidiary company to a parent intermediate company resident in a foreign low tax jurisdiction. But it can also apply in the reverse situation where the $100 payment is being made by an intermediate company or a parent company that's a U.S. company to a foreign subsidiary company that's a CFC, and that generates actually guilty inclusion. So in that case, query whether that's a base erosion payment. The other issue with present law BEAT is that base erosion payment may also be defined too narrowly. Too narrowly in the sense that base erosion payment is defined as a payment that generates a deduction against taxable income. So it doesn't include payments that are reductions to gross receipts. And these payments that reduce gross receipts can be payments that are added to the cost of inventory, such as COGS. And so here's just a little table that I pulled from a JCT publication that can show some concern about the base erosion payment and its definition. In the last 2 lines of this table, which was in a JCT publication published last year in July, you can see 2 things. The average base erosion percentage from 2018 for the average corporate taxpayer dropped from 8.4% to 2.9% in 2020. So the average corporate taxpayer would have a base erosion percentage less than 3%, so that it's not subject to the scope of BEAT. The other point is BEAT liability collected each year is significantly less than what was estimated to be collected. So JCT also did a revenue estimate of the BEAT in the original TCJA, and the estimate was 150 billion or so over 10 years, more than 14 billion a year. And you can see in this chart that the BEAT liability collected was less than 2 billion a year, so a lot less than what was anticipated. This I guess gave some this kind of shows the concern that maybe the BEAT wasn't applying as intended.
Carol, I'd like to just make a comment on the slide. I think it's interesting, but I think we should be looking at the data with some of the principles and the policies that may have been in mind when the BEAT was enacted. First of all, cost of goods sold. You're right, it's not a deduction, right? It's a reduction in gross receipts. And when you think about what's included in cost of goods sold, it's things like the labor costs, purchases, costs that are required to be capitalized under 263 Cap A, that's direct and indirect costs to produce property acquired for resale. So there is a requirement in the code. And in fact, I think just prior to TCJA, the regulations under 263 Cap A were modified to either clarify or require certain indirect costs to be capitalized to inventory. There's also method of accounting rules that are applicable. So you can't just move from one method to another. This is relevant. Obviously, you have to get approval to change a method of accounting. So I think when looking at this data, and it's very interesting data, it's good to have a perspective on maybe the nuances and some of the other things and considerations that are relevant to the topic.
There's a question from Kyle.
Just to comment on the revenue estimate versus this data here, your hypothesis may be correct. Just a comment on maybe that this data is a little apples and oranges with the JCT's revenue score. So when JCT scores a provision, they're going to take into account behavioral responses. And BEAT may have, one of the responses may have BEAT pushed income elsewhere to be taxed. And that's where the 14 billion is coming in, where this is just looking at how much BEAT in isolation is raising. So this doesn't necessarily tell us that it's not working as intended, but perhaps, so just a thought on that.
That's a good point. But the BBVA addressed kind of both concerns that base erosion payments were defined too broadly as well as too narrowly by redefining base erosion payments to include amounts that are included or capitalized into inventory costs as COGS as base erosion payments. They also excluded from base erosion payments on which U.S. tax is imposed. So if GILTI is imposed on that payment to a CFC, then it wouldn't be a base erosion payment subject to BEAT. And then also base erosion payments are excluding payments made to foreign-related parties that were subject to a sufficient rate of foreign tax. And then the two other changes worth mentioning is the regular tax liability would no longer be reduced by tax credits. So no tax credits would reduce the regular tax liability. So as a result, BEAT liability is less likely to be in excess of that regular tax liability that's increased by all credits, foreign tax credits, LIHTC credits, R&D credits. And then the applicable taxpayer test, there's only one test that would apply in the BBVA, and that would be the gross receipts test. The base erosion percentage test was removed. So those are some of the BBVA changes. Arlene, did you have something to say?
I think on the next slide.
Okay.
Yeah.
Okay, so I thought it might be worthwhile to tie the BBVA amendments of BEAT to the two policy goals that Harrison kind of started our conversation with, which is treating foreign companies, foreign multinationals, similarly to U.S. multinationals. and also, just denying tax benefits from base erosion payments to foreign-related parties resident in low-tax foreign jurisdictions. So on the first objective, treating foreign parenting groups and U.S. parenting groups similarly, I think that the move to exclude from base erosion payments, those payments that are made to a CFC that are subject to GILTI, was a good move, in that foreign parenting groups are not subject to GILTI. They would just only be subject to the BEAT in that case. U.S. parenting groups could be subject to 2 minimum taxes. We want to treat them more similarly, so having only BEAT apply to foreign groups, and then only, I guess, GILTI then apply to U.S. parenting groups would be a move in that direction. Another consideration as I was preparing for this talk was maybe we need to also look at the gross receipts rule in the BEAT. Currently, for gross receipts of foreign entities, only gross receipts that are used in the calculation of ECI is included in the gross receipts. But for U.S. entities, it seems like the 448 regs, temporary regs, may pull in amounts that are used in the calculation of CFC income. So in that case, there could be more payments that are pulled into the gross receipts test for U.S. parented groups, and easier for a U.S. parented group to satisfy that 500 million threshold. So we could consider that further if we want to create parity between the two groups. The second policy objective of just focusing on base erosion payments, not payments that are not eroding or not payments that are being made to just save tax. I think the move to excluding from base erosion payments those payments that are subject to sufficient foreign tax is a good move also, as well as increasing the regular tax liability by tax credits that aren't commonly perceived to be base erosion payments. So that also is a good move towards furthering kind of the original BEAT policy goals that Harrison was describing.
Right. And if I could just comment, I think, if the policy goal of BEAT is to reduce deductible payments to low tax jurisdictions, then the tax imposed makes sense, because if it's U.S. tax imposed on by reason of CFC inclusions, subpart F or GILTI, then that makes sense to me. Also, with respect to the changes that are proposed in the BBBA as it relates to payments that are subject to a sufficient rate of tax, would also make sense. I think and it would get at the critique of
Foreign
BEAT.
rate of sufficient foreign tax.
Sufficient rate of foreign tax, correct. It would get at the critique of BEAT, which was that it was over or under inclusive, and so it was sweeping in too many taxpayers without regard to whether or not something was subject to tax. I think here, though, the need for some clarifications, and just as a practical matter, knowing when, for example, the tax has been imposed from a U.S. perspective, and then also with respect to the foreign sufficient rate of tax. How is that determined? I think the BBBA left some open questions. On the one hand, I think it referred to 904 D2F, for the high tax income rules, but then I think it also referred to the financial statement considerations and taking those into account, maybe because it was before we saw Pillar 2 get fleshed out with model rules. But I think that is going to be critical, because when you think about all the other changes that are proposed to BBBA, including expanding the scope of base erosion payments that could be swept in, a lot is going to, I think, there's going to be a lot of emphasis on what is the sufficient rate of tax from a foreign perspective.
Was there a clear intent, Carol, as to whether you would use financial statement concepts or U.S. tax measurement of income concepts in determining the foreign effective rate of tax?
Well, I think the statute is clear that it gives Treasury authority to use financial statement concepts to develop that. And I think that Arlene is right that the BBBA was issued or introduced in September, and the model rules weren't published until December. So there wasn't, an understanding or a consensus on what exactly the rules would be. So it was difficult to kind of pinpoint sufficient rate of tax by tethering it to some concepts that hadn't been finalized.
Right. But on tax imposed, so is it enough, or was the thinking, or do you recall of the thinking being that it was taken into account for as guilty or subpart F, was that sufficient, or was there some requirement to do further work?
On the US tax,
Yeah.
whether it's subject to US tax, not the foreign tax, I think what was in the description of the aims to the BBBA that was issued by JCT was helpful in explaining that. So it talks about the computation of guilty, so long as that payment is considered the computation of guilty, whether or not it's taxed at a reduced rate, doesn't matter. That would probably be a payment that's excluded from base
Or whether it
erosion
was
payment.
reduced by the fact that it wasn't in the intangible part of the CFC's income. In other words, it was the DTIR, prevented there being any tax on it. It didn't matter. It still was excluded from base erosion tax payment, base erosion tax benefit.
Yes, I think so. I mean, given what was written in the aims, I think that is helpful guidance.
So more work then would be needed with respect to fleshing out exactly what is a sufficient rate of tax for purposes of on the foreign side. Thank you.
By the way, DTIR is what you all call Cuba, but I don't want to be confused with talking about Cuba.
Yes, tying that back to the former comment earlier this morning. But I think on the sufficient rate of tax, foreign tax point, that 15% was chosen with some kind of, by the staffers really, I think because of the developments in Pillar 2. And so I just wanted to talk briefly about how BEAT and the Pillar 2 rules may be different. And I think materially different. It wasn't a specific policy objective for BEAT to be a Pillar 2 compliant rule, but it was definitely, the BBBA amendments were definitely developed with Pillar 2 in mind, developing in the background. So I think I made a chart on some of the differences, but rather than just reading through the chart, I think just going through two very simplified examples could be helpful in explaining how the BEAT and the UTPR are different. So here, you have this example group. You have a parent company owning an intermediate company that owns a subsidiary company. Parent co, intermediate co, and PE are in 3 different states, and subsidiary co is in the US. Subsidiary co makes a base erosion payment of $100 to intermediate co. That base erosion payment is then added to the regular taxable income of $200. So equals $300, and the BEAT rate of 12.5% is applied to that. So you have a tentative BEAT liability of 37.5. As a minimum tax, though, it's only applicable if it's in excess of the regular tax, and in this case, the regular tax is 21% of 200, so 42. So under these facts, there's no excess of BEAT liability over regular tax, so there's no tax under BEAT.
Carol, could I just say, though, in reality, when we were doing our BEAT calculation, generally speaking, you would have had BEAT because it was reduced by foreign tax credits, right? The regular taxable income would have been reduced by foreign tax credits. And so the proposal to not reduce your regular tax liability in BBBA is helpful. Just
Okay,
yeah.
yes, no, definitely. I think here, though, USCO is the last entity, so it doesn't own a CFC, so it's a little harder to show
Right.
the foreign tax credit that it would be able to use against its US tax, but I think that's a good point. Two other things about the BEAT is there is a reliance on a base erosion payment. There has to be a finding of a base erosion payment. And then two, the applicability of the BEAT depends on the gross receipts of the group, which is aggregated for all members of a group that's considered as part of a Section 52 single employer. So it's aggregated under tax rules. Okay, so now a UTPR. The UTPR, I understand, was derived with the BEAT as kind of its inspiration, just like the income inclusion rule kind of had the guilty and as a mirror. But the subsequent changes to UTPR made it substantially different from BEAT, primarily the collection mechanism. So rather than being an undertaxed payments rule, it became an undertaxed profits rule, and that was something that a lot of people focused on. But so in this structure, it's the same structure. The U.S. entity is a subsidiary co. We assume that the other states have effective tax rates of 10%, so it's below the globe minimum tax of 15%. Also assuming that for simplicity, globe income, financial statement income of each entity is 100, each entity owns a top-up tax of 5, or owes a top-up tax of 5. And if we can assume, which is not realistic, that the US has enacted Pillar 2 and has only enacted the UTPR of the various charging mechanisms within Pillar 2, US is the only entity that would then collect the top-up tax that's owed from parent co, intermediate co, and from the PE.
But in this situation, the U.S. interest is only contingently protected, because if there are QDMTTs, that's a kill switch to ever get to this. So we're not protecting the U.S. interest first. And if there's anyone else that's adopted a UTPR, then we would have to share that amount with everyone else. So where the BEAT is attempting to protect the U.S. tax base directly on payments related to U.S. business profits, the UTPR gives us a contingent interest only in the underpayments.
A joint interest, too.
Joint interest, joint contingent that can be kill switched off, which is very unusual. It's very unusual that we would cede our right to tax income based upon what the other jurisdiction does.
But in this picture, there is no U.S. income in these other entities.
Right.
It's just that they are low taxed.
Yeah.
And because of the UTP, and they each have a top-up tax associated with their low taxedness of 5, and the United States comes along and says, hey, nobody's collecting that tax, we'll collect that tax. And we'll figure out a mechanism, that's 15, 5 plus 5 plus 5, 15. We'll figure out a mechanism to collect it. Don't worry about it. It's not going to be denial of a deduction to one of these companies.
We already know that 40 plus countries have said they're going to adopt their own UTPRs, and that is path dependent on whether or not other jurisdictions have QDMTTs.
Yeah.
Is that like the connection between the BEAT and the UTPR? Really interesting discussion coming right after that transfer pricing, lively dialogue about U.S. arm's length standard, OECD transfer pricing guidelines. How could we or should we be thinking about the connection between OECD, UTPR rules, and US BEAT in this context?
So, yeah. You have another slide?
Oh, no, do you want us
Yes.
to answer that?
We have
Yes,
some
I want to
slides on
answer that question.
And then
on
Steve
this
has a
slide.
question as well.
Oh, okay. Go ahead, Stephen.
Yeah, I just, if you could go back to that prior slide. So the U.S. persuaded the OECD to treat, I think I'm remembering correctly, for QDMTT purposes, for guilty taxes to be taken into account.
As a CFC tax. That's
As
correct.
a CFC tax. Now, there are two responses to your concern. One is the the US could adopt a QDMTT itself, in which case, with the BEAT, it would, in theory, preserve it. That's a question, but that's possible. The other is maybe the US now needs to go persuade the OECD, in your example, that those QDMTT taxes upstream get pushed down for its UTPR, but that's just to that point. In other words, we're still in a fluid situation.
Right. And so what I want to answer Mindy's question and your point with two slides. And I don't come here to bury the Pillar 2 project, but nor do I come to praise it. But I do want to talk about what Pillar 2 means in terms of the BEAT. And there's a key component of Pillar 2 that is an interlocking top-up tax mechanism, where if the jurisdiction in the number 1 spot has a doctor's note that says I'm an adequately compliant regime, that doctor's note gives them a pass from any other top-up tax. There's a kill switch downstream. If QDMTT fails, then the IIR regime gives a kill switch for anyone else downstream. And so the GLOBE rules do something that the U.S. has never really had in its past, namely that In the past, we said you collect whatever tax you want, but we're going to determine whether it's low tax based on U.S. principles. And we're going to apply U.S. tax rules to determine that. Instead of saying, just give us a doctor's note that says somebody else's top-up tax is adequate. Why that matters is because the Pillar 2 rules have get-out-of-jail-free cards in terms of whether or not you can be adequately compliant from a minimum tax perspective and yet not pay any actual minimum tax. Isn't that cute? I'm minimally tax compliant, but I didn't collect any tax. And the two key carve-outs are a substance-based carve-out that you can have zero taxed income and get a doctor's note that says I'm a QDMTT regime and every other regime is turned off. Or you can have qualified refundable credits. And the OECD expanded that at the urging of the US to allow marketable transferable credits to also be not treated as a reduction of tax. That's curious because the Treasury Department at the same time said when we consider taxes paid under the US rules, if you get refundable credits, we're generally not going to treat those as taxes paid. We're going to treat that as a reduction of the amount of your tax. So on the one hand, we're saying we want the Pillar 2 rules to treat refundable credits, marketable transferable credits as not a reduction of your tax expense, so you can get your doctor's note and therefore have a kill switch on every other regime that might apply. But for US tax rules, we want to preserve the ability to say, we're going to look through that and not treat that as a more gross income and a payment of tax. Now, I want to talk from the paradigm that I would hope that Congress would think about. And I want to do it with a box that's different than what's on the slide. If you imagine that the slide had a US-owned company in that top box, so that I had a US subsidiary owned by a US parent, and base erosion payments were made to the foreign affiliate, that income of rents, royalties, and interest would retain its US source. The foreign personal holding company rules would pick that up as subpart F income because none of the active related party exceptions, none of the look-through CFC payments would be respected because it's a US payor. And if there were any US withholding tax, it would not be creditable. So in that model, if I shift US origin profits to a foreign affiliate with a base erosion payment, then the US under subpart F brings it back as US source, subpart F, no credits, no US withholding credits. I'm too young, believe it or not, even though I have no hair, to have been in the room, but I've been told that when Stanley Surrey was told about this issue, he said, I don't care, because you're moving US origin profits to a foreign affiliate that are US business profits are something I don't want to happen. And so the fact that you will retain subpart F treatment and have a punitive result is actually what we want. Now, the reason that's relevant is that if you're thinking about a competitively level playing field, we should look at how a US multinational would be treated under base of profits from US business that are paid as rents, royalties, and interest to a foreign affiliate. They would all come back and they would be subject to US tax. What the BEAD is saying is that if we're going to have those people in the US sandbox earning business profits and they can shift them to foreign affiliates, the US should have a first right to have the ability to have a minimum tax on business profits generated in our sandbox. And if you shift those, it may well be that another jurisdiction would love to tax those as well, but we under subpart F preserve the first right to tax US business profits. And the BEAD is simply saying we should, in order to have a level playing field versus the subpart F result, ensure that foreign-based multinationals incur a minimum tax. What is the amount that you can shift profits from the US to the foreign affiliate? You can shift half your profits because the BEAT liability is about the half the US rate. you have to have base erosion payments that are more than half or offset more than half of your EBITDA. And so if you view it from that perspective, I think that the BEAT does something that the UTPR is a dangerous game. We would only have the right under a UTPR to tax the residual profits if someone else didn't actually collect a real tax. And the OECD will give a doctor's note saying that you don't actually have to have a minimum tax paid if you're adequately compliant. And it puts us second in line, whereas the Subpart F results keep us first in line. And so, in my view, the BEAT should be a minimum tax. And there are things that should be done to fix the BEAT that are mentioned on the slide, and we could work through that if there's some Q&A about the specific points.
But a lot of them are in the Build Back Better
A lot of them are in the Build Back Better Act. But what is different is that if we're wanting to have a level playing field on U.S. origin business profits generated in the U.S., there's a fundamental jurisdictional question, and that is, don't we have a first right vested fiscal interest to ensure a minimum tax on those? And if you strip more than half of those profits out of the U.S., that's not an appropriate result, even if somebody else can give you a doctor's note to say you're compliant.
So this is getting to the point of, from yesterday and this morning about, first right of taxation versus, having a behavioral effect that causes, other countries not to take advantage of their low taxes.
Yeah, and so, for example, Singapore, as has been reported in the press, has said we're going to have qualified refundable credits. One could imagine that Mexico is going to rethink their maquiladora regime to fit in the exception. So there's going to be a number of countries, and there's really only 12 IIR regimes that matter in terms of how those provisions are going to preserve tax competition. Let me make one more point. I know we're getting short on time. I'm not trying to disparage anyone that worked on Pillar 2. The political decision at multiple pay grades above the working people at OECD decided that tax competition would not be stopped and that we would allow reasonable tax competition to continue. Having made that decision, the U.S. should not, in my view, simply accept doctor's notes and say that we're going to just stand back and let the U.S. tax base be eroded for foreign M&Es when we have a very strong protection with U.S. M&Es as a matter of horizontal equity.
So we had another topic in the paper, and that was what we called 163N. If you move the slide or give me the clicker, do we have a slide on that? Yeah. So, this is about thin capitalization. We have had 163J in the code for a long time, and it was completely rewritten in 2017. But there was also a lurking proposal for at least 20 years old to say that you should look at a multinational group's worldwide leverage and make sure that it's not any greater in the United States than it is in the company as a whole. And in fact, that's what 163N does. And what's interesting about that in the last 2 minutes is that that's not unlike what was in Action 4 of the BEPS project, but Action 4 basically used that worldwide ratio as a safety valve in order to allow you to deduct more than you could deduct under what they call a fixed ratio rule. And they call this the group ratio rule. And I'm looking at Barbara and thinking about the 2001, 2002 administration proposals to change the debt equity ratio safe harbor in 163J, where they said, some businesses really support more debt and we shouldn't penalize those businesses. The same thing is said in Action 4, that it shouldn't be penalized. So what I found interesting is that all the U.S. proposals do the opposite. They say you can either meet 163J or if it's less than that, you still can't deduct it if you don't meet this group-wide ratio under 163N. And it always struck me as, well, why didn't they follow Action 4? And I don't know if you would like to say some closing remarks about that, Carol, in our remaining minute before Mindy storms the stage.
Well, I acknowledge that Action 4 of the BEPS project, allows for the higher of a group ratio rule, something like 163N, or the 163J fixed ratio rule. But I don't think I have incredible insights, other than people from the audience maybe can add some insights as far as why, the lower of limit was chosen. In my recollection, it was about tracing which interest expense was disallowed from when 163J only applied versus to a new regime where both 163J and 163N would apply.
Which is why we have a reference to 163.0, which is about the carryovers.
Yes, I don't know if I can make two quick points, but I just wanted to say that the Senate amendments to the House-passed Build Back Better Act also allowed a group ratio rule that was based on assets as opposed to EBITDA. And so I think that was a good rule in that EBITDA and earnings are more volatile and asset values are less so. So I think future proposals should maybe consider that as a worthwhile addition to 163N. And then in the carry forward rule, I think there was speaking of unintended consequences, I think some practitioners have pointed out that the way that this is written, actually the carry forward disallowed interest is added only to the interest paid or accrued, the tax concept that's in red, but it's not added to the reported net interest expense. That's a financial statement concept that's in green to the denominator. So as a result, the carry forward just keeps getting larger and larger because it's added to the numerator but not the denominator. So that's maybe something that will be fixed, but I'm not sure that this was an intended consequence of the carry forward rule.
Thank you.
Thank you so much. So about that, everybody. Thank you. Oh, they will. Sorry. Perfect. All right, we are at the home stretch, everybody, and our next panel is the individual taxation. Our presenter obviously does not need any introduction, Mindy Hersfeld, Professor of Practice at the University of Florida Levin College of Law. And our commentators are Clark Armitage, a member at Kaplan and Drysdale, Sahil Asar, counsel at Buchanan, Ingersoll, and Rooney, and Stephen Haji Logio, a partner at McDermott, Will, and Emery. I was practicing.
I think I didn't build in enough breaks into this schedule. But thanks everyone for sticking through to close to the end, although not the last panel, which will be fantastic, for this session on taxation of individuals. And I guess, so most of what we've spent the past almost day and a half now on is corporate taxation, but which is what I've spent most of my career on. But in Florida, that is corporate taxation is less of a concern than, as Steve will tell us, taxation of individuals, high net worth individuals and their cross-border business. And so as a University of Florida is a sponsor here, and it's a UF Tax Incubator Group, we are dedicating some time to considerations of taxation of individuals' cross-border income. And one of the reasons why this is particularly important is because there have always been differences in the way individuals versus corporate foreign earnings have been taxed, but the 2017 tax law really sharpened and heightened those differences. And so what I'm gonna give a little bit of a spoiler alert in the beginning here. My thinking on this has pretty much come full circle from an article I wrote shortly after the 2017 tax law passed, where I said, the 2017, Tax Cuts and Jobs Act treated individuals unfairly. It denied them much of the benefits that corporations got on their foreign earned income. And why did it do this? And it seemed that individuals were just a forgotten aspect of the 2017 tax law. And so I think I'm going to run you through some of my thinking, but I look forward to hearing from the commentators here and from any of you as to whether my evolved thinking, that maybe it got to the right place, may or may not be the right approach. So to take a step back and go really basic. So U.S. classical system of taxation. Corporate, we have a two-tier system, 2 levels of tax. For corporate income, we tax income. So in a purely domestic context, we tax corporate income, corporate profits, once at the corporate level, and then when those profits are distributed to individual shareholders, they're taxed again. And so that's been our historical system since the beginning of the income tax. In 2004, that basic structure of the system wasn't changed, but we introduced a lower rate on dividends. And at the same time that the lower rate on dividend, the capital gains rate, the lower capital gains rates was introduced on dividends from corporations, the statute also allowed, Congress also permitted that lower rate to apply to some dividends from some foreign corporations, and that would be qualified foreign corporations. And qualified foreign corporations is defined in the statute by reference to whether the U.S. has a tax treaty, or whether the payor is eligible for the benefits of a treaty between the U.S. and another country. So that's 2004, and then we skip forward a couple of years to 2017 when we've got a lower corporate rate introduced. And so what that means is that for the first time, really, the combined the combined rates on the two levels of tax on corporate profits, one at the corporate level, one at the individual level, now equal combined really the higher individual rate, although you still get the benefit of deferral for income earned in a corporation. Okay, so that's a corporate tax, corporate versus individual tax on the mostly domestic level. If we then think about foreign income, so foreign earnings historically were taxed, so if an individual earns income overseas, taxed immediately, just like on domestic income, at the highest individual rate. But income earned by a foreign corporation, historically not taxed in the United States, so we're going way back, pre-1962, historically not taxed in the US. I know George is going to say there was some taxation of foreign corporate income even before 1962, but mostly not taxed in the US until repatriated to the US as a dividend, and obviously that allowed for deferral. And then another important aspect of this historical system that still exists, but domestic corporations could claim a foreign tax credit to offset taxes paid by a foreign corporation upon the receipt of a dividend from the foreign corporation. But this foreign indirect foreign tax credit is called, still called, individual is not allowed for individuals. So what that means is that you essentially, when you take into account the foreign tax credit, when you layer on foreign tax credit into the levels of tax system and the difference in how individuals can claim a foreign tax credit versus corporations. You have again, we're pre-1962 still, 2 levels of tax at the corporate level. One foreign corporation, one at the domestic corporation upon the distribution of profits, but the domestic corporation can claim a foreign tax credit for the foreign taxes paid. So you've got foreign taxes paid by the foreign corporation, U.S. taxes paid by the U.S. corporation, 2 levels of tax. But the individual who cannot claim the foreign tax credit on the dividends paid by a foreign corporation is also now paying 2 levels of tax. It's like the corporation, it's paying 1 level of tax at the foreign corporate level, but it's paying another level of tax when the income is repatriated because it can't claim a foreign tax credit. Okay, so in 1962, Subpart F was introduced. It accelerated taxation of foreign earned income to 10% shareholders to 10% U.S. shareholders of controlled foreign corporations. Again, U.S. corporations could claim a foreign tax credit on the deemed inclusion of the foreign earned income, but individuals still, even though individuals, just like corporations, were required to include the Subpart F in taxable income, they still could not claim the indirect credit. However, a special election under Section 962 allowed individuals to claim a foreign tax credit on the Subpart F inclusion to the extent that they would elect to be taxed as a U.S. corporation, with an additional tax cost arising on the subsequent distribution of profits. Also introduced in 1962, as we learned about earlier today, Section 1248, recharacterizing gain on the sale of stock as a dividend to the extent of earnings and profits, also only applies to corporate sales of stock. But 1248B attempts to reach a similar answer as 1248A through a formula. Doesn't operate in the same way, but it attempts to get to a similar place, commensurate place, using a thesaurus. Okay, so now we fast forward from 1960. So that's like the landscape from 1962 to 2017. Some differences between individual and corporate shareholders, but probably not enough, and very little attention paid to Section 962. The election very rarely made because of the high corporate tax rate and the potential for double tax. So 2017 introduced a number of changes, and if you look at the legislative history, in general, and the people who worked on this can tell me if I'm wrong here, was the primary goal, the primary focus in 2017 was to address challenges faced by and posed by by corporate cross-border investment. Individuals perhaps were an afterthought in the 2017 tax law. You could tell me if I got this wrong. So what did 2017 tax law do? Well, we've heard all about participation exemption, 100% dividends received deduction for corporations receiving a dividend from untaxed earnings of qualified foreign corporations. That deduction, that DRD, is only available to corporations. It's not available to individuals. So whereas corporations maybe get a free pass on taxation of foreign earned income, individuals do not. 2017 law also introduced a lower rate for the inclusion. So it mandated much larger inclusion of foreign earned income, known as GILTI, but it allowed a deduction against that inclusion, now currently 50% deduction. That deduction in the statute is, again, only allowable for corporations, not for individuals. Also introduced another deduction for foreign for income as foreign-derived intangible income. Again, only foreign-derived intangible income earned by corporations, not for individuals. Individuals do not get the benefit of the FDII deduction. I'm with Pat in calling it FDII rather than the other term.
Fitting.
And then 1248J attempts to replicate the 245 Cap A benefit for the sale of stock. We heard all about whether we get to the right place there. Again, 1248J, because 1248 doesn't apply to for individuals. 1248J also doesn't apply for individuals. Treasury regulations under Section 962 have effectively allowed individuals who elect to be to be taxed as U.S. corps for Subpart F and guilty purposes to claim the Section 250 deduction. So it addresses one of the differences between corporate and individual taxation of foreign earned income, but doesn't deal with the rest of them. So lots of questions here that were in my mind that as I started down this path. Do we get to the right balance? Has the law gotten to the right balance here? Whereas you could say perhaps it's really unfair that corporations get the benefit of the 245 Cap A deduction, but individuals do not. Maybe that's the right answer, because denying individuals the deduction for the DRD on the payment of dividends from foreign corporation ensures that a U.S. individual is taxed at least once on its receipt of earnings of the profits of a foreign corporation in which it owns shares. If we allowed U.S. individuals the benefit of a DRD for such dividends, they would get a completely free pass on the earnings in a foreign corporation. Now, you might say, well, those earnings are being taxed by another country, and so why should the U.S. get another right to tax it? But assuming that the U.S. wants to be able to tax its residents on their earnings and still on their worldwide earnings, then denying the 245 Cap A deduction would seem to be the better answer. And then perhaps, even though U.S. individuals don't get the benefit of the guilty deduction, the Section 250 deduction for guilty, maybe it's okay that the Treasury reg gives them that benefit if they make the 962 election. And then I'm just not sure what rationale. We had a very interesting session on FDII earlier today. I'm not sure, and I didn't pose a question earlier, whether there's any rationale for individuals being able to claim the benefit of the lower FDII rate, just like corporations. And then some things which seem like glitches. Like 962 doesn't fix the differential in 1248, which just seems odd, but maybe it's not. Maybe as a practical matter, it doesn't make that much of a difference for dividends paid or for sales of stock of a company that's located in a treaty jurisdiction. Then another question, there's this kind of arbitrary standard in Section 1H11 of a qualified dividend from a qualified foreign corporation defined by reference to a company that's resident in a jurisdiction with which the U.S. has a tax treaty. Why is a tax treaty relevant in this situation? Why, like, what are we trying to get at? Or do we want to deny the lower U.S. rate for income that's subject to low foreign taxes? Well, then the treaty standard doesn't seem eligible. It doesn't seem like the right. Doesn't seem to make sense at all. And so. Do we want to rethink that standard? But maybe someone who was there when this was being drafted has a good explanation for why that standard was chosen. And then there's different 1248, and when CFC shares are owned by a partnership, that's a whole another can of worms. I don't know if any of the commentators want to get into. And another big topic, PFICs. I know Steve maybe wants to address some of those points, areas where Congress could provide clarity for startup companies, working capital, and the like. So with that, I'll turn it over to all of you to comment on any or all of what I've said. You can start.
Sure. So thanks very much. Great paper. Enjoyed reading it. Really didn't understand it the first time I read it. Sort of understood it the third time I read it. One of the things that helped me understand what you were talking about in many places was identifying the goals of what the legislation might have been for individuals. And you have to benchmark the legislation against something. So I wrote down a bunch of goals. Do we meet the goals or do we fail the goals? And there's so many variables that you can't really easily conclude on any point probably. But we operated in our pre-discussion under the assumption of a zero rate foreign tax, foreign country rate, 0%. So if you take that as the starting point, what are the goals and does the legislation meet the goals? So one goal was to avoid parking money offshore anymore. And 965 dealt with the past, but let's deal with the future. Can we establish rules that prevent that kind of goal of parking money offshore? And I think largely the answer is yes, and jump in anybody if you disagree. But PFIC rules are still out there. The CFC rules, as long as guilty is a fairly comprehensive taxing regime, you're going to be taxed. There's an exception area for those situations that are neither CFC nor PFIC, and you can still get the benefit of deferral. So that's maybe something we should tackle. But overall, generally, there's no longer the great incentive to leave money offshore that there once was. Happy for anybody to jump in on that.
Yeah, I'll jump in there. I think, with the guilty rate of 10.5% in a zero tax jurisdiction, as long as you're not repatriating those profits, I think certainly there is a benefit of an offshore CFC earning that income rather than an individual in a flow-through structure.
Yeah, and so my two caveats were the non-PFIC, non-CFC area, and if you make a 962 election, you get a slightly reduced rate, maybe about 34 between the two rates of tax right now, and deferral. And so later on, I have a couple of recommendations for addressing those. But I think, subject to that caveat as well, you have less incentive to leave money offshore. Another incentive is to move your operations onshore that generate foreign earned income. And I think just the fact that there's less deferral overall, pushes money back to the States. There's not the same incentive to continue to reinvest those profits offshore because you can now bring them back in a little more tax efficient manner.
So can I stop you right
Yeah.
there? So with respect to that point, if the idea is to incentivize for those profits to come back at reduced rates, why should there be a disadvantage to the individual who may wish to do that, other than individuals likely have passive investment income versus multinationals where the impact of those foreign profits coming back into the United States are going to be sufficiently, if you'd like, larger than, say, a private individual. But would you say that is one of the underlying reasons, or?
I'll jump down to the bottom of my paper. I thought that what you really want to do is have every type of structure taxed the same, both in terms of timing and rate. And otherwise, and maybe you decide you want to create different options for taxpayers. I'll have some deferral, please, in exchange for a larger rate, but right now it's deferral with a lower rate, I think, under 962. Mm-hmm. And so if there's exceptions, right? There's how do you address variations in foreign tax credits, variations in what whether you get qualified dividend treatment. In the PFIC regime, you have capital gains that can flow through as capital gains. So there are other issues to tackle. But overall, is that a good goal? I mean, my thought was yes. Get everybody to the same rate regardless of structure. Address timing concerns. Allow deferral, but maybe have a PFIC-like tax interest inclusion that's required. And if you take that to its logical extent, you could essentially apply that. First of all, the guilty rate in next year in 26 is going to go up to essentially 37%, right? So it's going to be basically the same between, I think it's 13 1/8 plus 23 0.8, you get to 37. So it's maybe that's not a problem. So address the deferral. You could address it with something like how the PFIC regime addresses it. Fine, don't pay current dividends, but then you got to pay interest on the tax deferral. And those are, I don't know if those are big changes or not, but they would make the whole thing cohere, I think.
Sahil, Are you really, your point about the individual being disadvantaged if they bring the cash back relative to a corporation deciding to bring cash back? I guess the way the question is posed is like similar to the rationale that's always being offered for why 199 Cap A is important,
Correct.
right? We need the lower rate for individuals engaged in business, because otherwise, why'd you lower the corporate rate and not
Correct.
lower the individual rate? But individuals have a choice, right? You could have always stuck your foreign business in a U.S. corp and gotten the benefits of using that cash
A few more
in
steps.
the corporate structure.
Yeah, my view on that is if you allowed the individuals to take dividends out of their CFC tax-free, they're essentially taking their money out of corporate form, or they would be allowed to take their money out of corporate form without the second layer of tax, which is, as you mentioned, been in the code since the origination of the two layers of tax system. So I don't know any other better way to do it. So other than, of course, dropping your CFC into a C Corp and then bringing your money up to the C Corp and reinvesting that in the U.S.
And there's also, it seems, I mean, my practice involves a lot of U.S. individuals who are frustrated with this particular rule, and there's this, I have to give the explanation, well, why not? And then you have to restructure. And then sort of reading your paper and kind of thinking about the underlying policy reasons, there seems to be a rule of convenience, if you will, because the focus from a tax policy, what is with respect to multinationals as compared to individuals, is vastly different. The individual is predominantly about tax compliance, ensuring that their offshore assets are streamlined in a way that there is some impact, but it's quite different than, say, a large multinational that's going to have an impact on our economy, and it's a larger scale. So in hindsight, I guess I do concur that you have different options of organizing yourself, and perhaps Congress's thought was their focus is truly the multinationals because that's where you get the largest impact. And how many private individuals do we know where their activities would rise to the level of the same type of impact that a multinational?
I can think of a couple.
What's that?
I said I can
They're
think of
out
a
there.
couple, but.
Yeah. Or our panel will be moot. But one thing that strikes me is how close the rates on income are for individuals now. There's a couple of exceptions, but everything tends back to the high 30s. With two levels of tax. Maybe there's deferral. Maybe there's a little difference with GILTI now. FDII's off on its own over on the side to be discussed, but there's not nearly as much difference as there might have been pre-TCJA. And one of the points that you made in our discussion, Mindy, was that it doesn't seem as broken as I thought it was going to be, if I'm paraphrasing accurately. And there are things to fix, but I would say it's around the edges, not core.
I would actually take it a step further. I think a well-represented individual has more options than a corporation post-TCJA than they did before. I mean, the individual, through the use of maybe S-corps, can trigger into complete flow-through without necessarily a tax on that inbounding under a 332.
Or just operate through a foreign partnership.
Well, a liquidation to foreign partnership would be a taxable liquidation as opposed to inbounding into a S-corp, which would just trigger the all E&P amount, which, with GILTI now in place, there's not a lot of E&P in most of these CFCs, assuming the transition tax applied. So actually, the interesting thing about the TCJA is, for whatever reason, maybe somebody in the audience can answer this, but they love CFCs owned by S-corps. I had represented individuals with CFCs for many years, never saw one with an S-corp, but then once the transition tax rules came out and there was an indefinite deferral, magically every individual in the world had an S-corp that owned their CFC by the end of 2017. But the other advantage of it, obviously, is that a 332 works into an S corp, and so, you know, I think that's a fair result, because if you think about it, right now, without a 962 election, if you're an individual that owns a CFC in a high tax place, your CFC would have been taxed at the high tax rate. You wouldn't have gotten a foreign tax credit, and then you'd get a deduction for that tax paid, and then you'd have a flow through at a 37% rate of that income. And then if you add in the potential that a withholding tax applied on a distribution out, then that individual could be subject to taxes that much greater than 50%. So the ability to have that escape hatch into an S corp is important.
Can I call in one of the, yeah, Steve?
I was here, you didn't call me.
He didn't call anyone, except until later. I wanted to call in the audience and see if some of the people who were closely involved in the 2017 law wanted to weigh in on some of these questions about the extent to which individuals were considered in the legislative process, and also the Steve's S corp point.
Looking at Barbara.
Individuals in the international area is very complex. I mean, and it was complex before TCJA. It is still complex. I will say on your comment about S corporations, I think that those rules reflect a significant interest in S corporations. As opposed to the CFCs, there's strong bipartisan interest in S corporations. So.
I would say that my comment was assumed that there was a well-represented individual. I mean, there's certainly a lot of traps for the unwary now, and the compliance for corporations is equally hard for individuals. So that makes it very difficult, I think, for a smaller company to be compliant.
I would just second what Barbara said and add to that it didn't magically, is it 965I, I think, right? It didn't magically appear, although an earlier version of it was in the 2014 draft that former Chairman Camp put out in February of 2014, almost 4 years before the TCJA. I think not a lot of people noticed that until it was in the version of it was in the 2017 legislation. But as Barbara said, S corporations are very well organized and my recollection is they raised concerns as early as 2012, 2013 when we were working on this stuff, that if 965 was a toll charge to get on the dividend exemption highway, well, they weren't going to be eligible for the dividend exemption highway, and so they should be able to avoid the toll charge, at least for as long as they didn't engage in a transaction where it could ultimately be under a C corp that then could get the exemption. And I think they made a compelling argument, but my recollection, as Barbara suggested, is it was an S corp specific conversation.
Okay.
Just to clarify, I didn't say the law magically appeared. I said the S corps magically appeared.
I know you had a bunch of points you wanted to make, Steve, or Sahel. I don't know who wants to give.
Sure, I have a few. Yeah. So, I do think 962. The policy perspective behind it works perfectly with GILTI, so I was very happy to see that the regulations came in allowing the 250 deduction to individuals that make the 962 election. And so that was a very fair result.
Do you think it matters that the result is in a reg rather than a statute?
Well, I think the statute gave the appropriate authority to clarify it in the regulation. I was actually surprised that many commentators thought that that deduction would not be available, but the community seemed to think that was true. Anyway, I think the right result was reached there. One comment you made in your paper, which I thought was a good one, is that the indirect credit should apply to individuals regardless of whether a 962 election is made. I think in your paper, though, you suggest maybe that's in lieu of being allowed to make a 962 election. I would say that taxpayers should have the option to make the 962 election or get the indirect credit because, you know, a lot of companies are reinvesting their profits in their business, and so to get the 10.5% rate, I think, is very important for those clients. One thing that is always a challenge is withholding taxes, especially as it applies to individuals with CFCs, because they might be making a distribution of PTEP or 962 taxable E&P, and then a large withholding tax could apply in addition to that. And I think there's some uncertainty as to how the foreign tax credits work in that scenario. One thing that's always true in our treaties is that individuals have a higher rate than corporations. So a lot of our treaties give 0% rates to corps, but individuals are always subject to at least a 15% rate in most of our treaties. And then the net investment income tax is something also that I think needs a little more clarity, especially on the timing of when it applies. So I think there's, in the regs, kind of dependent on how involved the individual is with the business, the tax might apply at different times. I did like your comment.
Eric's smiling because he had 5 notes for me to add more information on the net investment income tax, and I said, it's too complicated.
Yeah. Yeah, that was one thing I noted too. So.
Great minds think alike.
I do like the comment about expanding the 1H11. I don't understand the policy of limiting qualified dividends to treaties or countries that impose treaties. But the other thing is, you know, a lot of commentators simply say that if the U.S. has entered a treaty with a country, the dividends paid from that company are qualified dividends. That's not actually how the rule works. The rule actually says that that company has to pretend it's earning income in the U.S. and whether that income would be qualified under the LOB provision. So you might have a scenario where a U.S. citizen owns like 10% of a foreign corp, and that foreign corp, when it pays a dividend, would get the benefit of a treaty, but that person still might not get qualified dividends. So I never understood the reasoning behind that rule. I would think if that person is qualified to receive treaty benefits, he should also get qualified dividends. And then the last thing I'll say, 958B4 has been a real disaster for individuals. It used to be that, you know, family-owned businesses where the family might be from another country and some child has moved here would largely be non-CFCs. Now the assumption everywhere is that they are CFCs. And I've seen a lot of scenarios where children who have moved to the US are disinherited simply because they live in the US. So mom and dad might not give their child their 20% interest in the family business, not because of the taxes, but because of the compliance involved. So, you know, I do see a lot of times where a closely held business is as large as a public company, and maybe there's 200-300 subsidiaries, and imagine doing all the CFC compliance for a business of that size just because 20% is owned by a US citizen. It's a little outrageous.
So I can concur to that point because I see that as well. I have a large clientele outside of the United States, and the concern each time is, oh my gosh, if we have a US entity, we have to abide by numerous different compliance in terms of reporting. It's not worth it. It's not worth the headaches. We're going to, you know, go somewhere else. So I've seen that over and over again, sadly.
Did you have anything else you wanted to add?
No, I wanted to also talk about the 1H11, but I think that's been sort of posed, so I'm not going to reiterate.
A couple other things. One is, the PFIC rules, particularly for startups, are a disaster. The startup exception is not well framed. You earn interest income and suddenly you're a PFIC and you're a PFIC forever. And those rules could be cleaned up. One idea is, I don't really understand the exception from current income inclusion for entities that are not CFCs and PFICs. Once you've gone that far, why is that little slice still off on its own and not subject to current inclusion? Does that make policy sense? Anyone can speak to that, but it seems to me that it doesn't. And so one idea might be to have a CFC regime with deferral and a lower, a tax rate that you eventually pay for, and every other foreign entity. And maybe some kind of a PFIC regime, you could get rid of some of the definitional aspects of the PFIC regime and just say any other foreign entity is subject to this secondary regime, which has certain options. One might be current inclusion, like a QEF. One might be later tax with an interest charge. I don't know if there are lots of companies out there that would not like that, that conclusion, but it seems to me to make policy sense.
That is an interesting idea that I have never heard of before.
Why do you think that there's a gap that needs to be filled?
There are companies that are neither PFICs nor CFCs that do not have to currently include their income. And the question is, why are they different? And look at the Moores, for example. Someone mentioned them. They're an 11% shareholder. Is that really different from a 9% shareholder? Is the policy difference enough to justify different treatment?
So they're CFC shareholders.
Right, exactly, yeah.
I'm just asking a different question, which is, so, we have a 1050 rule, which applies, by the way, to corporations that are not CFC shareholders. And we have the rule because the CFC rules don't apply. And, in other cases, the PFIC rules don't apply. And by the way, the PFIC rules should only apply when there's a PFIC, a PFIC problem. I mean, these are not good rules to extend to anyone that doesn't have to otherwise deal with them. So I don't really understand why we think that somebody needs to be taxed just because they fall between those, that they're not in one of those two regimes.
That's a really good question, and we can debate it for a while, but I want to make sure that we start the next panel on time because I'm looking forward to hearing what they have to say, and they have to get mic'd up. So unless anyone else has, okay. So thank you so much for helping us through.
Thank you.
Final session. In this session, we will cover every issue related to international tax policy. And to do so, we have three outstanding panelists that I will not introduce. Instead, I will promote Michael's most recent book, as he asked me to do, The Power to Destroy. Pam prefers his earlier book, The Wolf at the Door. But if you feel so inclined, you can purchase both and then see which one you yourself prefer. Anyway, with that, let me turn to Michael to hear his thoughts on everything we've heard over the past day and a half, and anything else that may have come to mind.
Well, that's the best introduction of the day, I'll say that. I'm always glad to hear about my own books, especially in a crowd like this, which might actually read them. So our panel is entitled Bringing It All Together. And as I was sitting out here thinking about that, I thought this was really an impossible mission, but I'm not Tom Cruise, and so I won't be able to play that role. It was an impossible suggestion, so we're going to bring a little of it together, I think. The other thing that I was struck by is how much of this conference is a history story. That is to say, that many of the rules that were discussed came from the 1920s, so they are a century old. And then the new ones came, if you put aside the 2017 legislation, came in 1962, which is sort of more than about a half a century old, a little over half a century old. So we're talking about rules that were written for a very different world. And in thinking about the differences between now and then, obviously the most important difference is the crucial role of intellectual property. And the importance of IP to producing income, its growth over that period of time, its mobility, and its ubiquity, I think are all extremely important. And so I'm going to make most of my remarks through the lens of IP changes. But I want to be explicit about my normative framework, because there have been several normative frameworks produced here today. And I'll comment on them, and then I'm going to make a comment first about some that were not mentioned, which I think is a good thing. So it used to be at conferences like this, and this is not my first one, that people talked about worldwide economic efficiency and capital export neutrality and capital import neutrality and capital ownership neutrality, all of which are worldwide neutrality norms that the economists invented, again, about the 1960s with Peggy Musgrave's work. So I'm going to, as my written work suggests, discuss IP income from the perspective of the interest of U.S. citizens and residents, which I've argued is the perspective that nations will look at these international tax rules, and that certainly our president and Congress, no matter who it turns out to be, will look at these international tax rules. There are two other norms we've heard a lot about, and I just want to make very brief comments on them. One is double taxation. I always have trouble with the concept of double taxation, but at least for those of us who lived in New York in 2017, double taxation didn't seem to be of great concern to the Congress when it denied deductions for state and local taxes. And, you know, the question about double taxation is really a question of what is the overall taxation on income. And I have to say that, you know, a tax of 21% or a FDII rate of 13.25%, 13.125%, or so forth, plus the patent box rate, which is an average of 8%, I don't get quite so worried about double taxation when we're talking about patent boxes abroad, for example, and whether we should or should not tax that income here. And then the other goal that was mentioned a lot was maintaining the competitiveness of U.S. multinationals, which of course was a huge goal motivating the 2017 changes. And all I want to say about that is that we've got a very different Congress today than we did then, and they're going to be asking about U.S. jobs a lot more than they're going to be asking about U.S. companies competing in foreign markets with other foreign companies. And so I think that it's really worth thinking about how these rules will affect U.S. jobs and economic growth, because I think that's where we're heading in terms of the questions that will be asked going forward. So I want to talk about IP, and there's been a lot of discussion here about defining IP. Everybody seems to hate every possible way of defining IP. So I'm not here to defend QBI or the Pillar 2 5% of payroll and tangible property rules. If you like them, you may want to define IP that way. If you don't like them, you may not. Obviously, the patent boxes in general broad or narrower than that. If you want a fairly broad description, I commend Section 367D4, which has 6 categories of IP that are specified, although within the 6 subparagraphs, there are 24 specific categories that are identified. It's a longer list than it seems. And then there's the catch-all, which says any other item, the value or potential value of which is not attributable to tangible property or the services of any individual, which rings consonant with some of the other rules that we've seen, but is different. So Congress can define it however it will, and that's what will happen. I guess the other thing to say is that I really want to talk about the source rules. The main thing I want to talk about is the source rules on royalties and the discussion of the source rules. In 2020, which I think is the last year for which there's SOI data available, U.S. corporations received $215 billion of royalties from foreign sources, foreign payers, on which they paid $8 billion of tax, a rate of 3.7% by my calculations. And the paper on source, which spends a lot of time on the difficulties, and I certainly understand those, of identifying where property is used, where royalties are coming from, where is the IP used, suggests that this is, even in comparison to other source rules of which there is great difficulty, this is really quicksand. There's what do you mean used? And if you're looking at history here, how did we get to royalties being sourced where they're used? The answer is the phrase rents and royalties, which is the way royalties were always talked about. They weren't considered very important, and rents were sourced to where used, and they always said rents and royalties would be sourced to where used, and rents actually are usually connected with some tangible personal or real property, whereas royalties, as we know, are usually connected to some intangible property, which is harder to find in some sense. And so there is a place in which the paper on source suggests resourcing as domestic source royalties received by U.S. taxpayers for the use of tangibles outside of the U.S. where the royalty is free from withholding tax in the royalty payor jurisdiction. It says, surely, this is where I really woke up on this paper. Anytime somebody says surely, I think, okay. let me read this sentence carefully. Surely, the jurisdiction where development costs are incurred should have some primary right to taxing the resulting income from the development efforts. And I thought, surely indeed. And so I was surprised at the end of the paper that there was no recommendation for a fundamental change in the sourcing of royalties. It seemed to me that there was a strong argument for sourcing royalties in the country in which they are developed. It also occurred to me that this would be a great boon to the United States, since most IP is developed here. There were some numbers bandied about yesterday, but there are very big differences between what's developed here and what's developed elsewhere. And yet, there was no suggestion that we rethink the used rule. And of course, the transfer pricing paper, as was mentioned earlier today, seems to like the cost-sharing rules better than I do. I would like them better if there was a lot of cost-sharing with unrelated parties, but I don't think that's really the general case. And so there was no suggestion that we reconsider that. But again, I think if you think about sourcing royalties to where they are developed, you begin to ask yourself important questions about the role of financing and cost sharing and the like, and whether that should matter very much. Now, those are fundamental changes, I understand, and the project here was deliberately designed, as I understand it from both Paul and Mindy, to stay away from fundamental changes. But you raised enough problems that it seems to me that fundamental changes maybe should be on the table. And at least as I understand what's going on in the world, boy, there are fundamental changes afoot, not only in terms of the minimum taxes that are being proposed, but the role of market countries in their efforts to grab revenues, and then things like the Australian royalty ruling, which basically says they want to take their money on IP that was developed here, even though they didn't, they're not withholding it, or diverted profits taxes, or, you know, there are enough unilateral things going on around the world that the fact that this is a unilateral idea doesn't bother me a whole lot at the moment, and that the rest of the world, I think, will have to deal with it in some sense. Let me just say a couple of other things. Since Phil is not here, Phil is on jury duty, so we have a little extra time, which I may use up.
He warned me in advance.
As is my wont, as Pam and Eric know well. So if we did change the source rules this way, that would really streamline or eliminate a lot of the transfer pricing disputes that we're now seeing, a lot of the litigation. It also does link to some extent to the OECD's nexus requirement for patent boxes. I mean, they've got a little bit of that, a hint of that in their nexus requirement. It's just a hint because that's all they were willing to do. But if we were to change our source rules, that would change it a lot. And then if we want the revenue to go to market countries or other countries where there's manufacturing or whatever, we could provide in treaties or however for routine markup on those kinds of things. And then people will fight about what you mean by a routine markup and so forth, but that's okay with me. That's a smaller fight than the fights we're now having about IP. Then I'll make only a few more comments. One is, if we did that, I would then urge that we allow transfers of IP back to the U.S. with a carryover of basis and without imposing tax at the time of carryover. And that would encourage a previously owned IP to be back in the U.S., where incremental IP is often produced based on previously owned IP, which may be owned in a multiplicity of countries. So I think ownership of IP actually matters in a way that was, I think, understated in the panel yesterday on that question. And then the last thing I would say about this is that maybe you would have to think carefully about some transition rules and so forth on this sort of thing. I'm certainly just one quick comment. I would not give foreign tax credits under any circumstance for income that's taxed under a patent box. I don't see any reason to do that with the current rate structure. And so that might create a little discouragement from people putting their income there in the same way that everyone I know moved from New York to Florida after the 2017 Act. So I have no friends left in New York anymore. And then there was talk earlier about a little bit about DSTs. I think there was some question about whether we should be giving foreign tax credits for DSTs. And my view of DSTs is that these are, because they're gross-based taxes, they're really much closer to excise taxes or value-added taxes than they are to income taxes. And so there's no reason to be doing that. And then, you could certainly keep the FDII rules, but their role as an export subsidy would be even more apparent than it is now. I think it's quite apparent now. And you may get some retaliation, but as I understand it, Germany is actually thinking about some retaliation already. So that's that. And then, just to fill it out, since we're bringing it all together, I'm a person who is on the side of conforming guilty to an IIR or QDMTT and getting rid of expense allocation. And, I'm not a believer in country by country allocation, but that's where everybody is. And so if we have to do it, we may have to do it. And I would conform it. I think we're now essentially going to have to give away revenues that we should not give away if we don't. And so that's sort of where I end with that. But the big change, as I said, I would make is in the sourcing rules, which were arbitrary and unimportant when they were formed and are difficult, if not impossible, to understand now. And so I think this is where we should be heading.
Thank you so much, Michael. I will say on your double taxation comment, I certainly agree. I think it's not a particularly compelling notion to begin with, and it's at the very least very inconsistently applied, right? You don't hear complaints about the coexistence of income taxation and consumption taxes. Certainly a tax on wages and a tax on consumption are economically equivalent under pretty loose assumptions. That never seems to bother people. So I agree with you that emphasis.
Well, and payroll taxes and income taxes are pretty much the same for most people.
Well, same. Anyway, what do you agree that we should fundamentally transform our system of international?
Well, I certainly think we should be considering making some changes. So I had 3 points that I wanted to make. The first of which is that I think it's important for us to define the scope of the tax base, and this aligns with Michael's comments. So I'm kind of a broken record on this for a number of years now. I've been complaining about the fact that we've gone after secondary rights to tax as opposed to primary taxing rights, and that's what Michael's point is about. Second point is about the legislative process, both what gave us the current system with its discontinuities, inconsistencies, and unintended consequences, as well as why I believe there is the possibility of constructive legislative change I'm fundamentally, I have to be a Pollyanna, I have to be an optimist, which is why I like The Wolf at the Door a whole lot better than The Power to Tax, but whatever, go read both of them.
Power to destroy.
Power to Destroy, sorry, thank you, yes. And then the third point is that while we should be fixing the current system, because it can take, as we've seen, a very long time to do something, even fixing the current system, let alone moving to something new, but the global economy has changed, and we should get about designing a better system for the future. So to go first to the importance of defining the tax base, and I'll say the US tax base, although one of the things I learned from reading these papers was about the source rules and not realizing until reading that paper the extent to which we do have things that are determined other than by the United States. But I'm fundamentally US-centric and biased, although I like to think I'm neutral. I think that the US does better when the world does better because of the role that we've played and because of the role I think we can continue to play. So I'm okay with a system that is, I would think of as neutral, but recognizing that I'm American and I see things through my American eyes, I realize that there are a lot of people around the world who might not think that my ideas are very neutral. The U.S. has focused on protecting its base with measures aimed at secondary taxing jurisdiction rather than primary taxing jurisdiction. I think, like if I could go back to, 2017, I'd like us to go back and start by sticking a stake in the ground and saying, this is how I want to define the U.S. jurisdiction to tax. And that's a point I made to Bob Stack going back to the Obama administration. But you know what, this is maybe a curse of the revenue estimators, Mike. But you say, okay, I want to make changes to the transfer pricing rules. Well, it doesn't score anything. On the other hand, I can throw a bead up and I get a lot of revenue from it. So we move in directions that don't protect our primary taxing jurisdiction. Instead, we go at it on a secondary basis. That said, I think that the most important step that we can take to establish the U.S.'s primary jurisdiction is to create an environment where companies want to invest, where they want to create jobs, where they want their headquarters to be located. And if we do that, then we attract investment. It's a voluntary kind of thing. We don't have to set out rules. And in that respect, the TCJA made enormous contributions. The 21% corporate rate, took us off the top of the list of the highest corporate rates, ending lockout, FDII. So I think the carrots that were put in place have been very valuable. Secondary taxing jurisdiction has been a backstop to disincentivize base erosion and profit shifting. But with the implementation of Pillar 2 and rising corporate tax rate, that's going to diminish their role. I think when I look at Pillar 2, I think the reality is that the Biden Treasury gave up a lot of secondary taxing jurisdiction and dented our ability to reclaim primary taxing jurisdiction with encouragement of QDMTTs. And so I think we need to look at what we're doing going forward with all of that in mind. Second, on the process, I think there is, there's reason for us to be very pessimistic. If we listen to the discussion that's going on today, and we're going to eliminate the tax on tips, we're going to replace the income tax with tariffs. I mean, it's really, we have too much of our policy being driven by somebody saying, well, this polls well. I don't really care if it polls well. I miss Bob Dole. So, and I realize there aren't a whole lot of us in this room who are old enough to remember Bob Dole as the tax collector for the welfare system, yeah. But so, when we think about how tax laws are made, many of them are written without a system-wide view. They're made to address symptoms rather than cure the disease. And now, as we're saying about the source rules, we've got some that can't be changed or fixed without international coordination. And this is perhaps what the OECD should have been doing, or what the UN could be doing if they cared more about building an economically stronger and more inclusive world that is actually going to lift people out of poverty, as opposed to just merely ranting about inequality. A second problem is partisanship. We've had too much unwillingness of the parties to cooperate and work together and recognize when they have mutual goals. So every time they do something on a bipartisan basis, I get very excited. We need more of that. And a third problem is a bias for comprehensive change. Now, I've just complained about rules being written on a not system-wide basis or to cure symptoms rather than diseases, but we've had a tendency over the last couple of decades at least to take revenue-raising provisions. There's like things that are broken. We know they need to be fixed, but instead of fixing them, we've said, I'm saving that for tax reform. And while that may have facilitated the tax reform, we really need to have a willingness to fix known problems even on a standalone basis. My third issue, sorry, Mike, again, the role of the revenue estimators. In another group, we've been working through what I would call fairly minuscule changes to the international rules that have caused pain points for business, some options that might fix them. There's not a lot of revenue involved, but these provisions were put in the code because when Congress needed $500 million to reach a revenue goal, they grabbed it. Did it really raise $500 million? I mean, who knows? Having sat in a number of sessions where revenue estimates and how they get put together are discussed, I have an enormous respect for the economists who are doing this, but I also take what they produce with a grain of salt. When I first joined Treasury 20 years ago, the chief revenue estimator at the time got really frustrated with me one day when we were having a discussion about revenue estimates. And so he said, I'm taking you out to breakfast, and I'm going to tell you how this is done. And so we went to breakfast, and the one thing that he said that sticks to my mind forever is that he once got a revenue estimate right. And when he took it apart, it was because the mistakes that he'd made had exactly offset. So I think, one of the things that I've heard recently as we've been talking about some of these issues are that economists may assume companies will move for every last 1% of rate differential. I think this is something I heard Pat Brown say. The reality is that the chief tax officer who recommends a move for a 1% rate difference better be spending some time updating their resume quickly. So why, with all of that, am I optimistic? Well, one reason is this conference and a room that's still full of people who care about getting to right answers. And then the second is, actual hard legislation that we saw done by, our friends on the Ways and Means Committee in 2021 and 2022. The hard work that was done to examine the provisions, the groundwork that was laid by Barbara and others to fix issues that they saw. All of those kinds of things still go on and will go on, and I believe lead us to have some confidence that we can make changes that will improve the current system. Finally, while we should work on fixing the current system, we also have to be working on designing a different system for the future. It may take a while, but when we look at Pillar 2 implementation, the Global South's restlessness with what they've got out of Pillar 1 and Pillar 2, and then I think we have to look at things like the DBCFT. Get your hashtag out, George and Kyle. And Daniel, I think we got a bunch of fans of the DBCFT back there. But I think that the world has changed so much that we need to spend some time thinking about how do we migrate from our current system to something new.
There was some chuckling earlier at that table when someone conjured up a second acronym to refer to QBA. That we thought the lawyers really have a good way to confuse us all. Eric, let me turn to you.
Well, first I want to thank Mindy for organizing all of this, and this has been over a year project. So I want to give thanks to Mindy for everything she's done to organize us. I also want to thank Paul for his inspiration for this project, because I think this is a very important project to try to analyze what works and what hasn't worked exactly right in the TCJA. I also want to thank the authors for their papers. It was an incredible amount of work, and they did a fantastic job. I recognize I'm the fourth and final speaker on the final panel of this program, And I'd like to think I'm batting cleanup, but on the other hand, I might be batting last. But that's another unresolved issue, just like there's so many unresolved issues we've talked about, and I'll just add it to the list of unresolved issues. What I'm going to try to do very briefly is just try to summarize some of the key points that have been made yesterday and today, and I have 6 points that I'd like to make. The first one is, I think Mark Prater coined this phrase, that the advancement of legislation depends on policy, process, and politics. And this incubator initiative is a nonpartisan effort to focus on substantive technical issues, particularly on whether the TCJA achieved the goals articulated for it. This initiative does not focus on process or politics or on revenue estimates for potential statutory changes. But as we all know and have to acknowledge, process and politics are going to play a leading role in determining the legislative outcome in 2025. This initiative is focused on policy and not process and politics, but it's nevertheless worthwhile and meaningful because it's a contribution to the overall discussion, and I hope will educate policymakers and have an influence on the legislative process. Point number 2 is that the framework of TCJA is here to stay for the foreseeable future. And there are good things about that, very good things that the TCJA accomplished. As was pointed out by Pam, a lower tax rate, base erosion protection, Section 245 Cap A. And so it accomplished a lot of very important things. So that's on the good side. It really, including the lockout effect, ending the lockout effect. So low corporate tax rate, ending the lockout effect, dealing with base erosion, all very good things. I would say, on the other hand, it's built on an old system. I think of the term a palimpsest. It's a term I heard a long time ago where you have like a wax tablet, and you keep writing over it, but the stuff underneath it is still there. Another way of looking at it is like Yertle the turtle, you know, the pile of turtles on top of each other and they're teetering. This is what our current system makes me think of. And then when I was listening to the discussion of Section 1248, I think of 1248. I always thought that 1248 is about individuals converting dividends into capital gains. You sell stock, you get capital gain, when in fact the earnings are sitting offshore, and if they were repatriated, they'd be taxed at dividends at a much higher rate. And it just reminded me of so many other provisions of the Internal Revenue Code that I deal with, like Section 304 and dereorganizations and Section 355, that were enacted to deal with issues that really aren't the same issues as we have today. And we're trying to kind of take these provisions and try to cram them into a system that really is very different now. But TCJA has done a lot of good things. And I think it's here to stay for the foreseeable future, and therefore it's, I think, incumbent on us to try to improve it. Point number 3, nothing is certain except everything's going to keep changing. And how it's going to change is going to depend on factors in our control and out of our control, including the changing global economy that we keep talking about, developments in other countries, including those initiated by the OECD, and we can't predict exactly where that's going to go, though we can expect the trend to continue, and perhaps the United Nations is going to play an important role here. And finally, which sort of unspoken about this entire conference, is what's going to happen in the elections in November, and that's obviously going to affect where we're headed. My 4th point is, listening to everything, there are intractable issues in our international tax system for which there is no apparent solution. And I listened to the sourcing discussion, and with respect to sourcing, I don't know what the answer is to sourcing, except maybe moving away from sourcing altogether. When I think of sourcing and I hear the conversation about the characterization of what a payment is and then putting it in a basket and then figuring out what the source is, it takes me back to discussions I had in my LLM program 30 years ago, which is, it's all Bank of America. You figure out what bucket it goes in, and then you say what the source is. And to me, this is an intractable problem, and maybe we have to just completely reconsider sourcing. Also, transfer pricing. Between the United States and other countries, to me, is a problem that's going to go on for as long as we have a tax system. And all these issues are going to be exacerbated by our global economy, and with increasing only because of intangible assets. Intangible assets only increase the difficulty of these issues. And then my fifth point is, okay, who's going to solve these problems? Well, I have a priority order, which I think most people would agree with, that who's going to resolve these issues as required by the Constitution. Congress has the leading role. Congress passes the tax laws. Treasury has a very important role to play in the regulatory process. And then finally, the courts. But in my view, courts shouldn't be answering these questions. Leaving resolution to litigation just creates uncertainty. It's inefficient. It only answers specific questions in specific situations. And in the absence of rules, it provides opportunities for taxpayer planning and electivity. So, on the other hand, I will observe that the role of the courts is likely to be enhanced very shortly. Because I think the role of the Treasury Department and the IRS in writing regulations is gradually narrowing. And as we see with all the contests about what the role is, the proper role, under the Chevron doctrine, under the APA, et cetera, the role of the Treasury Department is narrowing. And I expect when the Chevron decision comes out, I think the role of the Treasury Department and IRS in the regulatory area is going to be even narrower. And then my final point is most of these issues, they're all entwined with each other. Every single panel, someone says, well, when we consider this, we have to consider what was said on 6 other panels. And we can't decide this until we decide that. And that's absolutely right. As Chip Harder said yesterday, the Internal Revenue Code is a vast, seamless web. And so consideration of any changes to our complex international tax system are going to need to take into account all the collateral implications. That's just the way it's going to be. And it's going to require time and resources. So we better get started now.
Well, that's why we've brought it all together. Michael and Pam, any closing comments? We only have a few minutes left.
Well, I didn't say this earlier. I've said it many times before, but I think that the lowering of the corporate rate, and it came up during the expensing discussion. I mean, I think as between expensing and lowering the rate was crucial in the international economy. And so I've been arguing for a lower rate for many, many years. And I just wanted to endorse Pam's comment about that. I mean, it was hugely important and politically difficult because corporate taxes, as bad as they often are economically, are really terrific politically, I think. And so that's a problem. And the TCJA deserves huge credit for that, plus some of the other things. So I just wanted to agree with Pam on that explicitly before I run for a plane.
Mindy, any closing comments from you before we hold apart? Otherwise, I think we may have time for one question. Anyone wants the honor?
Somebody probably like to put a question back to a prior panel.
Otherwise, I'm going to thank our panelists, and I'm going to give Michael permission to run off to his car. And I will thank you all for coming. Thank you to Mindy, Paul, others for organizing, and enjoy the rest of your day.
I'll just close out here, and not to try and repeat the very insightful attempts to bring this all together. I'll just repeat the thank yous. One special thank you to AEI, and that's Kyle and Stan for hosting us, and also Ottman, who's done tremendous work pulling this together. Really, the fact that it ran well is due to Ottman, so thank you very much. To Paul and Pat and the rest of the steering committee and the working group who've been working on these papers for over a year, really, but also all the commentators over the past 2 days, and really everyone else who participated. Yeah, that's what made this interesting conversation that I learned a lot from, and I hope you all did too. And then I would like to solicit all your input for where we should take this. I've heard a lot of thoughts of people telling me that we've got to do more with what we've done here. So I welcome any contributions or suggestions as to how we might take this forward. And one last thing, the books that you have, the compilations of the papers that you have on the tables are draft papers. Tax Notes will be publishing the final versions of the papers over the next several weeks, and so keep a lookout for those. And with that, thank you, everyone.